Welcome to Voice of the Pages, where the echoes of history and economics come to life. Today, we present one of the most provocative works ever written, The Creature from Jekyll Island, a second look at the Federal Reserve by Edward Griffin. A deep investigation into power, money, and secrecy, this book begins by exposing the fundamental question: where does money come from? Where does it go? Who truly controls it? Step into the shadows of global finance, where hidden decisions shape economies, and the origins of the Federal Reserve reveal themselves like a detective story. Let the pages guide you through a gripping account of monetary policy, deception, and the forces behind modern banking. Prepare to see the world's financial system in an entirely new way. Section 1. What creature is this? What is the Federal Reserve System? The answer may surprise you. It is not federal, and there are no reserves. Furthermore, the Federal Reserve banks are not even banks. The key to this riddle is to be found, not at the beginning of the story, but in the middle. Since this is not a textbook, we're not confined to a chronological structure. The subject matter is not a curriculum to be mastered, but a mystery to be solved. So let us start where the action is. Chapter 1. The Journey to Jekyll Island. The secret meeting on Jekyll Island in Georgia at which the Federal Reserve was conceived. The birth of a banking cartel to protect its members from competition. The strategy of how to convince Congress and the public that this cartel was an agency of the United States government. The New Jersey railway station was bitterly cold that night. Flurries of the year's first snow swirled around streetlights. November wind rattled roof panels above the track shed and gave a long, mournful sound among the rafters. It was approaching 10 p.m., and the station was nearly empty except for a few passengers scurrying to board the last southbound of the day. The rail equipment was typical for that year of 1910, mostly chair cars that converted into sleepers with cramped upper and lower berths. For those with limited funds, coach cars were coupled to the front. They would take the brunt of the engine's noise and smoke that, somehow, always managed to seep through unseen cracks. A dining car was placed between the sections as a subtle barrier between the two classes of travelers. By today's standards, the environment was drab. Chairs and mattresses were hard. Surfaces were metal or scarred wood. Colors were dark green and gray. In their hurry to board the train and escape the chill of the wind, few passengers noticed the activity at the far end of the platform. At a gate seldom used at this hour of the night was a spectacular sight. Nudged against the end rail bumper was a long car that caused those few who saw it to stop and stare. Its gleaming black paint was accented with polished brass handrails, knobs, frames, and filigrees. The shades were drawn, but through the open door, one could see mahogany paneling, velvet drapes, plush armchairs, and a well-stocked bar. Porters with white serving coats were busying themselves with routine chores, and there was the distinct aroma of expensive cigars. Other cars in the station bore numbers on each end to distinguish them from their dull brothers. But numbers were not needed for this beauty. On the center of each side was a small plaque bearing but a single word: Aldrich. The name of Nelson Aldrich, senator from Rhode Island, was well known even in New Jersey. By 1910, he was one of the most powerful men in Washington, D.C., and his private railway car often was seen at the New York and New Jersey rail terminals during frequent trips to Wall Street. Aldrich was far more than a senator. He was considered to be the political spokesman for big business. As an investment associate of J.P. Morgan, he had extensive holdings in banking, manufacturing, and public utilities. His son-in-law was John D. Rockefeller, Jr. 60 years later, his grandson, Nelson Aldrich Rockefeller, would become Vice President of the United States. When Aldrich arrived at the station, there was no doubt he was the commander of the private car. Wearing a long, fur-collared coat, a silk top hat, and carrying a silver-tipped walking stick, he strode briskly down the platform with his private secretary, Shelton, and a cluster of porters behind them hauling assorted trunks and cases. No sooner had the senator boarded his car when several more passengers arrived with similar collections of luggage. The last man appeared just moments before the final all aboard. He was carrying a shotgun case. While Aldrich was easily recognized by most of the travelers who saw him stride through the station, the other faces were not familiar. These strangers had been instructed to arrive separately to avoid reporters and, should they meet inside the station, to pretend they did not know each other. After boarding the train, they had been told to use first names only so as not to reveal each other's identity. As a result of these precautions, not even the private car porters and servants knew the names of these guests. Back at the main gate, there was a double blast from the engine's whistle. Suddenly, the gentle sensation of motion, the excitement of a journey begun. But no sooner had the train cleared the platform when it shuddered to a stop. Then, to everyone's surprise, it reversed direction and began moving toward the station again. Had they forgotten something? Was there a problem with the engine? A sudden lurch and the slam of couplers gave the answer. They had picked up another car at the end of the train, possibly the mail car. In an instant, the forward motion was resumed, and all thoughts returned to the trip ahead and to the minimal comforts of the accommodations. And so, as the passengers drifted off to sleep that night to the rhythmic clicking of steel wheels against rail, little did they dream that, riding in the car at the end of their train, were 7 men who represented an estimated 1/4 of the total wealth of the entire world. This was the roster of the Aldrich car that night. 1. Nelson W. Aldrich, Republican whip in the Senate, chairman of the National Monetary Commission, business associate of J.P. Morgan, father-in-law to John D. Rockefeller, Jr. 2. Abraham Pyatt Andrew, Assistant Secretary of the United States Treasury. 3. Frank A. Vanderlip, President of the National City Bank of New York, the most powerful of the banks at that time, representing William Rockefeller and the international investment banking house of Kuhn, Loeb and Company. 4. Henry P. Davison, senior partner of the J.P. Morgan Company. 5. Charles D. Norton, president of J.P. Morgan's First National Bank of New York. 6. Benjamin Strong, head of J.P. Morgan's Bankers Trust Company. 7. Paul M. Warburg, a partner in Kuhn, Loeb and Company, a representative of the Rothschild banking dynasty in England and France, and brother to Max Warburg, who was head of the Warburg Banking Consortium in Germany and the Netherlands. Concentration of wealth. Centralization of control over financial resources was far advanced by 1910. In the United States, there were 2 main focal points of this control, the Morgan Group and the Rockefeller Group. Within each orbit was a maze of commercial banks, acceptance banks, and investment firms. In Europe, the same process had proceeded even further and had coalesced into the Rothschild Group and the Warburg Group. An article appeared in the New York Times on May 3, 1931, commenting on the death of George Baker, one of Morgan's closest associates. It said, 1/6 of the total wealth of the world was represented by members of the Jekyll Island Club. The reference was only to those in the Morgan Group, members of the Jekyll Island Club. It did not include the Rockefeller Group or the European financiers. When all of these are combined, the previous estimate that 1/4 of the world's wealth was represented by these groups is probably conservative. In 1913, the year that the Federal Reserve Act became law, a subcommittee of the House Committee on Currency and Banking, under the chairmanship of Arsène Pujol of Louisiana, completed its investigation into the concentration of financial power in the United States. Pujol was considered to be a spokesman for the oil interests, part of the very group under investigation, and did everything possible to sabotage the hearings. In spite of his efforts, however, the final report of the committee at large was devastating. Your committee is satisfied from the proof submitted that there is an established and well-defined identity and community of interest between a few leaders of finance, which has resulted in great and rapidly growing concentration of the control of money and credit in the hands of these few men. Under our system of issuing and distributing corporate securities, the investing public does not buy directly from the corporation. The securities travel from the issuing house through middlemen to the investor. It is only the great banks or bankers with access to the mainsprings of the concentrated resources made up of other people's money in the banks, trust companies, and life insurance companies, and with control of the machinery for creating markets and distributing securities, who have had the power to underwrite or guarantee the sale of large-scale security issues. The men who, through their control over the funds of our railroad and industrial companies, are able to direct where such funds shall be kept, and thus to create these great reservoirs of the people's money, are the ones who are in a position to tap those reservoirs for the ventures in which they are interested, and to prevent their being tapped for purposes which they do not approve. When we consider also, in this connection, that into these reservoirs of money and credit there flow a large part of the reserves of the banks of the country, that they are also the agents and correspondents of the out-of-town banks in the loaning of their surplus funds in the only public money market of the country, and that a small group of men and their partners and associates have now further strengthened their hold upon the resources of these institutions by acquiring large stock holdings therein, by representation on their boards, and through valuable patronage. We begin to realize something of the extent to which this practical and effective domination and control over our greatest financial, railroad, and industrial corporations has developed largely within the past 5 years, and that it is fraught with peril to the welfare of the country. Such was the nature of the wealth and power represented by those 7 men who gathered in secret that night and traveled in the luxury of Senator Aldrich's private car. Destination: Jekyll Island. As the train neared its destination of Raleigh, North Carolina, the next afternoon, it slowed and then stopped in the switching yard just outside the station terminal. Quickly, the crew threw a switch, and the engine nudged the last car onto a siding where, just as quickly, it was uncoupled and left behind. When passengers stepped onto the platform at the terminal a few moments later, their train appeared exactly as it had been when they boarded. They could not know that their traveling companions for the night, at that very instant, were joining still another train which, within the hour, would depart southbound once again. The elite group of financiers was embarked on a 1,000-mile journey that led them to Atlanta, then to Savannah, and, finally, to the small town of Brunswick, Georgia. At first, it would seem that Brunswick was an unlikely destination. Located on the Atlantic seaboard, it was primarily a fishing village with a small but lively port for cotton and lumber. It had a population of only a few thousand people. But by that time, the sea islands that sheltered the coast from South Carolina to Florida already had become popular as winter resorts for the very wealthy. One such island, just off the coast of Brunswick, had recently been purchased by J.P. Morgan and several of his business associates, and it was here that they came the fall and winter to hunt ducks or deer and to escape the rigors of cold weather in the north. It was called Jekyll Island. When the Aldrich car was uncoupled onto a siding at the small Brunswick station, it was indeed conspicuous. Word traveled quickly to the office of the town's weekly newspaper. While the group was waiting to be transferred to the dock, several people from the paper approached and began asking questions. Who were Mr. Aldrich's guests? Why were they here? Was there anything special happening? Mr. Davison, who was one of the owners of Jekyll Island and who was well known to the local paper, told them that these were merely personal friends and that they had come for the simple amusement of duck hunting. Satisfied that there was no real news in the event, the reporters returned to their office. Even after arrival at the remote island lodge, the secrecy continued. For 9 days, the rule for first names only remained in effect. Full-time caretakers and servants had been given vacation, and an entirely new, carefully screened staff was brought in for the occasion. This was done to make absolutely sure that none of the servants might recognize by sight the identities of these guests. It is difficult to imagine any event in history, including preparation for war, that was shielded from public view with greater mystery and secrecy. The purpose of this meeting on Jekyll Island was not to hunt ducks. Simply stated, it was to come to an agreement on the structure and operation of a banking cartel. The goal of the cartel, as is true with all of them, was to maximize profits by minimizing competition between members, to make it difficult for new competitors to enter the field, and to utilize the police power of government to enforce the cartel agreement. In more specific terms, the purpose, and indeed the actual outcome of this meeting, was to create the blueprint for the Federal Reserve System. The story is confirmed. For many years after the event, educators, commentators, and historians denied that the Jekyll Island meeting ever took place. Even now, The accepted view is that the meeting was relatively unimportant and only paranoid unsophisticates would try to make anything out of it. Ron Chernow writes, "The Jekyll Island meeting would be the fountain of 1,000 conspiracy theories. Little by little, however, the story has been pieced together in amazing detail, and it has come directly or indirectly from those who actually were there. Furthermore, if what they say about their own purposes and actions does not constitute a classic conspiracy, then there is little meaning to that word." The first leak regarding this meeting found its way into print in 1916. It appeared in Leslie's Weekly and was written by a young financial reporter by the name of B.C. Forbes, who later founded Forbes magazine. The article was primarily in praise of Paul Warburg, and it is likely that Warburg let the story out during conversations with the writer. At any rate, the opening paragraph contained a dramatic but highly accurate summary of both the nature and purpose of the meeting. Picture a party of the nation's greatest bankers stealing out of New York on a private railroad car under cover of darkness, stealthily hieing hundreds of miles south, embarking on a mysterious launch, sneaking on to an island deserted by all but a few servants, living there a full week under such rigid secrecy that the names of not one of them was once mentioned, lest the servants learn the identity and disclose to the world this strangest, most secret expedition in the history of American finance. I am not romancing. I am giving to the world, for the first time, the real story of how the famous Aldrich Currency Report, the foundation of our new currency system, was written. In 1930, Paul Warburg wrote a massive book, 1750 pages in all, entitled The Federal Reserve System, Its Origin and Growth. In this tome, he described the meeting and its purpose, but did not mention either location or the names of those who attended. But he did say, the results of the conference were entirely confidential. Even the fact there had been a meeting was not permitted to become public. Then, in a footnote, he added, "Though 18 years have since gone by, I do not feel free to give a description of this most interesting conference concerning which Senator Aldrich pledged all participants to secrecy." An interesting insight to Paul Warburg's attendance at the Jekyll Island meeting came 34 years later in a book written by his son, James. James had been appointed by FDR as director of the budget and, during World War II, as head of the Office of War Information. In his book, he described how his father, who didn't know one end of the gun from the other, borrowed a shotgun from a friend and carried it with him to the train to disguise himself as a duck hunter. This part of the story was corroborated in the official biography of Senator Aldrich, written by Nathaniel Wright Stevenson. In the autumn of 1910, 6 men, in addition to Aldrich, went out to shoot ducks. That is to say, they told the world that was their purpose. Mr. Warburg, who was of the number, gives an amusing account of his feelings when he boarded a private car in Jersey City, bringing with him all the accoutrements of a duck shooter. The joke was in the fact that he had never shot a duck in his life and had no intention of shooting any. The duck shoot was a blind. Stevenson continues with a description of the encounter at Brunswick Station. He tells us that, shortly after they arrived, the station master walked into the private car and shocked them by his apparent knowledge of the identities of everyone on board. To make matters even worse, he said that a group of reporters were waiting outside. Davison took charge. "Come outside, old man," he said, "and I will tell you a story." No one claims to know what story was told standing on the railroad ties that morning, but a few moments later Davison returned with a broad smile on his face. "It's all right," he said reassuringly. "They won't give us away." Stevenson continues, "The rest is silence." The reporters dispersed, and the secret of the strange journey was not divulged. No one asked him how he managed it, and he did not volunteer the information. In the February 9th, 1935 issue of the Saturday Evening Post, an article appeared written by Frank Vanderlip. In it he said, "Despite my views about the value to society of greater publicity for the affairs of corporations, there was an occasion, near the close of 1910, when I was as secretive, indeed as furtive, as any conspirator. I do not feel it is any exaggeration to speak of our secret expedition to Jekyll Island as the occasion of the actual conception of what eventually became the Federal Reserve System. We were told to leave our last names behind us. We were told, further, that we should avoid dining together on the night of our departure. We were instructed to come one at a time and as unobtrusively as possible to the railroad terminal on the New Jersey littoral of the Hudson, where Senator Aldrich's private car would be in readiness, attached to the rear end of a train for the South. Once aboard the private car, we began to observe the taboo that had been fixed on last names. We addressed one another as Ben Paul, Nelson, Abe. It is Abraham Piatt Andrew. Davison and I adopted even deeper disguises, abandoning our first names. On the theory that we were always right, he became Wilbur and I became Orville, after those two aviation pioneers, the Wright brothers. The servants and train crew may have known the identities of one or two of us, but they did not know all, and it was the names of all printed together that would have made our mysterious journey significant in Washington, in Wall Street, even in London. Discovery, we knew, simply must not happen, or else all our time and effort would be wasted. If it were to be exposed publicly that our particular group had got together and written a banking bill, that bill would have no chance whatever of passage by Congress. The structure was pure cartel. The composition of the Jekyll Island meeting was a classic example of cartel structure. A cartel is a group of independent businesses which join together to coordinate the production, pricing, or marketing of their members. The purpose of a cartel is to reduce competition and thereby increase profitability. This is accomplished through a shared monopoly over their industry, which forces the public to pay higher prices for their goods or services than would be otherwise required under free enterprise competition. Here were representatives of the world's leading banking consortia: Morgan, Rockefeller, Rothschild, Warburg, and Kuhn-Loeb. They were often competitors, and there is little doubt that there was considerable distrust between them and skillful maneuvering for favored position in any agreement. But they were driven together by one overriding desire to fight their common enemy. The enemy was competition. In 1910, the number of banks in the United States was growing at a phenomenal rate. In fact, it had more than doubled to over 20,000 in just the previous 10 years. Furthermore, most of them were springing up in the South and West, causing the New York banks to suffer a steady decline of market share. Almost all banks in the 1880s were national banks, which means they were chartered by the federal government. Generally, they were located in the big cities and were allowed by law to issue their own currency in the form of banknotes. Even as early as 1896, however, the number of non-national banks had grown to 61%, and they already held 54% of the country's total banking deposits. By 1913, when the Federal Reserve Act was passed, those numbers were 71% non-national banks holding 57% of the deposits. In the eyes of those duck hunters from New York, this was a trend that simply had to be reversed. Competition also was coming from a new trend in industry to finance future growth out of profits rather than from borrowed capital. This was the outgrowth of free market interest rates, which set a realistic balance between debt and thrift. Rates were low enough to attract serious borrowers who were confident of the success of their business ventures and of their ability to repay, but they were high enough to discourage loans for frivolous ventures or those for which there were alternative sources of funding. For example, one's own capital. That balance between debt and thrift was the result of a limited money supply. Banks could create loans in excess of their actual deposits, as we shall see, but there was a limit to that process. And that limit was ultimately determined by the supply of gold they held. Consequently, between 1900 and 1910, 70% of the funding for American corporate growth was generated internally, making industry increasingly independent of the banks. Point one, even the federal government was becoming thrifty. It had a growing stockpile of gold, was systematically redeeming the greenbacks, which had been issued during the Civil War, and was rapidly reducing the national debt. Here was another trend that had to be halted. What the bankers wanted, and what many businessmen wanted also, was to intervene in the free market and tip the balance of interest rates downward to favor debt over thrift. To accomplish this, the money supply simply had to be disconnected from gold and made more plentiful or, as they described it, more elastic. The specter of bank failure. The greatest threat, however, came not from rivals or private capital formation, but from the public at large in the form of what bankers call a run on the bank. This is because when banks accept a customer's deposit, they give in return a balance in his account. This is the equivalent of a promise to pay back the deposit anytime he wants. Likewise, when another customer borrows money from the bank, he also is given an account balance which usually is withdrawn immediately to satisfy the purpose of the loan. This creates a ticking time bomb because at that point, the bank has issued more promises to pay on demand than it has money in the vault. Even though the depositing customer thinks he can get his money anytime he wants, in reality, it has been given to the borrowing customer and no longer is available at the bank. The problem is compounded further by the fact that banks are allowed to loan even more money than they have received in deposit. The mechanism for accomplishing this seemingly impossible feat will be described in a later chapter, but it is a fact of modern banking that promises to pay often exceed savings deposits by a factor of 10 to 1. And because only about 3% of these accounts are actually retained in the vault in the form of cash, the rest having been put into even more loans and investments, the bank's promises exceed its ability to keep those promises by a factor of over 300 to 1.2, as long as only a small percentage of depositors request their money at one time. No one is the wiser. But if public confidence is shaken, and if more than a few percent attempt to withdraw their funds, the scheme is finally exposed. The bank cannot keep all its promises and is forced to close its doors. Bankruptcy usually follows in due course. Currency drains. The same result could happen, and prior to the Federal Reserve System, often did happen, even without depositors a run on the bank. Instead of withdrawing their funds at the teller's window, they simply wrote checks to purchase goods or services. People receiving those checks took them to a bank for deposit. If that bank happened to be the same one from which the check was drawn, then all was well, because it was not necessary to remove any real money from the vault. But if the holder of the check took it to another bank, it was quickly passed back to the issuing bank and settlement was demanded between banks. This is not a one-way street, however. While the downtown bank is demanding payment from the uptown bank, the uptown bank is also clearing checks and demanding payment for the downtown bank. As long as the money flow in both directions is equal, then everything can be handled with simple bookkeeping. But if the flow is not equal, then one of the banks will have to actually send money to the other to make up the difference. If the amount of money required exceeds a few percentage points of the bank's total deposits, the result is the same as a run on the bank by depositors. This demand of money by other banks rather than by depositors is called a currency drain. In 1910, the most common cause of a bank having to declare bankruptcy due to a currency drain was that it followed a loan policy that was more reckless than that of its competitors. More money was demanded from it because more money was loaned by it. It was dangerous enough to loan 90% of their customers' savings, keeping only $1 in reserve out of every 10, but that had proven to be adequate most of the time. Some banks, however, were tempted to walk even closer to the precipice. They pushed the ratio to 92%, 90-5%, 90-9%. After all, the way a bank makes money is to collect interest, and the only way to do that is to make loans. The more loans, the better. And so, there was a practice among some of the more reckless banks to loan up, as they call it, which was another way of saying to push down their reserve ratios. A banker's utopia. If all banks could be forced to issue loans in the same ratio to their reserves as other banks did, then, regardless of how small that ratio was, the amount of checks to be cleared between them would balance in the long run. No major currency drains would ever occur. The entire banking industry might collapse under such a system, but not individual banks, at least not those that were part of the cartel. All would walk the same distance from the edge, regardless of how close it was. Under such uniformity, no individual bank could be blamed for failure to meet its obligations. The blame could be shifted, instead, to the economy or government policy or interest rates or trade deficits or the exchange value of the dollar or even to the capitalist system itself. But in 1910, such a banker's utopia had not yet been created. If the downtown bank began to loan at a greater ratio to its reserves than its competitors, the amount of checks which would come back to it for payment also would be greater. Thus, the bank which pursued a more reckless lending policy had to draw against its reserves in order to make payments to the more conservative banks, and, when those funds were exhausted, it usually was forced into bankruptcy. Historian John Klein tells us that the financial panics of 1873, 1884, 1893, and 1907 were in large part an outgrowth of reserve pyramiding and excessive deposit creation by reserve city banks. These panics were triggered by the currency drains that took place in periods of relative prosperity when banks were loaned up. In other words, the panics and resulting bank failures were caused not by negative factors in the economy, but by currency drains on the banks which were loaned up to the point where they had practically no reserves at all. The banks did not fail because the system was weak. The system failed because the banks were weak. This was another common problem that brought these 7 men over 1,000 miles to a tiny island off the shore of Georgia. Each was a potentially fierce competitor, but uppermost in their minds are the so-called panics and the very real 1,748 bank failures of the preceding 2 decades. Somehow, they had to join forces. A method had to be devised to enable them to continue to make more promises to pay on demand than they could keep. To do this, they had to find a way to force all banks to walk the same distance from the edge, and when the inevitable disasters happened, to shift public blame away from themselves. By making it appear to be a problem of the national economy rather than a private banking practice, the door then could be opened for the use of tax money rather than their own funds for paying off the losses. Here, then, were the main challenges that faced that tiny but powerful group assembled on Jekyll Island. 1. How to stop the growing influence of small, rival banks, and 2. Ensure that control over the nation's financial resources would remain in the hands of those present. 2. How to make the money supply more elastic in order to reverse the trend of private capital formation and to recapture the industrial loan market. 3. How to pool the meager reserves of the nation's banks into one large reserve so that all banks will be motivated to follow the same loan-to-deposit ratios. This would protect at least some of them from currency drains and bank runs. For should this lead eventually to the collapse of the whole banking system, then how to shift the losses from the owners of the banks to the taxpayers. The cartel adopts a name. Everyone knew that the solution to all these problems was a cartel mechanism that had been devised and already put in a similar operation in Europe. As with all cartels, it had to be created by legislation and sustained by the power of government under the deception of protecting the consumer. The most important task before them, therefore, can be stated as objective number 5. 5. How to convince Congress that the scheme was a measure to protect the public. The task was a delicate one. The American people did not like the concept of cartel. The idea of business enterprises joining together to fix prices and prevent competition was alien to the free enterprise system. It could never be sold to the voters. But if the word cartel was not used, if the venture could be described with words which are emotionally neutral perhaps, even alluring, then half the battle would be won. The first decision, therefore, was to follow the practice adopted in Europe. Henceforth, the cartel would operate as a central bank. And even that was to be but a generic expression. For purposes of public relations and legislation, they would devise a name that would avoid the word bank altogether and which would conjure the image of the federal government itself. Furthermore, to create the impression that there would be no concentration of power, they would establish regional branches of the cartel and make that a main selling point. Stevenson tells us, Aldrich entered this discussion at Jekyll Island, an ardent convert to the idea of a central bank. His desire was to transplant the system of one of the great European banks, say the Bank of England, bodily to America. But political expediency required that such plans be concealed from the public. As John Kenneth Galbraith explained it, it was Aldrich's thought to outflank the opposition by having not one central bank, but many. And the word bank would itself be avoided. With the exception of Aldrich, all of those present were bankers, but only one was an expert on the European model of a central bank. Because of this knowledge, Paul Warburg became the dominant and guiding mind throughout all of the discussions. Even a casual perusal of the literature on the creation of the Federal Reserve System is sufficient to find that he was, indeed, the cartel's mastermind. Galbraith says, Warburg has, with some justice, been called the father of the system. Professor Edwin Seligman, a member of the international banking family of J. and W. Seligman and head of the Department of Economics at Columbia University, writes that, in its fundamental features, the Federal Reserve Act is the work of Mr. Warburg more than any other man in the country. The real Daddy Warbucks. Paul Moritz Warburg was a leading member of the investment banking firm of M.M. Warburg and Company of Hamburg, Germany, and Amsterdam, the Netherlands. He had come to the United States only 9 years previously. Soon after arrival, however, and with funding provided mostly by the Rothschild Group, he and his brother Felix had been able to buy partnerships in the New York investment banking firm of Kuhn, Loeb and Company, while continuing as partners in Warburg of Hamburg. Within 20 years, Paul would become one of the wealthiest men in America with an unchallenged domination over the country's railroad system. At this distance in history, it is difficult to appreciate the importance of this man. But some understanding may be had from the fact that the legendary character Daddy Warbucks in the comic strip Little Orphan Annie was a contemporary commentary on the presumed benevolence of Paul Warburg and the almost magic ability to accomplish good through the power of his unlimited wealth. A third brother, Max Warburg, was the financial advisor of the Kaiser and became director of the Reichsbank in Germany. This was, of course, a central bank, and it was one of the cartel models used in the construction of the Federal Reserve System. The Reichsbank, incidentally, a few years later would create the massive hyperinflation that occurred in Germany, wiping out the middle class and the entire German economy as well. Paul Warburg soon became well known on Wall Street as a persuasive advocate for a central bank in America. 3 years before the Jekyll Island meeting, he had published several pamphlets. One was entitled Defects and Needs of Our Banking System, and the other was a plan for a modified central bank. These attracted wide attention in both financial and academic circles and set the intellectual climate for all future discussions regarding banking legislation. In these treatises, Warburg complained that the American monetary system was crippled by its dependency on gold and government bonds, both of which were in limited supply. What America needed, he argued, was an elastic money supply that could be expanded and contracted to accommodate the fluctuating needs of commerce. The solution, he said, was to follow the German example whereby banks could create currency solely on the basis of commercial paper, which is banker language for IOUs from corporations. Warburg was tireless in his efforts. He was a featured speaker before scores of influential audiences and wrote a steady stream of published articles on the subject. In March of that year, for example, the New York Times published an 11-part series written by Warburg explaining and expounding what he called the Reserve Bank of the United States. The message was plain for those who understood. Most of Warburg's writing and lecturing on this topic was eyewash for the public. To cover the fact that a central bank is merely a cartel which has been legalized, its proponents had to lay down a thick smoke screen of technical jargon, focusing always on how it would supposedly benefit commerce, the public, and the nation, how it would lower interest rates, provide funding for needed industrial projects, and prevent panics in the economy. There was not the slightest glimmer that, underneath it all, was a master plan which was designed from top to bottom to serve private interests at the expense of the public. This was, nevertheless, the cold reality, and the more perceptive bankers were well aware of it. In an address before the American Bankers Association the following year, Aldrich laid it out for anyone who was really listening to the meaning of his words. He said, "The organization proposed is not a bank, but a cooperative union of all the banks of the country for definite purposes." Precisely, a union of banks. 2 years later, in a speech before that same group of bankers, Barton Hepburn of Chase National Bank was even more candid. He said, "The measure recognizes and adopts the principles of a central bank. Indeed, if it works out as the sponsors of the law hope, it will make all incorporated banks together joint owners of a central dominating power. And That is about as good a definition of a cartel as one is likely to find. In 1914, 1 year after the Federal Reserve Act was passed into law, Senator Aldrich could afford to be less guarded in his remarks. In an article published in July of that year in a magazine called The Independent, he boasted, "Before the passage of this act, the New York bankers could only dominate the reserves of New York. Now we are able to dominate the bank reserves of the entire country." Myth accepted as history. The accepted version of history is that the Federal Reserve was created to stabilize our economy. One of the most widely used textbooks on this subject says, it sprang from the panic of 1907 with its alarming epidemic of bank failures. The country was fed up once and for all with the anarchy of unstable private banking. Even the most naive student must sense a grave contradiction between this cherished view and the system's actual performance. Since its inception, it has presided over the crashes of 1921 and 1929, the Great Depression of 29 to 39, recessions in 53, 57, 69, 75, and 81, a stock market Black Monday in 87, and a 1,000% inflation which has destroyed 90% of the dollar's purchasing power. Let's be more specific on that last point. By 1990, an annual income of $10,000 was required to buy what took only $1,000 in. 1914, that incredible loss in value was quietly transferred to the federal government in the form of hidden taxation, and the Federal Reserve System was the mechanism by which it was accomplished. Actions have consequences. The consequences of wealth confiscation by the Federal Reserve mechanism are now upon us. In the current decade, corporate debt is soaring. Personal debt is greater than ever. Both business and personal bankruptcies are at an all-time high. Banks and savings and loan associations are failing in larger numbers than ever before. Interest on the national debt is consuming half of our tax dollars. Heavy industry has been largely replaced by overseas competitors. We are facing an international trade deficit for the first time in our history. 75% of downtown Los Angeles and other metropolitan areas is now owned by foreigners, and over half of our nation is in a state of economic recession. First reason to abolish the system. That is the scorecard 80 years after the Federal Reserve was created supposedly to stabilize our economy. There can be no argument that the system has failed in its stated objectives. Furthermore, after all this time, after repeated changes in personnel, after operating under both political parties, after numerous experiments in monetary philosophy, after almost 100 revisions to its charter, and after the development of countless new formulas and techniques, there has been more than ample opportunity to work out mere procedural flaws. It is not unreasonable to conclude, therefore, that the system has failed not because it needs a new set of rules or more intelligent directors, but because it is incapable of achieving its stated objectives. If an institution is incapable of achieving its objectives, there is no reason to preserve it, unless it can be altered in some way to change its capability. That leads to the question, why is the system incapable of achieving its stated objectives? The painful answer is, those were never its true objectives. When one realizes the circumstances under which it was created, when one contemplates the identities of those who authored it, and when one studies its actual performance over the years, it becomes obvious that the system is merely a cartel with a government facade. There is no doubt that those who run it are motivated to maintain full employment, high productivity, low inflation, and a generally sound economy. They are not interested in killing the goose that lays such beautiful golden eggs. But when there is a conflict between the public interest and the private needs of the cartel, a conflict that arises almost daily, the public will be sacrificed. That is the nature of the beast. It is foolish to expect a cartel to act in any other way. This view is not encouraged by establishment institutions and publishers. It has become their apparent mission to convince the American people that the system is not intrinsically flawed. It merely has been in the hands of bumbling oafs. For example, William Grider was a former assistant managing editor for the Washington Post. His book, Secrets of the Temple, was published in 1987 by Simon & Schuster. It was critical of the Federal Reserve because of its failures, But according to Grider, these are not caused by any defect in the system itself, but merely because the economic factors are so complicated that the good men who have struggled to make the system work have just not yet been able to figure it all out. But don't worry, folks, they're working on it. That is exactly the kind of powder puff criticism which is acceptable in our mainstream media. Yet, Grider's own research points to an entirely different interpretation. Speaking of the system's origin, he says, as new companies prospered without Wall Street, so did the new regional banks that handled their funds. New York's concentrated share of bank deposits was still huge, about half the nation's total, but it was declining steadily. Wall Street was still the biggest kid on the block, but less and less able to bully the others. This trend was a crucial fact of history, a misunderstood reality that completely alters the political meaning of the reform legislation that created the Federal Reserve. At the time, the conventional wisdom in Congress, widely shared and sincerely espoused by progressive reformers, was that a government institution would finally harness the money trust, disarm its powers, and establish broad democratic control over money and credit. The results were nearly the opposite. The money reforms enacted in 1913, in fact, helped to preserve the status quo, to stabilize the old order. Money center bankers would not only gain dominance over the new central bank, but would also enjoy new insulation against instability and their own decline. Once the Fed was in operation, the steady diffusion of financial power halted. Wall Street maintained its dominant position and even enhanced it. Anthony Sutton, former research fellow at the Hoover Institution for War, Revolution, and Peace, and also professor of economics at California State University, Los Angeles, provides a somewhat deeper analysis. He writes, Warburg's revolutionary plan to get American society to go to work for Wall Street was astonishingly simple. Even today, academic theoreticians cover their blackboards with meaningless equations, and the general public struggles in bewildered confusion with inflation and the coming credit collapse, while the quite simple explanation of the problem goes undiscussed and almost entirely uncomprehended. The Federal Reserve System is a legal private monopoly of the money supply operated for the benefit of the few under the guise of protecting and promoting the public interest. The real significance of the journey to Jekyll Island and the creature that was hatched there was inadvertently summarized by the words of Paul Warburg's admiring biographer, Harold Kellock. Poem. Warburg is probably the mildest-mannered man that ever personally conducted a revolution. It was a bloodless revolution. He did not attempt to rouse the populace to arms. He stepped forth armed simply with an idea, and he conquered. That's the amazing thing. A shy, sensitive man, he imposed his idea on a nation of 100 million people. Point 2. Summary. The basic plan for the Federal Reserve System was drafted at a secret meeting held in November of 1910 at the private resort of J.P. Morgan on Jekyll Island off the coast of Georgia. Those who attended represented the great financial institutions of Wall Street and, indirectly, Europe as well. The reason for secrecy was simple. Had it been known that rival factions of the banking community had joined together, the public would have been alerted to the possibility that the bankers were plotting an agreement in restraint of trade, which, of course, is exactly what they were doing. What emerged was a cartel agreement with 5 objectives. Stop the growing competition from the nation's newer banks. Obtain a franchise to create money out of nothing for the purpose of lending. Get control of the reserves of all banks so that the more reckless ones would not be exposed to currency drains and bank runs. Get the taxpayer to pick up the cartel's inevitable losses. And convince Congress that the purpose was to protect the public. It was realized that the bankers would have to become partners with the politicians and that the structure of the cartel would have to be a central bank. The record shows that the Fed has failed to achieve its stated objectives. That is because those were never its true goals. As a banking cartel, and in terms of the 5 objectives stated above, it has been an unqualified success. The 7 men who attended the secret meeting on Jekyll Island, where the Federal Reserve System was conceived, represented an estimated 1/4 of the total wealth of the entire world. They were 1. Nelson W. Aldrich, Republican whip in the Senate, chairman of the National Monetary Commission, father-in-law to John D. Rockefeller, Jr. 2. Henry P. Davison, Sr., partner of J.P. Morgan Company. 3. Charles D. Norton, president of First National Bank of New York. 4a. Piatt Andrew, assistant secretary of the Treasury. 5. Frank A. Vanderlip, president of the National City Bank of New York, representing William Rockefeller. 6. Benjamin Strong, head of J.P. Morgan's Bankers Trust Company, later to become head of the system. 7. Paul M. Warburg, a partner in Kuhn, Loeb and Company, representing the Rothschilds and Warburgs in Europe. Chapter 2. The name of the game is Bailout. The analogy of a spectator sporting event as a means of explaining the rules by which taxpayers are required to pick up the cost of bailing out the banks when their loans go sour. It was stated in the previous chapter that the Jekyll Island group, which conceived the Federal Reserve System, actually created a national cartel which was dominated by the larger banks. It was also stated that a primary objective of that cartel was to involve the federal government as an agent for shifting the inevitable losses from the owners of those banks to the taxpayers. That, of course, is one of the more controversial assertions made in this book. Yet, there is little room for any other interpretation when one confronts the massive evidence of history since the system was created. Let us, therefore, take another leap through time. Having jumped to the year 1910 to begin this story, let us now return to the present era. To understand how banking losses are shifted to the taxpayers, it is first necessary to know a little bit about how the scheme was designed to work. There are certain procedures and formulas which must be understood, or else the entire process seems like chaos. It is as though we had been isolated all our lives on a South Sea island with no knowledge of the outside world. Imagine what it would then be like the first time we traveled to the mainland and witnessed a game of professional football. We would stare with incredulity at men dressed like aliens from another planet, throwing their bodies against each other, tossing a funny-shaped object back and forth, fighting over it as though it were of great value, yet occasionally kicking it out of the area as though it were worthless and despised, chasing each other, knocking each other to the ground, and then walking away to regroup for another surge. All this with tens of thousands of spectators riotously shouting in unison for no apparent reason at all, without a basic understanding that this was a game and without knowledge of the rules of that game. The event would appear as total chaos and universal madness. The operation of our monetary system through the Federal Reserve has much in common with professional football. First, there are certain plays that are repeated over and over again with only minor variations to suit the special circumstances. Second, there are definite rules which the players follow with great precision. Third, there is a clear objective to the game which is uppermost in the minds of the players. And fourth, if the spectators are not familiar with that objective, and if they do not understand the rules, they will never comprehend what is going on, which, as far as monetary matters is concerned, is the common state of the vast majority of Americans today. Let us, therefore, attempt to spell out in plain language what that objective is and how the players expect to achieve it. To demystify the process, we shall present an overview first. After the concepts are clarified, we then shall follow up with actual examples taken from the recent past. The name of the game is Bailout. As stated previously, the objective of this game is to shift the inevitable losses from the owners of the larger banks to the taxpayers. The procedure by which this is accomplished is as follows. Rules of the game. The game begins when the Federal Reserve System allows commercial banks to create checkbook money out of nothing. Details regarding how this incredible feat is accomplished are given in Chapter 10, entitled The Mandrake Mechanism. The banks derive profit from this easy money, not by spending it, but by lending it to others and collecting interest. When such a loan is placed on the bank's books, it is shown as an asset because it is earning interest and, presumably, someday will be paid back. At the same time, an equal entry is made on the liability side of the ledger. That is because the newly created checkbook money now is in circulation, and most of it will end up in other banks, which will return the canceled checks to the issuing bank for payment. Individuals may also bring some of this checkbook money back to the bank and request cash. The issuing bank, therefore, has a potential money payout liability equal to the amount of the loan asset. When a borrower cannot repay and there are no assets which can be taken to compensate, the bank must write off that loan as a loss. However, since most of the money originally was created out of nothing and cost the bank nothing except bookkeeping overhead, there is little of tangible value that is actual lost. It is primarily a bookkeeping entry. A bookkeeping loss can still be undesirable to a bank because it causes the loan to be removed from the ledger as an asset without a reduction in liabilities. The difference must come from the equity of IHOs who own the bank. In other words, the loan asset is removed, but the money liability remains. The original checkbook money is still circulating out there even though the borrower cannot repay, and the issuing bank still has the obligation to redeem those checks. The only way to do this and balance the books once again is to draw upon the capital which was invested by the bank stockholders or to deduct the loss from the bank's current profits. In either case, the owners of the bank lose an amount equal to the value of the defaulted loan. So, to them, the loss becomes very real. If the bank is forced to write off a large amount of bad loans, the amount could exceed the entire value of the owner's equity. When that happens, the game is over and the bank is insolvent. This concern would be sufficient to motivate most bankers to be very conservative in their loan policy. And in fact, most of them do act with great caution when dealing with individuals and small businesses. But the Federal Reserve System, the Federal Deposit Insurance Corporation, and the Federal Deposit Loan Corporation now guarantee that massive loans made to large corporations and to other governments will not be allowed to fall entirely upon the bank's owners should those loans go into default. This is done under the argument that if these corporations or banks are allowed to fail, the nation would suffer from vast unemployment and economic disruption. More on that in a moment. The perpetual debt play. The end result of this policy is that the banks have little motive to be cautious and are protected against the effect of their own folly. The larger the loan, the better it is, because it will produce the greatest amount of profit with the least amount of effort. A single loan to a third-world country netting hundreds of millions of dollars in annual interest is just as easy to process, if not easier, than a loan for $50,000 to a local merchant on a shopping mall. If the interest is paid, it's gravy time. If the loan defaults, the federal government will protect the public and, through various mechanisms described shortly, will make sure that the banks continue to receive their interest. The individual and the small businessman find it increasingly difficult to borrow money at reasonable rates because the banks can make more money on loans to the corporate giants and to foreign governments. Also, the bigger loans are safer for the banks because the government will make them good even if they default. There are no such guarantees for the small loans. The public will not swallow the line that bailing out the little guy is necessary to save the system. The dollar amounts are too small. Only when the figures become mind-boggling does the ploy become plausible. It is important to remember that banks do not really want to have their loans repaid, except as evidence of the dependability of the borrower. They make a profit from interest on the loan, not repayment of the loan. If a loan is paid off, the bank merely has to find another borrower, and that could be an expensive nuisance. It is much better to have the existing borrower pay only the interest and never make payments on the loan itself. That process is called rolling over the debt. One of the reasons banks prefer to lend to governments is that they do not expect those loans ever to be repaid. When Walter Wriston was chairman of the Citicorp Bank in 1982, he extolled the virtue of the action this way. If we had a Truth in Government Act comparable to the Truth in Advertising law, every note issued by the Treasury would be obliged to include a sentence stating, "This note will be redeemed with the proceeds from an identical note which will be sold to the public when this one comes due." When this activity is carried out in the United States, as it is weekly, it is described as a Treasury bill auction. But when basically the same process is conducted abroad in a foreign language, our news media usually speak of a country's rolling over its debts. The perception remains that some form of disaster is inevitable. It is not. To see why, it is only necessary to understand the basic facts of government borrowing. The first is that there are few recorded instances in history of government, any government actually getting out of debt. Certainly, in an era of $100 billion deficits, no one lending money to our government by buying a treasury bill expects that it will be paid at maturity in any way except by our governments selling a new bill of like amount. The debt rollover play. Since the system makes it profitable for banks to make large, unsound loans, that is the kind of loans which banks will make. Furthermore, it is predictable that most unsound loans eventually will go into default. When the borrower finally declares that he cannot pay, the bank responds by rolling over the loan. This often is managed to appear as a concession on the part of the bank, but in reality, it is a significant forward move toward the objective of perpetual interest. Eventually, the borrower comes to the point where he can no longer pay even the interest. Now the play becomes more complex. The bank does not want to lose the interest because that is its stream of income. But it cannot afford to allow the borrower to go into default either, because that would require a write-off which, in turn, could wipe out the owner's equity and put the bank out of business. So the bank's next move is to create additional money out of nothing and lend that to the borrower, so he will have enough to continue paying the interest, which by now must be paid on the original loan plus the additional loan as well. What looked like certain disaster suddenly is converted by a brilliant play into a major score. This not only maintains the old loan on the books as an asset, it actually increases the apparent size of that asset and also results in higher interest payments, thus greater profit to the bank. The up-the-ante play. Sooner or later, the borrower becomes restless. He is not interested in making interest payments with nothing left for himself. He comes to realize that he is merely working for the bank, and, once again, interest payments stop. The opposing teams go into a huddle to plan the next move, then rush to the scrimmage line where they hurl threatening innuendos at each other. The borrower simply will not pay. Collect if you can. The lender threatens to blackball the borrower, to see to it that he will never again be able to obtain a loan. Finally, a compromise is worked out. As before, the bank agrees to create still more money out of nothing and lend that to the borrower to cover the interest on both of the previous loans, but this time, they up the ante to provide still additional money for the borrower to spend on something other than interest. That is a perfect score. The borrower suddenly has a fresh supply of money for his purposes, plus enough to keep making those bothersome interest payments. The bank, on the other hand, now has still larger assets, higher interest income, and greater profits. One exciting game. The rescheduling play. The previous plays can be repeated several times until the reality finally dawns on the borrower that he is sinking deeper and deeper into the debt pit with no prospects of climbing out. This realization usually comes when the interest payments become so large they represent almost as much as the entire corporate earnings or the country's total tax base. This time around, rollovers with larger loans are rejected and default seems inevitable. But wait, what's this? The players are back at the scrimmage line. There is a great confrontation. Referees are called in. 2 shrill blasts from the horn tell us a score has been made for both sides. A voice over the public address system announces, "This loan has been rescheduled." Rescheduling usually means a combination of a lower interest rate and a longer period for repayment. The effect is primarily cosmetic. It reduces the monthly payment but extends the period further into the future. This makes the current burden to the borrower a little easier to carry, but it also makes repayment of the capital even more unlikely. It postpones the day of reckoning, but in the meantime, you guessed it, the loan remains as an asset, and the interest payments continue. The protect the public play. Eventually, the day of reckoning arrives. The borrower realizes he can never repay the capital and flatly refuses to pay interest on it. It is time for the final maneuver. According to the Banking Safety Digest, which specializes in rating the safety of America's banks and S&LS, most of the banks involved with problem loans are quite profitable businesses. Note that except for third-world loans, most of the large banks in the country are operating quite profitably. In contrast with the continually worsening S&L crisis, the bank's profitability has been the engine with which they have been working off, albeit slowly, their overseas debt. At last year's profitability levels, The banking industry could, in theory, buy out the entirety of their own Latin American loans within 2 years. The banks can absorb the losses of their bad loans to multinational corporations and foreign governments, but that is not according to the rules. It would be a major loss to the stockholders who would receive little or no dividends during the adjustment period, and any chief executive officer who embarked upon such a course would soon be looking for a new job. That this is not part of the game plan is evident by the fact that, while a small portion of the Latin American debt has been absorbed, the banks are continuing to make gigantic loans to governments in other parts of the world, particularly Africa, Red China, and Eastern European nations. For reasons which will be analyzed in Chapter 4, there is little hope that the performance of these loans will be different than those in Latin America. But the most important reason for not absorbing the losses is that there is a standard play that can still breathe life back into those dead loans and reactivate the bountiful income stream that flows from them. Here's how it works. The captains of both teams approach the referee and the game commissioner to request that the game be extended. The reason given is that this is in the interest of the public, the spectators who are having such a wonderful time and who will be sad to see the game ended. They request also that, while the spectators are in the stadium enjoying themselves, the parking lot attendants be ordered to quietly remove the hubcaps from every car. These can be sold to provide money for additional salaries for all the players, including the referee and, of course, the commissioner himself. That is only fair since they are now working overtime for the benefit of the spectators. When the deal is finally struck, the horn will blow 3 times, and a roar of joyous relief will sweep across the stadium. In a somewhat less recognizable form, the same play may look like this. The president of the lending bank and the finance officer of the defaulting corporation or government will join together and approach Congress. They will explain that the borrower has exhausted his ability to service the loan and, without assistance from the federal government, there will be dire consequences for the American people. Not only will there be unemployment and hardship at home, there will be massive disruptions in world markets. And since we are now so dependent on those markets, our exports will drop, foreign capital will dry up, and we will suffer greatly. What is needed, they will say, is for Congress to provide money to the borrower, either directly or indirectly, to allow him to continue to pay interest on the loan and to initiate new spending programs which will be so profitable he will soon be able to pay everyone back. As part of the proposal, the borrower will agree to accept the direction of a third-party referee in adopting an austerity program to make sure that none of the new money is wasted. The bank also will agree to write off a small part of the loan as a gesture of its willingness to share the burden. This move, of course, will have been foreseen from the very beginning of the game, and is a small step backward to achieve a giant stride forward. After all, the amount to be lost through the write-off was created out of nothing in the first place, and, without this final maneuver, the entirety would be written off. Furthermore, this modest write-down is dwarfed by the amount to be gained through restoration of the income stream. The guaranteed payment play. One of the standard variations of the final maneuver is for the government, not always to directly provide the funds, but to provide the credit for the funds. That means to guarantee future payments should the borrower again default. Once Congress agrees to this, the government becomes a co-signer to the loan, and the inevitable losses are finally lifted from the ledger of the bank and placed onto the backs of the American taxpayer. Money now begins to move into the banks through a complex system of federal agencies, international agencies, foreign aid, and direct subsidies. All of these mechanisms extract payments from the American people and channel them to the deadbeat borrowers who then send them to the banks to service their loans. Very little of this money actually comes from taxes. Almost all of it is generated by the Federal Reserve System. When this newly created money returns to the banks, it quickly moves out again into the economy where it mingles with and dilutes the value of the money already there. The result is the appearance of rising prices, but which, in reality, is a lowering of the value of the dollar. The American people have no idea they are paying the bill. They know that someone is stealing their hubcaps, but they think it is the greedy businessman who raises prices, or the selfish laborer who demands higher wages, or the unworthy farmer who demands too much for his crop, or the wealthy foreigner who bids up our prices. They do not realize that these groups also are victimized by a monetary system which is constantly being eroded in value by and through the Federal Reserve System. Public ignorance of how the game is really played was dramatically displayed during a recent Phil Donahue TV show. The topic was the savings and loan crisis and the billions of dollars that it would cost the taxpayer. A man from the audience rose and asked angrily, "Why can't the government pay for these debts instead of the taxpayer?" And the audience of several hundred people actually cheered in enthusiastic approval. Prosperity through insolvency. Since large corporate loans are often guaranteed by the federal government, one would think that the banks which make those loans would never have a problem. Yet, many of them still manage to bungle themselves into insolvency. As we shall see in a later section of this study, insolvency actually is inherent in the system itself, a system called fractional reserve banking. Nevertheless, a bank can operate quite nicely in a state of insolvency so long as its customers don't know it. Money is brought into being and transmuted from one imaginary form to another by mere entries on a ledger, and creative bookkeeping can always make the bottom line appear to balance. The problem arises when depositors decide, for whatever reason, to withdraw their money. Lo and behold, there isn't enough to go around, and when that happens, the cat is finally out of the bag. The bank must close its doors, and the depositors still waiting in line outside are just that, still waiting. The proper solution to this problem is to require the banks, like all other businesses, to honor their contracts. If they tell their customers that deposits are payable upon demand, then they should hold enough cash to make good on that promise, regardless of when the customers want it or how many of them want it. In other words, they should keep cash in the vault equal to 100% of their depositors' accounts. When we give our hat to the hat check girl and obtain a receipt for it, we don't expect her to rent it out while we eat dinner hoping she'll get it back, or one just like it, in time for our departure. We expect all the hats to remain there all the time, so there will be no question of getting ours back precisely when we want it. On the other hand, if the bank tells us it is going to lend our deposit to others so we can earn a little interest on it, then it should also tell us forthrightly that we cannot have our money back on demand. Why not? Because it is loaned out and not in the vault any longer. Customers who earn interest on their accounts should be told that they have time deposits, not demand deposits, because the bank will need a stated amount of time before it will be able to recover the money which was loaned out. None of this is difficult to understand, yet bank customers are seldom informed of it. They are told they can have their money anytime they want it, and they are paid interest as well. Even if they do not receive interest, the bank does, and this is how so many customer services can be offered at little or no direct cost. Occasionally, a 30-day or 60-day delay will be mentioned as a possibility, but that is greatly inadequate for deposits which have been transformed into 10, 20, or 30-year loans. The banks are simply playing the odds that everything will work out most of the time. We shall examine this issue in greater detail in a later section, but for now, it is sufficient to know that total disclosure is not how the banking game is played. The Federal Reserve System has legalized and institutionalized the dishonesty of issuing more hat checks than there are hats, and it has devised complex methods of disguising this practice as a perfectly proper and normal feature of banking. Students of finance are told that there simply is no other way for the system to function. Once that premise is accepted, then all attention can be focused not on the inherent fraud, but on ways and means to live with it and make it as painless as possible. Based on the assumption that only a small percentage of the depositors will ever want to withdraw their money at the same time, the Federal Reserve allows the nation's commercial banks to operate with an incredibly thin layer of cash to cover their promises to pay on demand. When a bank runs out of money and is unable to keep that promise, the system then acts as a lender of last resort. That is banker language, meaning it stands ready to create money out of nothing and immediately lend it to any bank in trouble. Details on how that is accomplished are in Chapter 8, but there are practical limits to just how far that process can work. Even the Fed will not support a bank that has gotten itself so deeply in the hole it has no realistic chance of digging out. When a bank's bookkeeping assets finally become less than its liabilities, the rules of the game call for transferring the losses to the depositors themselves. This means they pay twice, once as taxpayers and again as depositors. The mechanism by which this is accomplished is called the Federal Deposit Insurance Corporation, the FDIC play. The FDIC guarantees that every insured deposit will be paid back regardless of the financial condition of the bank. The money to do this comes out of a special fund, which is derived from assessments against participating banks. The banks, of course, do not pay this assessment. As with all other expenses, the bulk of the cost ultimately is passed on to their customers in the form of higher service fees and lower interest rates on deposits. The FDIC is usually described as an insurance fund, but that is deceptive advertising at its worst. One of the primary conditions of insurance is that it must avoid what underwriters call moral hazard. That is a situation in which the policyholder has little incentive to avoid or prevent that which is being insured against. When moral hazard is present, it is normal for people to become careless, and the likelihood increases that what is being insured against will actually happen. An example would be a government program forcing everyone to pay an equal amount into a fund to protect them from the expense of parking fines. One hesitates even to mention this absurd proposition lest some enterprising politician should decide to put it on the ballot. Therefore, let us hasten to point out that if such a numbskull plan were adopted, two things would happen. One, just about everyone soon would be getting parking tickets, and two, since there now would be so many of them, the taxes to pay for those tickets would greatly exceed the previous cost of paying them without the so-called protection. The FDIC operates exactly in this fashion. Depositors are told their insured accounts are protected in the event their bank should become insolvent. To pay for this protection, each bank is assessed a specified percentage of its total deposits. That percentage is the same for all banks regardless of their previous record or how risky their loans. Under such conditions, it does not pay to be cautious. The banks making reckless loans earn a higher rate of interest than those making conservative loans. They also are far more likely to collect from the fund, yet they pay not 1 cent more. Conservative banks are penalized and gradually become motivated to make more risky loans to keep up with their competitors and to get their fair share of the fund's protection. Moral hazard, therefore, is built right into the system. As with protection against parking tickets, the FDIC increases the likelihood that what is being insured against will actually happen. It is not a solution to the problem, it is part of the problem. Real insurance would be a blessing. A true deposit insurance program, which was totally voluntary and which geared its rates to the actual risks, would be a blessing. Banks with solid loans on their books would be able to obtain protection for their depositors at reasonable rates, because the chances of the insurance company having to pay would be small. Banks with unsound loans, however, would have to pay much higher rates or possibly would not be able to obtain coverage at any price. Depositors, therefore, would know instantly, without need to investigate further, that a bank without insurance is not a place where they want to put their money. In order to attract deposits, banks would have to have insurance. In order to have insurance at rates they could afford, they would have to demonstrate to the insurance company that their financial affairs are in good order. Consequently, banks which failed to meet the minimum standards of sound business practice would soon have no customers and would be forced out of business. A voluntary, private insurance program would act as a powerful regulator of the entire banking industry far more effectively and honestly than any political scheme ever could. Unfortunately, such is not the banking world of today. The FDIC protection is not insurance in any sense of the word. It is merely part of a political scheme to bail out the most influential members of the banking cartel when they get into financial difficulty. As we have already seen, the first line of defense in this scheme is to have large defaulted loans restored to life by a congressional pledge of tax dollars. If that should fail and the bank can no longer conceal its insolvency through creative bookkeeping, it is almost certain that anxious depositors will soon line up to withdraw their money, which the bank does not have. The second line of defense, therefore, is to have the FDIC step in and make those payments for them. Bankers, of course, do not want this to happen. It is a last resort. If the bank is rescued in this fashion, management is fired, and what is left of the business usually is absorbed by another bank. Furthermore, the value of the stock will plummet, but this will affect the small stockholders only. Those with controlling interest and those in management know long in advance of the pending catastrophe and are able to sell the bulk of their shares while the price is still high. The people who create the problem seldom suffer the economic consequences of their actions. The FDIC will never be adequately funded. The FDIC never will have enough money to cover its potential liability for the entire banking system. If that amount were in existence, it could be held by the banks themselves, and an insurance fund would not even be necessary. Instead, the FDIC operates on the same assumption as the banks, that only a small percentage will ever need money at the same time. So the amount held in reserve is never more than a few percentage points of the total liability. Typically, the FDIC holds about $1.20 for every $100 or covered deposits. At the time of this writing, however, that figure had slipped to only 70 cents and was still dropping. That means that the financial exposure is about 99.3% larger than the safety net, which is supposed to catch it. The failure of just one or two large banks in the system could completely wipe out the entire fund. And it gets even worse. Although the ledger may show that so many millions or billions are in the fund, that also is but creative bookkeeping. By law, the money collected from bank assessments must be invested in treasury bonds, which means it is loaned to the government and spent immediately by Congress. In the final stage of this process, therefore, the FDIC itself runs out of money and turns first to the Treasury, then to Congress for help. This step, of course, is an act of final desperation, but it is usually presented in the media as though it were a sign of the system's great strength. U.S. News and World Report blandly describes it this way. Should the agencies need more money yet, Congress has pledged the full faith and credit of the federal government. Gosh, gee whiz. Isn't that wonderful? It sort of makes one feel rosy all over to know that the fund is so well secured. Let's see what full faith and credit of the federal government actually means. Congress, already deeply in debt, has no money either. It doesn't dare openly raise taxes for the shortfall, so it applies for an additional loan by offering still more treasury bonds for sale. The public picks up a portion of these IOUs, and the Federal Reserve buys the rest. If there is a monetary crisis at hand and the size of the loan is great, the Fed will pick up the entire issue. But the Fed has no money either. So it responds by creating out of nothing an amount of brand new money equal to the IOUs, and, through the magic of central banking, the FDIC is finally funded. This new money gushes into the banks where it is used to pay off the depositors. From there it floods through the economy, diluting the value of all money and causing prices to rise. The old paycheck doesn't buy as much anymore, so we learn to get along with a little bit less. But see, the bank's doors are open again, and all the depositors are happy until they return to their cars and discover the missing hubcaps. That is what is meant by the full faith and credit of the federal government. Summary: although national monetary events may appear mysterious and chaotic, they are governed by well-established rules which bankers and politicians rigidly follow. The central fact to understanding these events is that all the money in the banking system has been created out of nothing through the process of making loans. A defaulted loan, therefore, costs the bank little of tangible value, but it shows up on the ledger as a reduction in assets without a corresponding reduction in liabilities. If the bad loans exceed the size of the assets, the bank becomes technically insolvent and must dose its doors. The first rule of survival, therefore, is to avoid writing off large, bad loans, and if possible, to at least continue receiving interest payments on them. To accomplish that, the endangered loans are rolled over and increased in size. This provides the borrower with money to continue paying interest plus fresh funds for new spending. The basic problem is not solved, but it is postponed for a little while and made worse. The final solution on behalf of the banking cartel is to have the federal government guarantee payment of a loan should the borrower default in the future. This is accomplished by convincing Congress that not to do so would result in great damage to the economy and hardship for the people. From that point forward, the burden of the loan is removed from the bank's ledger and transferred to the taxpayer. Should this effort fail and the bank be forced into insolvency, the last resort is to use the FDIC to pay off the depositors. The FDIC is not insurance because the presence of moral hazard makes the thing it supposedly protects against more likely to happen. A portion of the FDIC funds are derived from assessments against the banks. Ultimately, however, they are paid by the depositors themselves. When these funds run out, the balance is provided by the Federal Reserve System in the form of freshly created new money. This floods through the economy, causing the appearance of rising prices, but which, in reality, is the lowering of the value of the dollar. The final cost of the bailout, therefore, is passed to the public in the form of a hidden tax called inflation. So much for the rules of the game. In the next chapter, we shall look at the scorecard of the actual play itself. Lucrative defense contracts at non-competitive bids. The banks were paid back. In 1975, New York City had reached the end of its credit rope. It had borrowed heavily to maintain an extravagant bureaucracy and a miniature welfare state. Congress was told that the public would be jeopardized if city services were curtailed and that America would be disgraced in the eyes of the world. So Congress authorized additional direct loans up to $2.3 billion, which more than doubled the size of the current debt. The banks continued to receive their interest. In 1978, Chrysler was on the verge of bankruptcy. Congress was informed that the public would suffer greatly if the company folded, and that it would be a blow to the American way if freedom of choice were reduced from 3 to 2 makes of automobiles. So Congress guaranteed up to $1.5 billion in new loans. The banks reduced part of their loans and exchanged another portion for preferred stock. News of the deal pushed up the market value of that stock and largely offset the loan write-off. The bank's previously uncollectible debt was converted into a government-backed, interest-bearing asset. In 1972, the Commonwealth Bank of Detroit, with $1.5 billion in assets, became insolvent. It had borrowed heavily from the Chase Manhattan Bank in New York to invest in high-risk and potentially high-profit ventures. Now that it was in trouble, so was Chase. The bankers went to Washington and told the FDIC the public must be protected from the great financial hardship that would follow if Commonwealth were allowed to close. So the FDIC pumped in a $60 million loan plus federal guarantees of repayment. Commonwealth was sold to an Arab consortium. Chase took a minor write-down, but converted most of its potential loss into government-backed assets. In 1979, the First Pennsylvania Bank of Philadelphia became insolvent. With assets in excess of $9 billion, it was 9 times the size of Commonwealth. It, too, had been an aggressive player in the 80s. Now the bankers in the Federal Reserve told the FDIC that the public must be protected from the calamity of a bank failure of this size, that the national economy was at stake, perhaps even the entire world. So the FDIC gave a $325 million loan, interest-free for the first year, and at half the market rate thereafter. The Federal Reserve offered money to other banks at a subsidized rate for the specific purpose of re-lending to First Penn. With that enticement, they advanced $175 million in immediate loans plus a $1 billion line of credit. In 1982, Chicago's Continental Illinois became insolvent. It was the nation's 7th largest bank with $42 billion in assets. The previous year, its profits had soared as a result of loans to high-risk business ventures and foreign governments. Although it had been the darling of market analysts, it quickly unraveled when its cash flow turned negative and overseas banks began to withdraw deposits. It was the world's first electronic bank run. Federal Reserve Chairman Volcker told the FDIC that it would be unthinkable to allow the world economy to be ruined by a bank failure of this magnitude. So, the FDIC assumed $4.5 billion in bad loans and, in return for the bailout, took 80% ownership of the bank in the form of stock. In effect, the bank was nationalized, but no one called it that. The United States government was now in the banking business. All of the money to accomplish these bailouts was made possible by the Federal Reserve System acting as the lender of last resort. That was one of the purposes for which it had been created. We must not forget that the phrase lender of last resort means that the money is created out of nothing, resulting in the confiscation of our nation's wealth through the hidden tax called inflation. Chapter 3. Protectors of the Public. The game called Bailout, as it actually has been applied to specific cases including Penn Central, Lockheed, New York City, Chrysler, Commonwealth Bank of Detroit, First Pennsylvania Bank, Continental Illinois, and others. In the previous chapter, we offered the whimsical analogy of a sporting event to clarify the maneuvers of monetary and political scientists to bail out those commercial banks, which comprise the Federal Reserve cartel. The danger in such an approach is that it could leave the impression the topic is frivolous. So, let us abandon the analogy and turn to reality. Now that we have studied the hypothetical rules of the game, it is time to check the scorecard of the actual play itself, and it will become obvious that this is no trivial matter. A good place to start is with the rescue of a consortium of banks which were holding the endangered loans of Penn Central Railroad. Penn Central. Penn Central was the nation's largest railroad with 96,000 employees and a payroll of $20 million a week. In 1970, it also became the nation's biggest bankruptcy. It was deeply in debt to just about every bank that was willing to lend it money, and that list included Chase Manhattan, Morgan Guaranty, Manufacturers Hanover, First National City, Chemical Bank, and Continental Illinois. Officers of the largest of those banks had been appointed to Penn Central's board of directors as a condition for obtaining funds, and they gradually had acquired control over the railroad's management. The banks also held large blocks of Penn Central stock in their trust departments. The arrangement was convenient in many ways, not the least of which was that the bankers sitting on the board of directors were privy to information long before the public received it, which would affect the market price of Penn Central stock. Chris Wells, in The Last Days of the Club, describes what happened. On May 21st, a month before the railroad went under, David Bevan, Penn Central's chief financial officer, privately informed representatives of the company's banking creditors that its financial condition was so weak it would have to postpone an attempt to raise $100 million in desperately needed operating funds through a bond issue. Instead, said Bevan, the railroad would seek some kind of government loan guarantee. In other words, unless the railroad could manage a federal bailout, it would have to close down. The following day, Chase Manhattan's trust department sold 134,300 shares of its Penn Central holdings. Before May 28th, when the public was informed of the postponement of the bond issue, Chase sold another 128,000 shares. David Rockefeller, the bank's chairman, vigorously denied Chase had acted on the basis of inside information. More to the point of this study is the fact that virtually all of the major management decisions which led to Penn Central's demise were made by or with the concurrence of its board of directors, which is to say by the banks that provided the loans. In other words, the bankers were not in trouble because of Penn Central's poor management. They were Penn Central's poor management. An investigation conducted in 1972 by Congressman Wright Patman, chairman of the House Banking and Currency Committee, revealed the following. The banks provided large loans for disastrous expansion and diversification projects. They loaned additional millions to the railroad so it could pay dividends to its stockholders. This created the false appearance of prosperity and artificially inflated the market price of its stock long enough to dump it on the unsuspecting public. Thus, the banker managers were able to engineer a three-way bonanza for themselves. They 1. Received dividends on essentially worthless stock, 2. Earned interest on the loans which provided the money to pay those dividends, and 3. Were able to unload 1.8 million shares of stock, after the dividends, of course, at unrealistically high prices showed that the company's top executives had disposed of their stock in this fashion at a personal savings of more than $1 million. Had the railroad been allowed to go into bankruptcy at that point and been forced to sell off its assets, the bankers still would have been protected. In any liquidation, debtors are paid off first, stockholders last. So the manipulators had dumped most of their stock while prices were relatively high. That is a common practice among corporate raiders who use borrowed funds to seize control of a company, bleed off its assets to other enterprises which they AFCO control, and then toss the debt-ridden, dying carcass upon the remaining stockholders, or, in this case, the taxpayers. The public be damned. In his letter of transmittal accompanying the staff report, Congressman Patman provided this summary. It was as though everyone was a part of a close-knit club in which Penn Central and its officers could obtain, with very few questions asked, loans for almost everything they desired, both for the company and for their own personal interests. Where the bankers sitting on the board asked practically no questions as to what was going on, simply allowing management to destroy the company, to invest in questionable activities, and to engage in some cases in illegal activities. These banks, in return, obtained most of the company's lucrative banking business. The attitude of everyone seemed to be, while the game was going on, that all these dealings were of benefit to every member of the club, and the railroad and the public be damned. The banking cartel, commonly called the Federal Reserve System, was created for exactly this kind of bailout. Arthur Burns, who was the Fed's chairman, would have preferred to provide a direct infusion of newly created money, but that was contrary to the rules at that time. In his own words, everything fell through. We couldn't lend it to them ourselves under the law. I worked on this thing in other ways. The company's cash crisis came to a head over a weekend, and in order to avoid having the corporation forced to file for bankruptcy on Monday morning, Burns called the homes of the heads of the Federal Reserve banks around the country and told them to get the word out immediately that the system was anxious to help. On Sunday, William Treiber, who was the first vice president of the New York branch of the Fed, contacted the chief executives of the 10 largest banks in New York and told them that the Fed's discount window would be wide open the next morning. Translated, that means the Federal Reserve System was prepared to create money out of nothing and then immediately loan it to the commercial banks so they, in turn, could multiply and re-lend it to Penn Central and other corporations, such as Chrysler, which were in similar straits. Point one furthermore, the rates at which the Fed would make these funds available would be low enough to compensate for the risk. Carrot peeking of what transpired on the following Monday, Burns boasted, I kept the board in session practically all day to change Regulation Q so that money could flow into CDs at the banks. Looking back at the event, Chris Wells approvingly describes it as what is by common consent the Fed's finest hour. Finest hour or not, the banks were not that interested in the proposition unless they could be assured the taxpayer would co-sign the loans and guarantee payment. So the action inevitably shifted back to Congress. Penn Central's executives, bankers, and union representatives came in droves to explain how the railroad's continued existence was in the best interest of the public, of the working man, of the economic system itself. The Navy Department spoke of protecting the nation's defense resources. Congress, of course, could not callously ignore these pressing needs of the nation. It responded by ordering a retroactive 13% pay raise for all union employees. After having added that burden to the railroad's cash drain and putting it even deeper into the hole, it then passed the Emergency Rail Services Act of 1970, authorizing $125 million in federal loan guarantees. Point three, none of this, of course, solved the basic problem, nor was it really intended to. Almost everyone knew that, eventually, the railroad would be nationalized, which is a euphemism for becoming a black hole into which tax dollars disappear. This came to pass with the creation of Amtrak in 1971 and Conrail in 1973. Amtrak took over the passenger services of Penn Central, and Conrail assumed operation of its freight services, along with 5 other eastern railroads. Conrail technically is a private corporation. When it was created, however, 85% of its stock was held by the government. The remainder was held by employees. Fortunately, the government stock was sold in a public offering in 1987. Amtrak continues under political control and operates at a loss. It is sustained by government subsidies, which is to say by taxpayers. In 1997, Congress dutifully gave it another $5.7 billion, and in 1998, liabilities exceeded assets by an estimated $14 billion. Conrail, on the other hand, since it was returned to the private sector, has experienced an impressive turnaround and has been running at a profit, paying taxes instead of consuming them. Lockheed. In that same year, 1970, the Lockheed Corporation, which was the nation's largest defense contractor, was teetering on the verge of bankruptcy. The Bank of America and several smaller banks had loaned $400 million to the Goliath, and they were not anxious to lose the bountiful interest income stream that flowed from that, nor did they wish to see such a large bookkeeping asset disappear from their ledgers. In due course, the banks joined forces with Lockheed's management, stockholders, and labor unions, and the group descended on Washington. Sympathetic politicians were told that if Lockheed were allowed to fail, 31,000 jobs would be lost, hundreds of subcontractors would go down, thousands of suppliers would be forced into bankruptcy, and national security would be seriously jeopardized. What the company needed was to borrow more money and lots of it. But because of its current financial predicament, no one was willing to lend. The answer? In the interest of protecting the economy and defending the nation, the government simply had to provide either the money or the credit. A bailout plan was quickly engineered by Treasury Secretary John B. Connally, which provided the credit. The government agreed to guarantee payment on an additional $250 million in loans, an amount which would put Lockheed 60% deeper into the debt hole than it had been before. But that made no difference now. Once the taxpayer had been made a co-signer to the account, the banks had no qualms about advancing the funds. The not-so-obvious part of this story is that the government now had a powerful motivation to make sure Lockheed would be awarded as many defense contracts as possible and that those contracts would be as profitable as possible. This would be an indirect method of paying off the banks with tax dollars, but doing so in such a way as not to arouse public indignation. Other defense contractors which had operated more efficiently would lose business, but that could not be proven. Furthermore, a slight increase in defense's expenditures would hardly be noticed. By 1977, Lockheed had, indeed, paid back this loan, and that fact was widely advertised as proof of the wisdom and skill of all the players, including the referee and the game commissioner. A deeper analysis, however, must include two facts. First, there is no evidence that Lockheed's operation became more cost-efficient during these years. Second, every bit of the money used to pay back the loans came from defense contracts which were awarded by the same government which was guaranteeing those loans. Under such an arrangement, it makes little difference if the loans were paid back or not. Taxpayers were doomed to pay the bill either way. New York City. Although the government of New York City is not a corporation in the usual sense, it functions as one in many respects, particularly regarding debt. In 1975, New York had reached the end of its credit rope and was unable even to make payroll. The cause was not mysterious. New York had long been a welfare state within itself, and success in city politics was traditionally achieved by lavish promises of benefits and subsidies for the poor. Not surprisingly, the city also was notorious for political corruption and bureaucratic fraud. Whereas the average large city employed 31 people per 1,000 residents, New York had 49. That's an excess of 58%. The salaries of these employees far outstripped those in private industry. While an X-ray technician in a private hospital earned $187 per week, a porter working for the city earned $203. The average bank teller earned $154 per week, but change maker on the city subway received $212. And municipal fringe benefits were fully twice as generous as those in private industry within the state. On top of this mountainous overhead were heaped additional costs for free college educations, subsidized housing, free medical care, and endless varieties of welfare programs. City taxes were greatly inadequate to cover the cost of this utopia. Even after transfer payments from Albany and Washington added state and federal taxes to the take, the outflow continued to exceed the inflow. There were now only three options: increase city taxes, reduce expenses, or go into debt. The choice was never in serious doubt. By 1975, New York had floated so many bonds it had saturated the market and could find no more lenders. $2 billion of this debt was held by a small group of banks, dominated by Chase Manhattan and Citicorp. When the payment of interest on these loans finally came to a halt, it was time for serious action. The bankers and the city fathers traveled down the coast to Washington and put their case before Congress. The largest city in the world could not be allowed to go bankrupt, they said. Essential services would be halted, and millions of people would be without garbage removal, without transportation, even without police protection. Starvation, disease, and crime would run rampant through the city. It would be a disgrace to America. David Rockefeller at Chase Manhattan persuaded his friend Helmut Schmidt, Chancellor of West Germany, to make a statement to the media that the disastrous situation in New York could trigger an international financial crisis. Congress, understandably, did not want to turn New York into a zone of anarchy, nor to disgrace America, nor to trigger a worldwide financial panic. So, in December of 1975, it passed a bill authorizing the Treasury to make direct loans to the city up to $2.3 billion, an amount which would more than double the size of its current debt to the banks. Interest payments on the old debt resumed immediately. All of this money, of course, would first have to be borrowed by Congress, which was itself deeply in debt. And most of it would be created directly or indirectly by the Federal Reserve System. That money would be taken from the taxpayer through the loss of purchasing power called inflation, but at least the banks could be repaid, which is the object of the game. There were several restrictions attached to this loan, including ARI austerity program and a systematic repayment schedule. None degree F these conditions was honored. New York City has continued to be a welfare utopia, and it is unlikely that it will ever get out of debt. Chrysler. By 1978, the Chrysler Corporation was on the verge of bankruptcy. It had rolled over its debt to the banks many times, and the game was nearing an end. In spite of an OPEC oil embargo which had pushed up the cost of gasoline, and in spite of the increasing popularity of small automobile imports, the company had continued to build the traditional gas hog. It was now saddled with a mammoth inventory of unsaleable cars and with a staggering debt which it had acquired to build those cars. The timing was doubly bad. America was also experiencing high interest rates which, coupled with fears of U.S. military involvement in Cambodia, had led to a slump in the stock market. Banks felt the credit crunch keenly, and, in one of those rare instances in modern history, the money makers themselves were scouring for money. Chrysler needed additional cash to stay in business. It was not interested in borrowing just enough to pay the interest on its existing loans. To make the game worth playing, it wanted over $1 billion in new capital. But, in the prevailing economic environment, the banks were hard-pressed to create anything close to that kind of money. Managers, bankers, and union leaders found common cause in Washington. If one of the largest corporations in America was allowed to fold, think of the hardship to thousands of employees and their families. Consider the damage to the economy as shock waves of unemployment move across the country. Tremble at the thought of lost competition in the automobile market, of only 2 major brands from which to choose instead of 3. Well, could anyone blame Congress for not wanting to plunge innocent families into poverty, nor to upend the national economy, nor to deny anyone their constitutional right to freedom of choice? So a bill was passed directing the Treasury to guarantee up to $1.5 billion in new loans to Chrysler. The banks agreed to write down $600 million of their old loans and to exchange an additional $700 million for preferred stock. Both of these moves were advertised as evidence the banks were taking a terrible loss but were willing to yield in order to save the nation. It should be noted, however, that the value of the stock which was exchanged for previously uncollectible debt rose drastically after the settlement was announced to the public. Furthermore, not only did interest payments resume on the balance of the old loans, but the banks now replaced the written-down portion with fresh loans, and these were far superior in quality because they were fully guaranteed by the taxpayers. So valuable was this guarantee that Chrysler, in spite of its previously poor debt performance, was able to obtain loans at 10.35% interest, while its more solvent competitor, Ford, had to pay 13.5%. Applying the difference of 3.15% to $1.5 billion, with a declining balance continuing for only 6 years, produces a savings in excess of $165 million. That is a modest estimate of the size of the federal subsidy. The real value was far greater because, without it, the corporation would have ceased to exist and the banks would have taken a loss of almost their entire loan exposure. Federal Deposit Insurance Corporation. It will be recalled from the previous chapter that the FDIC is not a true insurance program, and because it has been politicized, it embodies the principle of moral hazard, and it actually increases the likelihood that bank failures will occur. The FDIC has three options when bailing out an insolvent bank. The first is called a payoff. It involves simply paying off the insured depositors and then letting the bank fall to the mercy of the liquidators. This is the option usually chosen for small banks with no political clout. The second possibility is called a sell OFF, and it involves making arrangements for a larger bank to assume all the real assets and liabilities of the failing bank. Banking services are uninterrupted and, aside from a change in name, most customers are unaware of the transaction. This option is generally selected for small and medium banks. In both a payoff and a sell-off, the FDIC takes over the bad loans of the failed bank and supplies the money to pay back the insured depositors. The third option is called bailout, and this is the one which deserves our special attention. Irvine Sprague, a former director of the FDIC, explains, in a bailout, the bank does not close and everyone, insured or not, is fully protected. Such privileged treatment is accorded by FDIC only rarely to an elect few. That's right, he said everyone, insured or not, is fully protected. The banks, which comprise the elect few generally, are the large ones. It is only when the number of dollars at risk becomes mind-numbing that a bailout can be camouflaged as protection of the public. Sprague says, the FDI Act gives the FDIC board sole discretion to prevent a bank from failing at whatever cost. The board need only make the finding that the insured bank is in danger of failing and is essential to provide adequate banking service in its community. FDIC boards have been reluctant to make an essentiality finding unless they perceive a clear and present danger to the nation's financial system. Favoritism toward the large banks is obvious at many levels. One of them is the fact that, in a bailout, the FDIC covers all deposits, whether insured or not. That is significant because the banks pay an assessment based only on their insured deposits. So, if uninsured deposits are covered also, that coverage is free, more precisely, paid by someone else. What deposits are uninsured? Those in excess of $100,000 and those held outside the United States. Which banks hold the vast majority of such deposits? The large ones, of course, particularly those with extensive overseas operations, point to the bottom line is that the large banks get a whopping free ride when they're bailed out. Their uninsured accounts are paid by FDIC, and the cost of that benefit is passed to the smaller banks and to the taxpayer. This is not an oversight. Part of the plan at Jekyll Island was to give a competitive edge to the large banks. Unity Bank. The first application of the FDIC essentiality rule was, in fact, an exception. In 1971, Unity Bank and Trust Company in the Roxbury section of Boston found itself hopelessly insolvent, and the federal agency moved in. This is what was found. Unity's capital was depleted. Most of its loans were bad. Its loan collection practices were weak, and its personnel represented the worst of two worlds: overstaffing and inexperience. The examiners reported that there were 2 persons for every job, and neither one had been taught the job. With only $11.4 million on its books, the bank was small by current standards. Normally, the depositors would have been paid back, and the stockholders, like the owners of any other failed business venture, would have lost their investment. As Sprague himself admitted, if market discipline means anything, stockholders should be wiped out when a bank fails. Our assistance would have the side effect of keeping the stockholders alive at government expense. But Unity Bank was different. It was located in a black neighborhood and was minority-owned. As is often the case when government agencies are given discretionary powers, decisions are determined more by political pressures than by logic or merit, and Unity was a perfect example. In 1971, The specter of rioting in black communities still haunted the halls of Congress. Would the FDIC allow this bank to fail and assume the awesome responsibility for new riots and bloodshed? Sprague answers, "Neither will another director." Nora had any trouble viewing the problem in its broader social context. "We were willing to look for a creative solution. My vote to make the essentiality finding and thus save the little bank was probably foreordained, an inevitable legacy of Watts." The Watts riots ultimately triggered the essentiality doctrine. On July 22, 1971, the FDIC declared that the continued operation of Unity Bank was, indeed, essential and authorized a direct infusion of $1.5 million. Although appearing on the agency's ledger as a loan, no one really expected repayment. In 1976, in spite of the FDIC's own staff report that the bank's operations continued as slipshod and haphazard as ever, the agency rolled over the loan for another 5 years. Operations did not improve, and on June 30th, 1982, the Massachusetts Banking Commissioner finally revoked Unity's charter. There were no riots in the streets, and the FDIC quietly wrote off the sum of $4,463,000 as the final cost of the bailout. Commonwealth Bank of Detroit. The bailout of the Unity Bank of Boston was the exception to the rule that small banks are dispensable while the giants must be saved at all costs. From that point forward, however, the FDIC game plan was strictly according to Hoyle. The next bailout occurred in 1972 involving the $1.5 billion Bank of the Commonwealth of Detroit. Commonwealth had funded most of its phenomenal growth through loans from another bank, Chase Manhattan in New York. When Commonwealth went belly up, largely due to securities speculation and self-dealing on the part of its management, Chase seized 39% of its common stock and actually took control of the bank in an attempt to find a way to get its money back. FDIC Director Sprague describes the inevitable sequel. Chase officers suggested that Commonwealth was a public interest problem that the government agencies should resolve. That unsubtle hint was the way Chase phrased its request for a bailout by the government. Their proposal would come down to bailing out the shareholders, the largest of which was Chase. One of the bankers argued that Commonwealth must not be allowed to fold because it provided essential banking services to the community. That was justified on 2 counts. 1, it served many minority neighborhoods, and 2, there were not enough other banks in the city to absorb its operation without creating an unhealthy concentration of banking power in the hands of a few. It was unclear what the minority issue had to do with it inasmuch as every neighborhood in which Commonwealth had a branch was served by other banks as well. Furthermore, if Commonwealth were to be liquidated, many of those branches undoubtedly would have been purchased by competitors, and service to the communities would have continued. Judging by the absence of attention given to this issue during discussions, it is apparent that it was merely thrown in for good measure, and no one took it very seriously. In any event, the FDIC did not want to be accused of being indifferent to the needs of Detroit's minorities, and it certainly did not want to be a destroyer of free enterprise competition. So, on January 17, 1972, Commonwealth was bailed out with a $60 million loan plus numerous federal guarantees. Chase absorbed some losses, primarily as a result of Commonwealth's weak bond portfolio, but those were minor compared to what would have been lost without FDIC intervention. Since continuation of the bank was necessary to prevent concentration of financial power, FDIC engineered its sale to the First Arabian Corporation, a Luxembourg firm funded by Saudi princes. Better to have financial power concentrated in Saudi Arabia than in Detroit. The bank continued to flounder, and in 1983, what was left of it was resold to the former Detroit Bank and Trust Company, now called Comerica. Thus, the dreaded concentration of local power was realized after all, but not until Chase Manhattan was able to walk away from the deal with most of its losses covered. First Pennsylvania Bank. The 1980 bailout of the First Pennsylvania Bank of Philadelphia was next. First Penn was the nation's 23rd largest bank with assets in excess of $9 billion. It was 6 times the size of Commonwealth, 900 times larger than Unity. It was also the nation's oldest bank, dating back to the Bank of North America, which was created by the Continental Congress in 1781. The bank had experienced rapid growth and handsome profits largely due to the aggressive leadership of its chief executive officer, John Bunting, who had previously been an economist with the Federal Reserve Bank of Philadelphia. Bunting was the epitome of the era's go-go bankers. He vastly increased earnings ratios by reducing safety margins, taking on risky loans, and speculating in the bond market. As long as the economy expanded, these gambles were profitable, and the stockholders loved him dearly. When his gamble in the bond market turned sour, however, the bank plunged into a negative cash flow. By 1979, First Penn was forced to sell off several of its profitable subsidiaries in order to obtain operating funds, and it was carrying $328 million in questionable loans. That was $16 million more than the entire stockholder investment. The bank was insolvent, and the time had arrived to hit up the taxpayer for the loss. The bankers went to Washington and presented their case. They were joined by spokesmen from the nation's top three: Bank of America, Citibank, and of course the ever-present Chase Manhattan. They argued that not only was the bailout of First Penn essential for the continuation of banking services in Philadelphia, it was also critical to the preservation of world economic stability. The bank was so large, they said, if it were allowed to fall, it would act as the first domino leading to an international financial crisis. At first, the directors of the FDIC resisted that theory and earned the angry impatience of the Federal Reserve. Sprague recalls, "We were far from a decision on how to proceed. There was strong pressure from the beginning not to let the bank fail. Besides hearing from the bank itself, the other large banks, and the comptroller, we heard frequently from the Fed. I recall at one session, Fred Schultz, the Fed deputy chairman, argued in an ever-rising voice that there were no alternatives. We had to save the bank. He said, quit wasting time talking about anything else." The Fed's role as lender of last resort first generated contention between the Fed and FDIC during this period. The Fed was lending heavily to First Pennsylvania, fully secured, and Fed Chairman Paul Volcker said he planned to continue funding indefinitely until we could work out a merger or a bailout to save the bank. The directors of the FDIC did not want to cross swords with the Federal Reserve System, and they most assuredly did not want to be blamed for tumbling the entire world economic system by allowing the first domino to fall. The theory had never been tested, said Sprague. I was not sure I wanted it to be just then, too. So, in due course, a bailout package was put together which featured a $325 million loan from FDIC, interest-free for the first year and at a subsidized rate thereafter, about half the market rate. Several other banks, which were financially tied to First Penn, and which would have suffered great losses if it had folded, loaned an additional $175 million and offered a $1 billion line of credit. FDIC insisted on this move to demonstrate that the banking industry itself was helping and that it had faith in the venture. To bolster that faith, the Federal Reserve opened its discount window, offering low-interest funds for that purpose. The outcome of this particular bailout was somewhat happier than with the others, at least as far as the bank is concerned. At the end of the 5-year taxpayer subsidy, the FDIC loan was fully repaid. The bank has remained on shaky ground, however, and the final page of this episode has not yet been written. Continental Illinois. Everything up to this point was but mere practice for the big event which was yet to come. In the early 1980s, Chicago's Continental Illinois was the nation's 7th largest bank. With assets of $42 billion and with 12,000 employees working in offices in almost every major country in the world, its loan portfolio had undergone spectacular growth. Its net income on loans had literally doubled in just 5 years, and by 1981 had rocketed to an annual figure of $254 million. It had become the darling of the market analysts and even had been named by Dunn's Review as one of the 5 best-managed companies in the country. These opinion leaders failed to perceive that the spectacular performance was due not to an expertise in banking or investment, but to the financing of shaky business enterprises and foreign governments, which could not obtain loans anywhere else. But the public didn't know that, and wanted in on the action. For a while, the bank's common stock actually sold at a premium over others which were more prudently managed. The gaudy fabric began to unravel during the 4th of July weekend of 1982 with the failure of the Penn Square Bank in Oklahoma. That was a notorious shopping center bank that had booked $1 billion in oil and gas loans and resold them to Continental just before the collapse of the energy market. Other loans also began to sour at the same time. The Mexican and Argentine debt crisis was coming to a head, and a series of major corporate bankruptcies were receiving almost daily headlines. Continental had placed large chunks of its easy money with all of them. When these events caused the bank's credit rating to drop, cautious depositors began to withdraw their funds, and new funding dwindled to a trickle. The bank became desperate for cash to meet its daily expenses. In an effort to attract new money, it began to offer unrealistically high rates of interest on its CDs. Loan officers were sent to scour the European and Japanese markets and to conduct a public relations campaign aimed at convincing market managers that the bank was calm and steady. David Taylor, the Hanks chairman at that time, said, "We had the Continental Illinois Reassurance Brigade, and we fanned out all over the world." One in the fantasy land of modern finance, glitter is often more important than substance, image more valuable than reality. The bank paid the usual quarterly dividend in August, in spite of the fact that this intensified its cash crunch. As with the Penn Central Railroad 12 years earlier, that move was calculated to project an image of business-as-usual prosperity. And the ploy worked, for a while at least. By November, the public's confidence had been restored, and the bank's stock recovered to its pre-Penn Square level. By March of 1983, it had risen even higher. But the worst was yet to come. By the end of 1983, the bank's burden of non-performing loans had reached unbearable proportions and was growing at an alarming rate. By 1984, it was $2.7 billion. That same year, the bank sold off its profitable credit card operation to make up for the loss of income and to obtain money for paying stockholders their expected quarterly dividend. The internal structure was near collapse, but the external facade continued to look like business as usual. The first crack in that facade appeared at 11:39 a.m. On Tuesday, May 8th, Reuters, the British news agency, moved a story on its wire service stating that banks in the Netherlands, West Germany, Switzerland, and Japan had increased their interest rate on loans to Continental and that some of them had begun to withdraw their funds. The story also quoted the bank's official statement that rumors of pending bankruptcy were totally preposterous. Within hours, another wire, the Commodity News Service, reported a second rumor, that a Japanese bank was interested in buying Continental. World's first electronic bank run. As the sun rose the following morning, foreign investors began to withdraw their deposits. $1 billion in Asian money moved out that first day. The next day, a little more than 24 hours following Continental's assurance that bankruptcy was totally preposterous, its long-standing customer, the Board of Trade Clearing Corporation, located just down the street, withdrew $50 million. Word of the defection spread through the financial wire services, and the panic was on. It became the world's first global electronic bank run. By Friday, the bank had been forced to borrow $3.6 billion from the Federal Reserve in order to cover its escaping deposits. A consortium of 16 banks, led by Morgan Guaranty, offered a generous 30-day line of credit, but all of this was far short of the need. In the beginning, almost all of this action was at the institutional level. Other banks and professionally managed funds which closely monitor every minuscule detail of the financial markets. The general public had no inkling of the catastrophe, even as it unfolded. Chernow says, "The Continental run was like some modernistic fantasy. There were no throngs of hysterical depositors, just cool nightmare flashes on computer screens." Sprague writes, "Inside the bank, all was calm, the teller lines moved as always, and bank officials recall no visible sign of trouble, except in the wire room. Here the employees knew what was happening as withdrawal order after order moved on the wire, bleeding Continental to death." Some cried. This was the golden moment for which the Federal Reserve and the FDIC were created. Without government intervention, Continental would have collapsed, its stockholders would have been wiped out, depositors would have been badly damaged, and the financial world would have learned that banks not only have to talk about prudent management, they actually have to adopt it. Future banking practices would have been severely altered, and the long-term economic benefit to the nation would have been enormous. But with government intervention, the discipline of a free market is suspended, and the cost of failure or fraud is politically passed to the taxpayers. Depositors continue to live in a dream world of false security, and banks can operate recklessly and fraudulently with the knowledge that their political partners in government will come to their rescue when they get into trouble. FDIC generosity with tax dollars. One of the challenges at Continental was that, while only 4% of its liability was covered by FDIC insurance, the regulators felt compelled to cover the entire exposure, which means that the bank paid insurance premiums into the fund based on only 4% of its total coverage, and the taxpayers now would pick up the other 96%. FDIC Director Sprague explains, although Continental Illinois had over $30 billion in deposits, 90% were uninsured foreign deposits or large certificates substantially exceeding the $100,000 insurance limit. Off-book liabilities swelled Continental's real size to $69 billion. In this massive liability structure, only some $3 billion within the insured limit was scattered among 850,000 deposit accounts. So it was in our power and entirely legal simply to pay off the insured depositors, let everything else collapse, and stand back to watch the carnage. That course was never seriously considered by any of the players. From the beginning, there were only two questions: how to come to Continental's rescue by covering its total liabilities, and, equally important, how to politically justify such a fleecing of the taxpayer. As pointed out in the previous chapter, the rules of the game require that the scam must always be described as a heroic effort to protect the public. In the case of Continental, the sheer size of the numbers made the ploy relatively easy. There were so many depositors involved, so many billions at risk, so many other banks interlocked. It could be claimed that the economic fabric of the entire nation, of the world itself, was at stake. And who could say that it was not so? Sprague argues the case in familiar terms. An early morning meeting was scheduled for Tuesday, May 15th, at the Fed. We talked over the alternatives. They were few, none really. Treasury Secretary Reagan and Fed Chairman Volcker raised the familiar concern about a national banking collapse, that is, a chain reaction if Continental should fail. Volcker was worried about an international crisis. We all were acutely aware that never before had a bank even remotely approaching Continental's size closed. No one knew what might happen in the nation and in the world. It was no time to find out just for the purpose of intellectual curiosity. The final bailout package. The bailout was predictable from the start. There would be some preliminary lip service given to the necessity of allowing the banks themselves to work out their own problem. That would be followed by a plan to have the banks and the government share the burden. And that finally would collapse into a mere public relations illusion. In the end, almost the entire cost of the bailout would be assumed by the government and passed on to the taxpayer. At the May 15th meeting, Treasury Secretary Reagan spoke eloquently about the value of a free market and the necessity of having the banks mount their own rescue plan, at least for a part of the money. To work out that plan, a summit meeting was arranged the next morning among the chairmen of the 7 largest banks: Morgan Guaranty, Chase Manhattan, Citibank, Bank of America, Chemical Bank, Bankers Trust, and Manufacturers Hanover. The meeting was perfunctory at best. The bankers knew full well that the REAGA and administration would not risk the political embarrassment of a major bank failure. That would make the president and the Congress look bad at re-election time. But still, some kind of tokenism was called for to preserve the administration's conservative image. So, with urging from the Fed and the Treasury, the consortium agreed to put up the sum of $500 million, an average of only $71 million for each, far short of the actual need. Chernow describes the plan as make-believe and says they pretended to mount a rescue. Sprague supplies the details. The bankers said they wanted to be in on any deal but they did not want to lose any money. They kept asking for guarantees. They wanted it to look as though they were putting money in, but at the same time, wanted to be absolutely sure they were not risking anything. By 7:30 a.m., we had made little progress. We were certain the situation would be totally out of control in a few hours. Continental would soon be exposing itself to a new business day, and the stock market would open at 10 o'clock. Isaac, another FDIC director, and I held a hallway conversation. We agreed to go ahead without the banks. We told Conover, the third FDIC director, the plan, and he concurred. Later, we got word from Bernie McKeon, our regional director in New York, that the bankers had agreed to be at risk. Actually, the risk was remote since our announcement had promised 100% insurance. The final bailout package was a whopper. Basically, the government took over continental Illinois and assumed all of its losses. Specifically, the FDIC took $4.5 billion in bad loans and paid Continental $3.5 billion for them. The difference was then made up by the infusion of $1 billion in fresh capital in the form of stock purchase. The bank, therefore, now had the federal government as a stockholder controlling 80% of its shares, and its bad loans been dumped onto the taxpayer. In effect, even though Continental retained the appearance of a private institution, it had been nationalized. Lender of last resort. Perhaps the most important part of the bailout, however, was that the money to make it possible was created directly or indirectly by the Federal Reserve System. If the bank had been allowed to fail, and the FDIC had been required to cover the losses, the drain would have emptied the entire fund with nothing left to cover the liabilities of thousands of other banks. In other words, this one failure alone, if it were allowed to happen, would have wiped out the entire FDIC. That's one reason the bank had to be kept operating, losses or no losses, and that's why the Fed had to be involved in the bailout. In fact, that was precisely the reason the system was created at Jekyll Island, to manufacture whatever amount of money might be necessary to cover the losses of the cartel. The scam could never work unless the Fed was able to create money out of nothing and pump it into the banks along with credit and liquidity guarantees. Which means, if the loans go sour, the money is eventually extracted from the American people through the hidden tax called inflation. That's the meaning of the phrase, lender of last resort. FDIC Director Irvine Sprague, while discussing the press release which announced the Continental bailout package, describes the Fed's role this way. The third paragraph granted 100% insurance to all depositors, including the uninsured and all general creditors. The next paragraph set forth the conditions under which the Fed, as lender of last resort, would make its loans. The Fed would lend to Continental to meet any extraordinary liquidity requirements. That would include another run. All agreed that Continental could not be saved without 100% insurance by FDIC and unlimited liquidity support by the Federal Reserve. No plan would work without these two elements. By 1984, unlimited liquidity support had translated into the staggering sum of $8 billion. By early 1986, the figure had climbed to $9.24 billion and was still rising. While explaining this fleecing of the taxpayer to the Senate Banking Committee, Fed Chairman Paul Volcker said, "The operation is the most basic function of the Federal Reserve. It was why it was founded." One with those words, he has confirmed one of the more controversial assertions of this book. Small banks be damned. It has been mentioned previously that the large banks receive a free ride on their FDIC coverage at the expense of the small banks. There could be no better example of this than the bail out of continental Illinois. In 1983, the bank paid a premium into the fund of only $6.5 million to protect its insured deposits of $3 billion. The actual liability, however, including its institutional and overseas deposits, was 10 times that figure, and the FDIC guaranteed payment on the whole amount. As Sprague admitted, small banks pay proportionately far more for their insurance and have far less chance of a continental-style bailout. To how true? Within the same week that the FDIC and the Fed were providing billions in payments, stock purchases, loans, and guarantees for continental Illinois, it closed down the tiny Bledsoe County Bank of Pikeville, Tennessee, and the Planters Trust and Savings Bank of Opelousas, Louisiana. During the first half of that year, 43 smaller banks failed without an FDIC bailout. In most cases, a merger was arranged with a larger bank, and only the uninsured deposits were at risk. The impact of this inequity upon the banking system is enormous. It sends a message to bankers and depositors alike that small banks, if they get into trouble, will be allowed to fold, whereas large banks are safe regardless of how poorly or fraudulently they are managed. As a New York investment analyst stated to news reporters, Continental Illinois, even though it had just failed, was obviously the safest bank in the country to have your money in. 3-0 could be better calculated to drive the small independent banks out of business or to force them to sell out to the giants. And that, in fact, is exactly what has been happening. Since 1984, while hundreds of small banks have been forced out of business, the average size of the banks which remain with government protection has more than doubled. It will be recalled that this advantage of the big banks over their smaller competitors was also one of the objectives of the Jekyll Island plan. Perhaps the most interesting and depressing aspect of the Continental Illinois bailout was the lack of public indignation over the principle of using taxes and inflation to protect the banking industry. Smaller banks have complained of the unfair advantage given to the larger banks, but not on the basis that the government should have let the giant fall. Their lament was that it should now protect them in the same paternalistic fashion. Voters and politicians were silent on the issue, apparently awed by the sheer size of the numbers and the specter of economic chaos. Decades of public education had left their mark. After all, wasn't this exactly what government schools have taught is the proper function of government? Wasn't this the American way? Even Ronald Reagan, viewed as the national champion of economic conservatism, praised the action. From aboard Air Force One on the way to California, the president said, "It was a thing that we should do, and we did it. It was in the best interest of all concerned." 1. The Reagan endorsement brought into focus one of the most amazing phenomena of the 20th century, the process by which America has moved to the left towards statism, while marching behind the political banner of those who speak the language of opposing statism. William Grider, a former writer for the liberal Washington Post and the Rolling Stone, complains, "The nationalization of Continental was, in fact, a quintessential act of modem liberalism, the state intervening in behalf of private interests in a broad public purpose." In this supposedly conservative era, federal authorities were setting aside the harsh verdict of market competition and grossly expanding their own involvement in the private economy. In the past, conservative scholars and pundits had objected loudly at any federal intervention in the private economy, particularly emergency assistance for failing companies. Now, they hardly seem to notice. Perhaps they would have been more vocal if the deed had been done by someone other than the conservative champion, Ronald Reagan. For years after the bailout of Continental Illinois, the same play was used in the rescue of Bank Oklahoma, which was a bank holding company. The FDIC pumped $130 million into its main banking unit and took warrants for 55% ownership. The pattern had been set. By accepting stock in a failing bank in return for bailing it out, the government had devised an ingenious way to nationalize banks without calling it that. Issuing stock sounds like a business transaction in the private sector. And the public didn't seem to notice the reality that Uncle Sam was going into banking. Second reason to abolish the Federal Reserve. A sober evaluation of this long and continuing record leads to the second reason for abolishing the Federal Reserve System. Far from being a protector of the public, it is a cartel operating against the public interest. Summary. The game called Bailout is not a whimsical figment of the imagination. It is for real. Here are some of the big games of the season and their final scores. In 1970, Penn Central Railroad became bankrupt. The banks which loaned the money had taken over its board of directors and had driven it further into the hole, all the while extending bigger and bigger loans to cover the losses. Directors concealed reality from the stockholders and made additional loans so the company could pay dividends to keep up the false front. During this time, the directors and their banks unloaded their stock at unrealistically high prices. When the truth became public, The stockholders were left holding the empty bag. The bailout, which was engineered by the Federal Reserve, involved government subsidies to other banks to grant additional loans. Then Congress was told that the collapse of Penn Central would be devastating to the public interest. Congress responded by granting $125 million in loan guarantees so that banks would not be at risk. The railroad eventually failed anyway, but the bank loans were covered. Penn Central was nationalized into Amtrak and continues to operate at a loss. In 1970, as Lockheed faced bankruptcy, Congress heard essentially the same story. Thousands would be unemployed, subcontractors would go out of business, and the public would suffer greatly. So Congress agreed to guarantee $250 million in new loans, which put Lockheed 60% deeper into debt than before. Now that government was guaranteeing the loans, it had to make sure Lockheed became profitable. This was accomplished by granting lucrative defense contracts at non-competitive bids. The banks were paid back. In 1975, New York City had reached the end of its credit rope. It had borrowed heavily to maintain an extravagant bureaucracy and a miniature welfare state. Congress was told that the public would be jeopardized if city services were curtailed and that America would be disgraced in the eyes of the world. So Congress authorized additional direct loans up to $2.3 billion, which more than doubled the size of the current debt. The banks continued to receive their interest. In 1978, Chrysler was on the verge of bankruptcy. Congress was informed that the public would suffer greatly if the company folded, and that it would be a blow to the American way if freedom of choice were reduced from 3 to 2 makes of automobiles. So Congress guaranteed up to $1.5 billion in new loans. The banks reduced part of their loans and exchanged another portion for preferred stock. News of the deal pushed up the market value of that stock and largely offset the loan write-off. The bank's previously uncollectible debt was converted into a government-backed, interest-bearing asset. In 1972, the Commonwealth Bank of Detroit, with $1.5 billion in assets, became insolvent. It had borrowed heavily from the Chase Manhattan Bank in New York to invest in high-risk and potentially high-profit ventures. Now that it was in trouble, so was Chase. The bankers went to Washington and told the FDIC the public must be protected from the great financial hardship that would follow if Commonwealth were allowed to close. So the FDIC pumped in a $60 million loan plus federal guarantees of repayment. Commonwealth was sold to an Arab consortium. Chase took a minor write-down, but converted most of its potential loss into government-backed assets. In 1979, the First Pennsylvania Bank of Philadelphia became insolvent. With assets in excess of $9 billion, it was 9 times the size of Commonwealth. It, too, had been an aggressive player in the 80s. Now the bankers and the Federal Reserve told the FDIC that the public must be protected from the calamity of a bank failure of this size, that the national economy was at stake, perhaps even the entire world. So the FDIC gave a $325 million loan, interest-free for the first year, and at half the market rate thereafter. The Federal Reserve offered money to other banks at a subsidized rate for the specific purpose of rel-lending to First Penn. With that enticement, they advanced $175 million in immediate loans plus a $1 billion line of credit. In 1982, Chicago's Continental Illinois became insolvent. It was the nation's 7th largest bank with $42 billion in assets. The previous year, its profits had soared as a result of loans to high-risk business ventures and foreign governments. Although it had been the darling of market analysts, it quickly unraveled when its cash flow turned negative and overseas banks began to withdraw deposits. It was the world's first electronic bank run. Federal Reserve Chairman Volcker told the FDIC that it would be unthinkable to allow the world economy to be ruined by a bank failure of this magnitude. So the FDIC assumed $4.5 billion in bad loans and, in return for the bailout, took 80% ownership of the bank in the form of stock. In effect, the bank was nationalized, but no one called it that. The United States government was now in the banking business. All of the money to accomplish these bailouts was made possible by the Federal Reserve System acting as the lender of last resort. That was one of the purposes for which it had been created. We must not forget that the phrase lender of last resort means that the money is created out of nothing, resulting in the confiscation of our nation's wealth through the hidden tax called inflation. Chapter 4. Home, Sweet Loan. The history of increasing government intervention in the housing industry. The stifling of free market forces in residential real estate. The residing crisis in the S&L industry. The bailout of that industry with money taken from the taxpayer. As we have seen in previous chapters, the damage done by the banking cartel is made possible by the fact that money can be created out of nothing. It also destroys our purchasing power through the hidden tax called inflation. The mechanism by which it works is hidden and subtle. Let us turn, now, from the arcane world of central banking to the giddy world of savings and loan institutions. By comparison, the problem in the savings and loan industry is easy to comprehend. It is simply that vast amounts of money are disappearing into the black hole of government mismanagement, and the losses must eventually be paid by us. The end result is the same in both cases. Socialism takes root in America. It all began with a concept. The concept took root in America largely as a result of the Great Depression of the 1930s. American politicians were impressed at how radical Marxists were able to attract popular support by blaming the capitalist system for the country's woes and by promising a socialist utopia. They admired and feared these radicals, admired them for their skill at mass psychology, feared them lest they become so popular as to win a plurality at the ballot box. It was not long before many political figures began to mimic the soapbox orders, and the voters enthusiastically put them into office. While the extreme and violent aspects of communism generally were rejected, the more genteel theories of socialism became popular among the educated elite. It was they who would naturally become the leaders in an American socialist system. Someone had to look after the masses and tell them what to do for their own good. And many with college degrees and those with great wealth became enamored by the thought of playing that role. And so, the concept became widely accepted at all levels of American life, the downtrodden masses as well as the educated elite, that it was desirable for the government to take care of its citizens and to protect them in their economic affairs. And so, when more than 1,900 Senators went belly up in the Great Depression, Herbert Hoover, and a most willing Congress, created the Federal Home Loan Bank Board to protect depositors in the future. It began to issue charters to institutions that would submit to its regulations, and the public was led to believe that government regulators would be more wise, prudent, and honest than private managers. A federal charter became a kind of government seal of approval. The public at last was being protected. Hoover was succeeded by FDR in the White House, who became the epitome of the new breed. Earlier in his political career, he had been the paragon of free enterprise and individualism. He spoke out against big government and for the free market, but in midlife he reset his sail to catch the shifting political wind. He went down in history as a pioneer of socialism in America. It was FDR who took the next step toward government paternalism in the S&L industry, as well as the banking industry, by establishing the Federal Deposit Insurance Corporation, FDIC, and the Federal Saving and Loan Insurance Corporation, SLIC. From that point forward, neither the public nor the managers of the thrifts needed to worry about losses. Everything would be reimbursed by the government. A house on every lot. At about the same time, loans on private homes became subsidized through the Federal Housing Authority, FHA, which allowed S&Ls to make loans at rates lower than would have been possible without the subsidy. This was to make it easier for everyone to realize the dream of having their own home. While the Marxists were promising a chicken in every pot, the New Dealers were winning elections by pushing for a house on every lot. In the beginning, many people were able to purchase a home who, otherwise, might not have been able to do so, or who would have had to wait longer to accumulate a higher down payment. On the other hand, the FH-induced easy credit began to push up the price of houses for the middle class, and that quickly offset any real advantage of the subsidy. The voters, however, were not perceptive enough to understand this canceling effect and continued to vote for politicians who promised to expand the system. The next step was for the Federal Reserve Board to require banks to offer interest rates lower than those offered by SNLS. The result was that funds moved from the banks into the SNLS and became abundantly available for home loans. This was a deliberate national policy to favor the home industry at the expense of other industries that were competing for the same investment dollars. It may not have been good for the economy as a whole, but it was good politics. Abandonment of the free market. These measures effectively removed real estate loans from the free market and placed them into the political arena, where they have remained ever since. The damage to the public as a result of this intervention would be delayed a long time in coming, but when it came, it would be cataclysmic. The reality of government disruption of the free market cannot be overemphasized, for it is at the heart of our present and future crisis. We have savings institutions that are controlled by government at every step of the way. Federal agencies provide protection against losses and lay down rigid guidelines for capitalization levels, number of branches, territories covered, management policies, services rendered, and interest rates charged. The additional cost to SNLS of compliance with this regulation has been estimated by the American Bankers Association at about $11 billion per year, which represents a whopping 60% of all their profits. On top of that, the healthy component of the industry must spend over $1 billion each year for extra premiums into the so-called insurance fund to make up for the failures of the unhealthy component, a form of penalty for success. When some of the healthy institutions attempted to convert to banks to escape this penalty, the regulators said no. Their cash flow was needed to support the bailout fund. Insurance for the common man? The average private savings deposit is about $6,000. Yet, under the Carter administration, the level of FDIC insurance was raised from $40,000 to $100,000 for each account. Those with more than that merely had to open several accounts. So, in reality, the sky was the limit. Clearly, this had nothing to do with protecting the common man. The purpose was to prepare the way for brokerage houses to reinvest huge blocks of capital at high rates of interest virtually without risk. It was, after all, insured by the federal government. By December of 1980, they were paying 15.8% interest on their money market certificates. Yet, the average rate they were charging for new mortgages was only 12.9%. Many of their older loans were still crunching away at 7 or 8%. And to compound the problem, some of those were in default, which means they were really paying 0%. The thrifts were operating deep in the red and had to make up the difference somewhere. The weakest SNLS paid the highest interest rates to attract depositors, and they're the ones which obtained the large blocks of brokered funds. Brokers no longer cared how weak the operation was because the funds were fully insured. They just cared about the interest rate. On the other hand, the SNL managers reasoned that they had to make those funds work miracles for the short period they had them. It was their only chance to dig out, and they were willing to take big risks. For them also, the government's insurance program had removed any chance of loss to their depositors. So many of them plunged into high-profit, high-risk real estate developments. Deals began to go sour, and 1979 was the first year since the Great Depression of the 1930s that the total net worth of federally insured SNLS became negative. And that was despite expansion almost everywhere else in the economy. The public began to worry. Full faith in credit. The protectors in Washington responded in 1982 with a joint resolution of Congress declaring that the full faith and credit of the United States government stood behind the slick. That was a reassuring phrase, but many people had the gnawing feeling that, somehow, we were going to pay for it ourselves. And they were right. Consumer Reports explained, behind the troubled banks and the increasingly troubled insurance agencies stands the full faith and credit of the government. In effect, a promise, sure to be honored by Congress, that all citizens will chip in through taxes or through inflation to make AIL depositors whole. The plight of the SNLS was dramatically brought to light in Ohio in 1985 when the Home State Savings Bank of Cincinnati collapsed as a result of a potential $150 million loss in a Horita securities firm. This triggered a run, not only on the 33 branches of Home State, but on many of the other SNLs as well. The news impacted international markets where overseas speculators dumped paper dollars for other currencies, and some rushed to buy gold. Within a few days, depositors demanding their money caused $60 million to flow out of the state's $130 million insurance fund, which, true to form for all government protection schemes, was terribly inadequate. If the run had been allowed to continue, the fund likely would have been obliterated the next day. It was time for a political fix. On March 15th, Ohio Governor Richard Celeste declared one of the few bank holidays since the Great Depression and closed all 71 of the state-insured thrifts. He assured the public there was nothing to worry about. He said this was merely a cooling-off period until we can convincingly demonstrate the soundness of our system. Then he flew to Washington and met with Paul Volcker, chairman of the Federal Reserve Board, and with Edwin Gray, chairman of the Federal Home Loan Bank Board, to request federal assistance. They assured him it was available. A few days later, depositors were authorized to withdraw up to $750 from their accounts. On March 21st, President Reagan calmed the world money markets with assurances that the crisis was over. Furthermore, he said, the problem was limited to Ohio. This was not the first time there had been a failure of state-sponsored insurance funds. The one in Nebraska was pulled down when the Commonwealth Savings Company of Lincoln failed. It had over $60 million in deposits, but the insurance fund had less than $2 million to cover, not just Commonwealth, but the whole system. Depositors were lucky to get 65 cents on the dollar, and even that was expected to take up to 10 years. An invitation to fraud. In the early days of the Reagan administration, government regulations were changed so that the SNLs were no longer restricted to the issuance of home mortgages, the sole reason for their creation in the first place. In fact, they no longer even were required to obtain a down payment on their loans. They could now finance 100% of a deal, or even more. Office buildings and shopping centers sprang up everywhere regardless of the need. Developers, builders, managers, and appraisers made millions. The field soon became overbuilt and riddled with fraud. Billions of dollars disappeared into defunct projects. In at least 22 of the failed SNLs, there is evidence that the mafia and CIA were involved. Fraud is not necessarily against the law. In fact, most of the fraud in the SNL saga was not only legal, it was encouraged by the government. The Garnest Germain Act allowed the thrifts to lend an amount of money equal to the appraised value of real estate rather than a market value. It wasn't long before appraisers were receiving handsome fees for appraisals that were, to say the least, unrealistic. But that was not fraud, it was the intent of the regulators. The amount by which the appraisal exceeded the market value was defined as appraised equity and was counted the same as capital. Since the SNLs were required to have $1 in capital for every $33 held in deposits, an appraisal that exceeded market value by $1 million could be used to pyramid $33 million in deposits from Wall Street brokerage houses. And the anticipated profits from those funds was one of the ways in which the SNLs were supposed to recoup their losses without the government having to cough up the money, which it didn't have. In effect, the government was saying, we can't make good on our protection scheme, so go get the money yourself by putting the investors at risk. Not only will we back you up if you fail, we'll show you exactly how to do it. The fallout begins. In spite of the accounting gimmicks, which were created to make the Walking Dead SNLs look healthy, by 1984 the fallout began. The Slick closed one institution that year and arranged for the merger of 26 others which were insolvent. In order to persuade healthy firms to absorb insolvent ones, the government provides cash settlements to compensate for the liabilities. By 1984, these subsidized mergers were costing the FDIC over $1 billion per year. Yet, that was just the small beginning. Between 1980 and 1986, a total of 664 insured SNLs failed. Government regulators had promised to protect the public in the event of losses, but the losses were already far beyond what they could handle. They could not afford to close down all the insolvent thrifts because they simply didn't have enough money to cover the payout. In March of 1986, the Slick had only 3 cents for every dollar of deposits. By the end of that year, The figure had dropped to 0.2 of a penny for each dollar insured. Obviously, they had to keep those thrifts in business, which meant they had to invent even more accounting gimmicks to conceal the reality. Postponement of the inevitable made matters even worse. Keeping the SNLS in business was costing the Slick $6 million per day. By 1988, 2 years later, the thrift industry as a whole was losing $9.8 million per day, and the unprofitable ones, the corpses which were propped up by the Slick, were losing $35.6 million per day. And still, the game continued. By 1989, the Slick no longer had even 0.2 of a penny for each dollar insured. Its reserves had vanished altogether. Like the thrifts it supposedly protected, it was itself insolvent and looking for loans. It had tried offering bond issues, but these fell far short of its needs. Congress had discussed the problem, but had failed to provide new funding. The collapse of Lincoln's savings brought the crisis to a head. There was no money, period. The Fed usurps the role of Congress. In February, an agreement was reached between Alan Greenspan, chairman of the Federal Reserve Board, and M. Danny Wall, chairman of the Federal Home Loan Bank Board, to have $70 million of bailout funding for Lincoln savings come directly from the Federal Reserve. This was a major break in precedent. Historically, the Fed has served to create money only for the government or for banks. If it were the will of the people to bail out a savings institution, then it is up to Congress to approve the funding. If Congress does not have the money or cannot borrow it from the public, then the Fed can create it out of nothing, of course, and give it to the government. But in this instance, the Fed was usurping the role of Congress and making political decisions entirely on its own. There is no basis in the Federal Reserve Act for this action. Yet, Congress remained silent, apparently out of collective guilt for its own paralysis. Finally, in August of that year, Congress was visited by the ghost of FDR and sprang into action. It passed the Financial Institutions Reform and Recovery Act, FREA, and allocated a minimum of $66 billion for the following 10 years, $300 billion over 30 years. Of this amount, $225 billion was to come from taxes or inflation, and $75 billion was to come from the healthy SNLS. It was the biggest bailout ever, bigger than the combined cost for Lockheed, Chrysler, Penn Central, and New York City. In the process, the Slick was eliminated because it was hopelessly insolvent and replaced by the Savings Association Insurance Fund. Also created was the Banking Insurance Fund for the protection of commercial banks, and both are now administered by the FDIC. As is often the case when previous government control fails to produce the desired result, the response of Congress is to increase the controls. 4 entirely new layers of bureaucracy were added to the existing tangled mess. The Resolution Trust Oversight Board, to establish strategies for the RDC. The Resolution Funding Corporation, to raise money to operate the RDC. The Office of Thrift Supervision, to supervise thrift institutions even more than they had been, and the Oversight Board for the Home Loan Banks, the purpose of which remains vague, but probably is to make sure that the SNLS continue to serve the political directive of subsidizing the home industry. When President Bush signed the bill, he said, "This legislation will safeguard and stabilize America's financial system and put in place permanent reforms so these problems will never happen again." Moreover, it says to tens of millions of savings and loan depositors, "You will not be the victim of others' mistakes. We will guarantee that your insured deposits are secure." The estimates are slightly wrong. By the middle of the following year, it was clear that the $66 billion funding would be greatly inadequate. Treasury spokesmen were now quoting $130 billion, about twice the original estimate. How much is $130 billion? In 1990, it was 30% more than the salaries of all the school teachers in America. It was more than the combined profits of all the Fortune 500 industrial companies. It would send 1.6 million students through the best four-year colleges, including room and board. And the figure did not even include the cost of liquidating the huge backlog of thrifts already seized, nor the interest that had to be paid on borrowed funds. Within only a few days of the announced increase, The Treasury again revised the figure upward from $130 billion to $150 billion. As Treasury Secretary Nicholas Brady told the press, no one should assume that the estimates won't change. They will. Indeed, the estimates continued to change with each passing week. The government had sold or merged 223 insolvent thrifts during 1988 and had given grossly inadequate estimates of the cost. Financiers such as Ronald Perelman and the Texas investment partnership called Temple Inland, Inc. picked up many of these at fantastic bargains, especially considering that they were given cash subsidies and tax advantages to sweeten the deal. At the time, Danny Wall, who was then chairman of the Federal Home Loan Bank Board, announced that these deals took care of the worst thrift problems. He said the cost of the bailout was $39 billion. The Wall Street Journal replied, "Wrong again." The new study, a compilation of audits prepared by the Federal Deposit Insurance Corporation, indicates that the total cost of the so-called class of '88 will be $90 billion to $95 billion, including FAC benefits granted the buyers and a huge amount of interest on government debt to help finance this assistance. But the 1988 thrift rescue's most expensive flaw doesn't appear to be the enrichment of tycoons. Rather, it's that none of the deals ended or even limited the government's exposure to mismanagement by the new owners, hidden losses on real estate in the past, or the vicissitudes of the real estate markets in the future. And some of the deals appear to be sham transactions, in which failing thrifts were sold to failing thrifts, which are failing all over again. Although the thrifts proved to be in far worse shape than the bank board estimated, Mr. Wall defends his strategy for rescuing them with open-ended assistance. "We didn't have the money to liquidate," he says. When Congress passed HRREA the previous year to safeguard and stabilize America's financial system, the staggering sum of $300 billion was authorized to be taken from taxes and inflation over the following 30 years to do the job. Now, Federal Reserve Chairman Alan Greenspan was saying that the true long-term cost would stand at $500 billion, an amount even greater than the default of loans to all the third world countries combined. The figure was still too low. A non-biased private study released by Veribank Incorporated showed that, when all the hidden costs are included, the bill presented to the American people will be about $532 billion. The problems that President Bush promised would never happen again were happening again. Bookkeeping sleight of hand. Long before this point, the real estate market had begun to contract, and many mortgages exceeded the actual price for which the property could be sold. Furthermore, market interest rates had risen far above the rates that were locked into most of the S&L loans, and that decreased the value of those mortgages. The true value of a $50,000 mortgage that is paying 7% interest is only half of a $50,000 mortgage that is earning 14%. So the protectors of the public devised a scheme whereby the SNLS were allowed to value their assets according to the original loan value rather than their true market value. That helped, but much more was still needed. The next step was to create bookkeeping assets out of thin air. This was accomplished by authorizing the SNLS to place a monetary value on community goodwill. With the mere stroke of a pen, the referees created $2.5 billion in such assets, and the players continued the game. Then the slick began to issue certificates of net worth, which were basically promises to bail out the ailing SNLS should they need it. The government had already promised to do that, but by printing it on pieces of paper and calling them certificates of net worth, the SNLS were allowed to count them as assets on their books. Such promises are assets, but since the thrifts would be obligated to pay back any money it received in a bailout, those payback obligations should also have been put on the books as liabilities. The net position would not change. The only way they could count the certificates as assets without adding the offsetting liabilities would be for the bailout promises to be outright gifts with no obligation to ever repay. That may be the eventual result, but it is not the way the plan was set up. In any event, the thrifts were told they could count these pieces of paper as capital, the same as if the owners had put up their own cash. And the game continued. The moment of truth arrives when the SNLS have to liquidate some of their holdings, such as in the sale of their mortgages or foreclosed homes to other SNLS, commercial banks, or private parties. That is when the inflated bookkeeping value is converted into the true market value, and the difference has to be entered into the ledger as a loss. But not in the never-never land of socialism, where government is the great protector. Dennis Turner explains, the FSUC permits the S&L which sold the mortgage to take the loss over a 40-year period. Most companies selling an asset at a loss must take the loss immediately. Only S&LS can engage in this patent fraud. Two failing S&LS could conceivably sell their lowest-yielding mortgages to one another, and both would raise their net worth. This dishonest accounting in the banking system is approved by the highest regulatory authorities. U.S. News and World Report continues the commentary. Today, scores of savings and loan associations, kept alive mainly by accounting gimmicks, continue to post big losses. Only a fraction of the industry's aggregate net worth comprises hard assets, such as mortgage notes. Intangible assets, which include bookkeeping entries such as goodwill, make up nearly all of the industry's estimated net worth of $37.6 billion. Accounting gimmicks are not fraud. We must keep in mind that a well-managed institution would never assume these kinds of risks or resort to fraudulent accounting if it wanted to stay in business for the long haul. But with Washington setting guidelines and standing by to make up losses, a manager would be fired if he didn't take advantage of the opportunity. After all, Congress specifically said it was okay when it passed the laws. These were loopholes deliberately put there to be used. Dr. Edward Kane explains, deception itself doesn't constitute a legal fraud when it's authorized by an accounting system, such as the Generally Accepted Accounting Principles, GAAP, system which allows institutions to forego recording assets at their true worth, maintaining them instead at their inflated value. The Regulatory Accounting Principles system in 1982 added even new options to overstate capital. Intense speculation, such as we observe in these firms, is not necessarily bad management at all. In most of these cases, it was clever management. There were clever gambles that exploited not depositors or savers, but taxpayers. Point one, the press has greatly exaggerated the role of illegal fraud in these matters, with much time spent excoriating the likes of Donald Dixon at Vernon S&L and Charles Keating at Lincoln Savings. True, these flops cost the taxpayer well over $3 billion, but all the illegal fraud put together amounts to only about 0.5% of the total losses. So far, point two, focusing on that minuscule component, serves only to distract from the fact that the real problem is government regulation itself. Junk bonds are not junk. Another part of the distraction has been to make it appear that the thrifts got into trouble because they were heavily invested in junk bonds. Wait a minute. Were junk bonds, anyway? This may come as a surprise, but those held by the S&LS were anything but junk. In fact, in terms of risk-return ratios, most of them were superior grade investments to bond from the Fortune 500 companies. So-called junk bonds are merely those that are offered by smaller companies which are not large enough to be counted among the nation's giants. The large reinvestors, such as managers of mutual funds and retirement funds, prefer to stay with well-known names like General Motors and IBM. They need to invest truly huge blocks of money every day, and the smaller companies just don't have enough to offer to satisfy their needs. Consequently, many stocks and bonds from smaller companies are not traded in the New York Stock Exchange. They're traded in smaller exchanges or directly between brokers in what is called over-the-counter. Because they do not have the advantage of being traded in the larger markets, they have to pay a higher interest rate to attract investors, and for that reason, they're commonly called high-yield bonds. Bonds offered by these companies are derided by some brokers as not being investment grade, yet many of them are excellent performers. In fact, they have become an important part of the American economy because they are the backbone of new industry. The most successful companies of the future will be found among their ranks. During the last decade, while the Fortune 500 companies were shrinking and eliminating 3.6 million jobs, this segment of new industry has been growing and has created 18 million new jobs. Not all new companies are good investments. The same is true of older companies. But the small company sector generally provides more jobs, has greater profit margins, and pays more dividends than the so-called investment-grade companies. For 1981 to 1991, the average return on 10-year Treasury bills was 10.4%. The Dow Jones Industrial Average was 12.9%, and the average return on so-called junk bonds was 14.1%. Because of this higher yield, they attracted more than $180 billion from savvy investors, some of whom were S&Ls. It was basically a new market which was orchestrated by an upstart, Michael Milken, at the California-based Drexel Burnham Lambert brokerage house. Capital growth without bank loans, or inflation. One of the major concerns at Jekyll Island in 1910 was the trend to obtain business growth capital from sources other than bank loans. Here, 70 years later, the same trend was developing again in a slightly different form. Capital, especially for small companies, was now coming from bonds which Drexel had found a way to mass market. In fact, Drexel was even able to use those bonds to engineer corporate takeovers, an activity that previously had been reserved for the mega investment houses. By 1986, Drexel had become the most profitable investment bank in the country. Here was $180 billion that no longer was being channeled through Wall Street. Here was $180 billion that was coming from people's savings instead of being created out of nothing by the banks. In other words, here was growth built upon real investment, not inflation. Certain people were not happy about it. Glenn Yago, director of the Economic Research Bureau and associate professor of management at the State University of New York at Stony Brook, explains the problem. It was not until high-yield securities were applied to restructuring through deconglomeration and takeovers that hostilities against the junk bond market broke out. The high-yield market grew at the expense of bank debt, and high-yield companies grew at the expense of the hegemony of many established firms. As Peter Possehl noted in the New York Times, the impact was first felt on Wall Street, where sharp elbows and a working knowledge of computer spreadsheets suddenly counted more than a nose for dry sherry or membership in Skull and Bones. 1. The first line of attack on this new market of high-yield bonds was to call them junk. The word itself was powerful. The financial media picked it up, and many investors were frightened away. The next step was for compliant politicians to pass a law requiring S&Ls to get rid of their junk, supposedly to protect the public. That this was a hoax is evident by the fact that only 5% ever held any of these bonds, and their holdings represented only 1.2% of the total S&Ls assets. Furthermore, the bonds were performing satisfactorily and were a source of much-needed revenue. Nevertheless, the Financial Institutions Reform and Recovery Act, which was discussed previously, was passed in 1989. It forced S&Ls to liquidate at once their junk bond holdings. That caused their prices to plummet, and the thrifts were even further weakened as they took a loss on the sale. Jane Ingram comments, "Overnight, profitable S&Ls were turned into government-owned basket cases in the hands of the Resolution Trust Corporation, RDC. To add to the disaster, the RDC itself, which became the country's biggest owner of junk bonds, flooded the market again with $1.6 billion of its holdings at the market's bottom in 1990. So it was government itself that crashed the junk bond market, not Michael Milken, although the jailed Milken and other former officials of Drexel Burnham Lambert have just agreed to a $1.3 billion settlement of the hundreds of lawsuits brought against them by government regulators, aggrieved investors, and others demanding justice. 1. Incidentally, these bonds have since recovered, and had the S&Ls been allowed to keep them, they would be in better financial condition today. And so would be the RDC. With the California upstarts out of the way, it was a simple matter to buy up the detested bonds at bargain prices and to bring control of the new market back to Wall Street. The New York firm of Salomon Brothers, for example, one of Drexel's most severe critics during the 1980s, is now a leading trader in the market Drexel created. Real problem is government regulation. So the real problem within the savings and loan industry is government regulation, which has insulated it from the free market and encouraged it to embark upon unsound business practices. As the Wall Street Journal stated on March 10, 1992, if you're going to wreck a business the size of the U.S. thrift industry, you need a lot more power than Michael Milken ever had. You need the power of national political authority the kind of power possessed only by regulators and Congress. Whatever hold Milken or junk bonds may have had on the SNLS, it was nothing compared with the interventions of Congress. At the time this book went to press, the number of SNLS that operated during the 1980s had dropped to less than half. As failures, mergers, and conversion into banks continue, the number will decline further. Those that remain fall into two groups: those that have been taken over by the RDC and those that have not. Most of those that remain under private control, and that is a relative term in view of the regulations they endure, are slowly returning to a healthy state as a result of improved profitability, asset quality, and capitalization. The RDC-run organizations, on the other hand, continue to hemorrhage due to failure by Congress to provide funding to close them down and pay them off. Losses from this group are adding $6 billion per year to the ultimate cost of bailout. President Clinton was asking Congress for an additional $45 billion and hinting that this should be the last bailout, but no promises. The game continues. Congress is paralyzed, with good reason. Congress seems disinterested and paralyzed with inaction. One would normally expect dozens of politicians to be calling for a large-scale investigation of the ongoing disaster, but there is hardly a peep. The reason becomes obvious when one realizes that savings and loan associations, banks, and other federally regulated institutions are heavy contributors to the election campaigns of those who write the regulatory laws. A thorough public investigation would undoubtedly turn up some cozy relationships that the legislators would just as soon keep confidential. The second reason is that any honest inquiry would soon reveal the shocking truth that Congress itself is the primary cause of the problem. By following the socialist path and presuming to protect or benefit their constituency, they have suspended and violated the natural laws that drive a free market economy. In so doing, they created a Frankenstein monster they could not control. The more they tried to tame the thing, the more destructive it became. As economist Hans Sennholz has observed, the real cause of the disaster is the very financial structure that was fashioned by legislators and guided by regulators. They together created a cartel that, like all other monopolistic concoctions, is playing mischief with its victims. Point one. A cartel within a cartel. Sennholz has chosen exactly the right word: cartel. The savings and loan industry is really a cartel within a cartel. It could not function without Congress standing by to push unlimited amounts of money into it. And Congress could not do that without the banking cartel called the Federal Reserve System standing by as the lender of last resort to create money out of nothing for Congress to borrow. This comfortable arrangement between political scientists and monetary scientists permits Congress to vote for any scheme it wants, regardless of the cost. If politicians try to raise that money through taxes, they will be thrown out of office. But being able to borrow it from the Federal Reserve System upon demand allows them to collect it through the hidden mechanism of inflation, and not one voter in 100 will complain. The thrifts have become the illegitimate half-breed children of the creature. And that is why the savings and loan story is included in this study. If America is to survive as a free nation, her citizens must become far more politically educated than they are at present. As a people, we must learn not to reach for every political carrot dangled in front of us. As desirable as it may be for everyone to afford a home, we must understand that government programs pretending to make that possible actually wreak havoc with our system and bring about just the opposite of what they promise. After 60 years of subsidizing and regulating the housing industry, how many young people today can afford a home? Tinkering with the laws of supply and demand, plus the hidden tax called inflation to pay for the tinkering, has driven prices beyond the reach of many and has wiped out the down payments of others. Without such costs, common people would have much more money and purchasing power than they do today, and homes would be well within their reach. Summary: our present-day problems within the savings and loan industry can be traced back to the Great Depression of the 1930s. Americans were becoming impressed by the theories of socialism and soon embraced the concept that it was proper for government to provide benefits for its citizens and to protect them against economic hardship. Under the Hoover and Roosevelt administrations, New government agencies were established, which purported to protect depots, it's in the SNLS, and to subsidize home mortgages for the middle class. These measures distorted the laws of supply and demand, and from that point forward, the housing industry was moved out of the free market and into the political arena. Once the pattern of government intervention had been established, there began a long, unbroken series of federal rules and regulations that were the source of windfall profits for managers, appraisers, brokers, developers, and builders. They also weakened the industry by encouraging unsound business practices and high-risk investments. When these ventures failed, and when the value of real estate began to drop, many SNLS became insolvent. The Federal Insurance Fund was soon depleted, and the government was confronted with its own promise to bail out these companies, but not having any money to do so. The response of the regulators was to create a counting gem mix whereby insolvent thrifts could be made to appear solvent and, thus, continue in business. This postponed the inevitable and made matters considerably worse. The failed SNLS continued to lose billions of dollars each month and added greatly to the ultimate cost of bailout, all of which would eventually have to be paid by the common man out of taxes and inflation. The ultimate cost is estimated at over $1 trillion. Congress appears to be unable to act and is strangely silent. This is understandable. Many representatives and senators are the beneficiaries of generous donations from the SNLS. But perhaps the main reason is that Congress itself is the main culprit in this crime. In either case, the politicians would like to talk about something else. In the larger view, the S&L industry is a cartel within a cartel. The fiasco could never have happened without the cartel called the Federal Reserve System standing by to create the vast amounts of bailout money pledged by Congress. Chapter 5. Nearer to the Heart's Desire. The 1944 meeting in Bretton Woods, New Hampshire, at which the world's most prominent socialists established the International Monetary Fund and the World Bank as mechanisms for eliminating gold from world finance. The hidden agenda behind the IMF/World Bank revealed as the building of world socialism, the role of the Federal Reserve in bringing that about. As we have seen, the game called Bailout has been played over and over again in the rescue of large corporations, domestic banks, and savings and loan institutions. The pretense has been that these measures were necessary to protect the public. The result, however, has been just the opposite. The public has been exploited as billions of dollars have been expropriated through taxes and inflation. The money has been used to make up losses that should have been paid by the failing banks and corporations as the penalty for mismanagement and fraud. While this was happening in our hometown stadium, the same game was being played in the international arena. There are two primary differences. One is that the amount of money at stake in the international game is much larger. Through a complex tangle of bank loans, subsidies, and grants, the Federal Reserve is becoming the lender of last resort for virtually the entire planet. The other difference is that, instead of claiming to be protectors of the public, the players have emblazoned across the backs of their uniforms, saviors of the world. Bretton Woods, an attack on gold. The game began an international meeting of financiers, politicians, and theoreticians held in July of 1944 at the Mount Washington Hotel in Bretton Woods, New Hampshire. Officially, it was called the United Nations Monetary and Financial Conference, but is generally referred to today as simply the Bretton Woods Conference. Two international agencies were created at that meet, the International Monetary Fund and its sister organization, the International Bank for Reconstruction and Development, commonly called the World Bank. The announced purposes of these organizations were admirable. The World Bank was to make loans to war-torn and underdeveloped nations so they could build stronger economies. The International Monetary Fund, IMF, was to promote monetary cooperation between nations by maintaining fixed exchange rates between their currencies. But the method by which these goals would be achieved was less admirable. It was to terminate the use of gold as the basis of international currency exchange and replace it with a politically manipulated paper standard. In other words, It was to allow governments to escape the discipline of gold so they could create money out of nothing without paying the penalty of having their currencies drop in value on world markets. Prior to this conference, currencies were exchanged in terms of their gold value, and the arrangement was called the Gold Exchange Standard. This is not the same as a gold standard, in which a currency is backed by gold. It was merely that the exchange ratios of the various currencies, most of which were not backed by gold, were determined by how much gold they could buy in the open market. Their values, therefore, were set by supply and demand. Politicians and bankers hated the arrangement because it was beyond their ability to manipulate. In the past, it had served as a remarkably efficient mechanism, but it was a strict disciplinarian. As John Kenneth Galbraith observed, the Bretton Woods arrangements sought to recapture the advantages of the gold standard, currencies that were exchangeable at stable and predictable rates into gold, and thus at stable and predictable rates into each other. And this it sought to accomplish while minimizing the pain imposed by the gold standard on countries that were buying too much, selling too little, and thus losing gold. The method by which this was to be accomplished was exactly the method devised on Jekyll Island to allow American banks to create money out of nothing without paying the penalty of having their currencies devalued by other banks. It was the establishment of a world central bank which would create a common fiat money for all nations and then require them to inflate together at the same rate. There was to be a kind of international insurance fund which would rush that fiat money to any nation that temporarily needed it to face down a run on its currency. It wasn't born with all these features fully developed, just as the Federal Reserve wasn't fully developed when it was born. That, nevertheless, was the plan, and it was launched with all the structures in place. The theoreticians who drafted this plan were the well-known Fabian socialist from England, John Maynard Keynes, and the Assistant Secretary of the U.S. Treasury, Harry Dexter White. The Fabian Society. The Fabians were an elite group of intellectuals who formed a semi-secret society for the purpose of bringing socialism to the world. Whereas communists wanted to establish socialism quickly through violence and revolution, the Fabians preferred to do it slowly through propaganda and legislation. The word socialism was not to be used. Instead, they would speak of benefits for the people, such as welfare, medical care, higher wages, and better working conditions. In this way, they planned to accomplish their objective without bloodshed and even without serious opposition. They scorned the communists, not because they disliked their goals, but because they disagreed with their methods. To emphasize the importance of gradualism, they adopted the turtle as the symbol of their movement. The three most prominent leaders in the early days were Sidney and Beatrice Webb and George Bernard Shaw. A stained glass window in the Beatrice Webb house in Surrey, England, is especially enlightening. Across the top appears the last line from Omar Khayyam. "Dear love, couldst thou and I with fate conspire to grasp this sorry scheme of things entire, would we not shatter it to bits, and then remold it nearer to the heart's desire?" Beneath the line, "remold it nearer to the heart's desire," the mural depicts Shaw and Webb striking the earth with hammers. Across the bottom, the masses kneel in worship of a stack of books advocating the theories of socialism. Thumbing his nose at the docile masses is H.G. Wells, who, after quitting the Fabians, denounced them as the new Machiavellians. The most revealing component, however, is the Fabian crest which appears between Shaw and Webb. It is a wolf in sheep's clothing. Communist moles. Harry Dexter White was America's chief technical expert and the dominant force of the conference. He eventually became the first executive director for the United States at the IMF. An interesting footnote to this story is that White was simultaneously a member of the Council on Foreign Relations, CFR, and a member of a communist espionage ring in Washington while he served as Assistant Secretary of the Treasury. And even more interesting is that the White House was informed of that fact when President Truman appointed him to his post. The FBI had transmitted to the White House detailed proof of White's activities on at least 2 separate occasions. Serving as the technical secretary at the Bretton Woods Conference was Virginius Frank Coe, a member of the same espionage ring to which White belonged. Coe later became the first secretary of the IMF. Thus, completely hidden from public view, there was a complex drama taking place in which the intellectual guiding lights at the Bretton Woods Conference were Fabian socialists and communists. Although they were in disagreement over method, they were in perfect harmony on goal: international socialism. There were undoubtedly other reasons for communists to be enthusiastic about the IMF and the World Bank, despite the fact that the Soviet Union elected at the time not to become a member. The goal of the organizations was to create a world currency, a world central bank, and a mechanism to control the economies of all nations. In order for these things to happen, the United States would of necessity have to surrender its dominant position. In fact, it would have to be reduced to just one part of the collective whole. That fit in quite nicely with the Soviet plan. Furthermore, the World Bank was seen as a vehicle for moving capital from the United States and other industrialized nations to the underdeveloped nations, the very ones over which Marxists have always had the greatest control. They looked forward to the day when we would pay their bills. It has all come to pass. IMF structure and funding. The International Monetary Fund appears to be a part of the United Nations, much as the Federal Reserve System appears to be a part of the United States government, but it is entirely independent. It is funded on a quota basis by its member nations, almost 200 in number. The greatest share of capital, however, comes from the more highly industrialized nations such as Great Britain, Japan, France, and Germany. The United States contributes the most, at about 20% of the total. In reality, that 20% represents about twice as much as the number indicates, because most of the other nations contribute worthless currencies which no one wants. The world prefers dollars. One of the routine operations at the IMF is to exchange worthless currencies for dollars so the weaker countries can pay their international bills. This is supposed to cover temporary cash flow problems. It is a kind of international FDIC which rushes money to a country that has gone bankrupt so it can avoid devaluing its currency. The transactions are seldom paid back. Although escape from the gold exchange standard was the long-range goal of the IMF, the only way to convince nations to participate at the outset was to use gold itself as a backing for its own money supply, at least as a temporary expedient. As Keynes explained it, I felt that the leading central banks would never voluntarily relinquish the then existing forms of the gold standard, and I did not desire a catastrophe sufficiently violent to shake them off involuntarily. The only practical hope lay, therefore, in a gradual evolution in the forms of a managed world currency. Taking the existing gold standard as a starting point. Point 1, it was illegal for American citizens to own gold at that time. But everyone else in the world could exchange their paper dollars for gold at a fixed price of $35 per ounce. That made it the de facto international currency because, unlike any other at the time, its value was guaranteed. So, at the outset, the IMF adopted the dollar as its own international monetary unit. Paper gold. But the Fabian turtle was crawling inexorably toward its destination. In 1970, the IMF created a new monetary unit called the SDR, or Special Drawing Right. The media optimistically described it as paper gold, but it was pure bookkeeping wizardry with no relationship to gold or anything else of tangible value. SDRs are based on credits, which are provided by the member nations. These credits are not money. They are merely promises that the government will get the money by taxing their own citizens should the need arise. The IMF considers these to be assets, which then become the reserves from which loans are made to other governments. As we shall see in Chapter 10, this is almost identical to the bookkeeping sleight of hand that is used to create money out of nothing at the Federal Reserve System. Dennis Turner cuts through the garbage. SDRs are turned into loans to third world nations by the creation of checking accounts in the commercial or central banks of the member nations in the name of the debtor governments. These bank accounts are created out of thin air. The IMF creates dollars, francs, pounds, or other hard currencies and gives them to a third world dictator, with inflation resulting in the country where the currency originated. Inflation is caused in the industrialized nations while wealth is transferred from the general public to the debtor country, and the debtor doesn't repay. When the IMF was created, It was the vision of Fabian socialist John Maynard Keynes that there be a world central bank issuing a reserve currency called the Bancor to free all governments from the discipline of gold. With the creation of SDRs, the IMF had finally begun to fulfill that dream. Gold is finally abandoned. But there was still an obstacle. As long as the dollar was the primary currency used by the IMF, and as long as it was redeemable in gold at $35 per ounce, the amount of international money that could be created would be limited. If the IMF were to function as a true world central bank with unlimited issue, the dollar had to be broken away from its gold backing as a first step toward replacing it completely with a Bancor, an SDR, or something else equally free from restraint. On August 15, 1971, President Nixon signed an executive order declaring that the United States would no longer redeem its paper dollars for gold. So ended the first phase of the IMF's metamorphosis. It was not yet a true central bank because it could not create its own world currency. It had to depend on the central banks of its member nations to provide cash and so-called credits. But since these banks themselves could create as much money as they wished from now on, there would be no limit. The original purpose had been to maintain fixed rates of exchange between currencies. But the IMF has presided over more than 200 currency devaluations. In private industry, a failure of that magnitude might be cause for going out of business, but not in the world of politics. The greater the failure, the greater the pressure to expand the program. So, when the dollar broke loose from gold and there was no longer a ready standard for measuring currency values, the IMF merely changed its goal and continued to expand its operation. The new goal was to overcome trade deficits. Trade deficits. The topic of trade deficits is a favorite among politicians, economists, and talk show hosts. Everyone agrees they are bad, but there is much disagreement over what causes them. Let's have a try at it. A trade deficit is a condition that exists when a country imports a greater value of goods than it exports. In other words, it spends more than it earns in international trade. This is similar to the situation of an individual who spends more than he earns. In both cases, the process cannot be sustained unless 1. Earnings are increased. 2. Money is taken out of savings. 3. Assets are sold. 4. Money is counterfeited. Or 5. Money is borrowed. Unless one of these occurs, the individual or the country has no choice but to decrease spending. Increasing one's earnings is the best solution. In fact, it is the only solution for the long haul. All else is temporary at best. An individual can increase his income by working harder or smarter or longer. A country does it the same way. But it cannot happen unless private industry is allowed to flourish in a system of free enterprise. The problem with this option is that few politicians respect the dynamic power of the free enterprise system. Their world is built upon political programs in which the laws of the free market are manipulated to achieve politically popular goals. They may desire the option of increasing the nation's income by increasing its productivity, but their political agenda prevents that from happening. Point 1. The second option is to obtain extra money out of savings. But there are virtually no governments in the world today that have any savings. Their debts and liabilities exceed assets by a large margin. Likewise, most of their industries and their citizens are in a similar position. Their savings already have been consumed by government. The third option, the selling of assets, also is not available for most countries. By assets, we mean tangible items other than merchandise, which is normally for sale. Although these two are assets in the broad meaning, in accounting methodology, they are classified as inventory. The only government asset that is readily marketable is gold, and few countries today have a stockpile from which to draw. Even in those cases, what little they have is already owed to another government or a bank. As for private assets, nations can, for a while, sell these to foreign buyers and offset their negative trade balances. That is what has been happening in the United States for many years as office buildings, stocks, factories, and entire companies have been sold to foreign investors. But the fact remains that the nation is still spending more than it earns, and that process cannot continue indefinitely. Foreign ownership and control over industry and commerce also creates sociological and political problems. Underdeveloped countries do not have to worry about any of that, however, because they have few private assets to sell. The counterfeit option. The counterfeit option is available only if a country happens to be in the unique position of having its currency accepted as the medium of international trade, as has been the case for the United States. In that event, it is possible to create money out of nothing, and other nations have no choice but to accept it. Thus, for years, the United States has been able to spend more money than it earned in trade by having the Federal Reserve create whatever it needed. When the dollar was separated entirely from gold in 1971, it ceased being the official IMF world currency and finally had to compete with other currencies, primarily the mark and the yen, on the basis of its relative merit. From that point forward, its value increasingly became discounted. Nevertheless, it was still the preferred medium of exchange. Also, the U.S. was one of the safest places in the world to invest one's money. But to do so, one first had to convert his native currency into dollars. These facts gave the U.S. dollar greater value on international markets than it otherwise would have merited. So, in spite of the fact that the Federal Reserve was creating huge amounts of money during this time, the demand for it by foreigners was seemingly limitless. The result is that America has continued to finance its trade deficit with fiat money. Counterfeit, if you will, a feat which no other nation in the world could hope to accomplish. We have been told that our nation's trade deficit is terrible and that it would be better to weaken the dollar to bring an end. Weakening the dollar is a euphemism for increasing inflation. In truth, America is not hurt by a trade deficit at all. And we are the benefactors while our trading partners are the victims. We get the cars and TV sets while they get the funny money. We get the hardware. They get the paperware. There is a dark side to the exchange, however. As long as the dollar remains in high esteem as a trade currency, America can continue to spend more than it earns. But when the day arrives, as it certainly must, when the dollar tumbles and foreigners no longer want it, the free ride will be over. When that happens, hundreds of billions of dollars are now resting in foreign countries will quickly come back to our shores as people everywhere in the world attempt to convert them into yet more real estate, factories, and tangible products, and to do so as quickly as possible before they become even more worthless. As this flood of dollars bids up prices, we will finally experience the inflation that should have been caused in years past, but which was postponed because foreigners were kind enough to take the dollars out of our economy in exchange for their products. The chickens will come home to roost. But when they do, it will not be because of the trade deficit. It will be because we were able to finance the trade deficit with fiat money created by the Federal Reserve. If it were not for that, the trade deficit could not have happened. Back to the main topic, which is the 5 methods by which a trade deficit can be paid. Through the process of elimination, the 4th option of borrowing is where the action is today for most of the world, and that is where the IMF positioned itself in 1970. Its new mission was to provide loans so countries can continue to spend more than they earn, but to do so in the name of overcoming trade deficits. IMF loans, doomed but sweet. These loans do not go into private enterprises where they have a chance of being turned for a profit. They go into state-owned and state-operated industries, which are constipated by bureaucracy and poisoned by corruption. Doomed to economic failure from the start, they consume the loans with no possibility of repayment. Even the interest quickly becomes too much to handle, which means the IMF must fall back to the reserves, back to the assets, back to the credits, and eventually back to the taxpayers to bail them out. Whereas the International Monetary Fund is evolving into a world central bank, which eventually will issue a world currency based on nothing. Its sister organization, the World Bank, has become its lending agency. Acting as savior of the world, it seeks to aid the underdeveloped nations, to feed the hungry, and to bring a better life to all mankind. In pursuit of these humanitarian goals, it provides loans to governments at favorable terms, usually at rates below market, for terms as long as 50 years, and often with no payments due until after 10 years. Funding for these loans comes from member states in the form of a small amount of cash, plus promises to deliver about 10 times more if the bank gets into trouble. The promises, described as callable capital, constitute a kind of FDIC insurance program, but with no pretense at maintaining a reserve fund. In that sense, it is more honest than the real FDIC, which does maintain the pretense, but, in reality, is based on nothing more than a similar promise. Based upon the small amount of seed money, plus the far greater amount of credits and promises from governments of the industrialized countries, the World Bank is able to go into the commercial loan markets and borrow larger sums at extremely low interest rates. After all, the loans are backed by the most powerful governments in the world, which have promised to force their taxpayers to make the payments if the bank should get into trouble. It then takes these funds and relends them to the underdeveloped countries at slightly higher rates, making a profit on the arbitrage. The unseen aspect of this operation is that the money it processes is money which, otherwise, would have been available for investment in the private sector or as loans to consumers. It siphons off much-needed development capital for private industry, prevents new jobs from being created, causes interest rates to rise, and retards the economy at large. The hidden agenda: world socialism. Although most of the policy statements of the World Bank deal with economic issues, a close monitoring of its activities reveal a preoccupation with social and political issues. This should not be surprising considering that the bank was perceived by its founders as an instrument for social and political change. The change which it was designed to bring about was the building of world socialism, and that is exactly what it is accomplishing today. This hidden agenda becomes crystal clear in the nature of what the bank calls sectoral loans and structural adjustment loans. In the first category, only part of the money is to be used for the costs of specific projects, while the rest goes to support policy changes in the economic sector. In the second group, all of the money is for policy changes and none of it is for projects. In recent years, almost half of the loans to underdeveloped countries have been in that category. What are the policy changes that are the object of these loans? They add up to one thing: the building of world socialism. As the Fabians had planned it, the word socialism is not to be used. Instead, the loans are issued for government hydroelectric projects, government oil refineries, government lumber mills, government mining companies, and government steel plants. It is delivered from the hands of politicians and bureaucrats into the hands of other politicians and bureaucrats. When the money comes from government, goes to government, and is administered by government, the result will be the expansion of government. Here is an example. One of the policy changes often required by the World Bank as a condition of granting a loan is that the recipient country must hold down its wages. The assumption is that the government has the power, and rightfully should have the power, to set wages. In other words, one of the conditions of its loan is that the state must be omnipotent. Paul Roberts holds the William E. Simon Chair of Political Economy at the Center for Strategic and International Studies in Washington. Writing in Business Week, he says, "The entire development process has been guided by the belief that reliance on private enterprise and equity investment is incompatible with economic and social progress. In place of such proven avenues of success, development planning substituted loans and foreign aid so that governments of the LDCs, less developed countries, could control economic activity in keeping with plans drawn up by experts. Consequently, economic life in the LDCs was politicized from start. By endowing governments with extensive control over their economies, the U.S. set up conditions exactly opposite to those required for economic growth." Ken Ewart explains further that the conditions imposed by the fund are seldom free market-oriented. He says, "The fund concentrates on macro policies, such as fiscal and monetary policies or exchange rates, and pays little attention to fundamental issues like private property rights and freedom of enterprise. Implicit is the belief that with proper macro management, any economic system is viable. Even more important, it has allowed governments the world over to expropriate the wealth of their citizens more efficiently through the hidden tax of inflation, while at the same time aggrandizing their own power. There is little doubt that the IMF is an influence for worldwide socialism. Point one, an important feature of the structural adjustment loans is that the money need not be applied to any specific development project. It can be spent for anything the recipient wishes. That includes interest payments on overdue bank loans. Thus, The World Bank becomes yet one more conduit from the pockets of taxpayers to the assets of commercial banks, which have made risky loans to third-world countries. Austerity measures and scapegoats. Not every measure advocated by the IMF and World Bank is socialistic. Some of them even appear to be in support of the private sector, such as the reduction of government subsidies and welfare. They may include tax increases to reduce budget deficits. These policy changes are often described in the press as austerity measures, and they are seen as hard-nosed business decisions to salvage the failing economies of underdeveloped countries. But as the wolf in sheep's clothing said to Little Red Riding Hood, "All the better to fool you with, my dear." These austerity measures are meatly rhetoric. The borrowing nations usually ignore the conditions with impunity, and the World Bank keeps the money coming anyway. It's all part of the game. Nevertheless, the structural adjustment conditions provide a scapegoat for local politicians who can now place the blame for their nation's misery on big, bad capitalists from America and the IMF. People who have been taught that it is government's role to provide for their welfare, their health care, their food and housing, their jobs and retirement. Such people will not be happy when they hear that these rights are being threatened. So they demonstrate in the streets and protest. They riot in the commercial sections of town so they can steal goods from stores, and they throng to the banner of leftist politicians who promise to restore or increase their benefits. As described by Insight magazine, national strikes, riots, political upheavals, and social unrest in Argentina, Bolivia, Brazil, Ecuador, Egypt, Haiti, Liberia, Peru, Sudan, and elsewhere have at various times been attributed to IMF austerity programs. An honest reading of the record shows that the IMF, far from being a force for austerity in these countries, has been an engine of socialist waste and a fountain of abundance for the corrupt leaders who rule. Financing corruption and despotism. Nowhere is this pattern more blatant than in Africa. Julius Nyerere, the dictator of Tanzania, is notorious for his villagization program in which the army has driven the peasants from their land, burned their huts, and loaded them like cattle into trucks for relocation into government villages. The purpose is to eliminate opposition by bringing everyone into compounds where they can be watched and controlled. Meanwhile, the economy staggers, farms have gone to weed, and hunger is commonplace. Yet, Tanzania has received more aid per capita from the World Bank than any other nation. In Uganda, government security forces have engaged in mass detentions, torture, and killing of prisoners. The same is true under the terrorist government in Zimbabwe. Yet, both regimes continue to be the recipients of millions of dollars in World Bank funding. Zimbabwe, formerly Rhodesia, is a classic case. After its independence, the leftist government nationalized, confiscated many of the farms previously owned by white settlers. The most desirable of these lands became occupied by the government's senior ruling party officials, and the rest were turned into state-run collectives. They were such miserable failures that the workers on these farmlands were, themselves, soon begging for food. Not daunted by these failures, the socialist politicians announced in 1991 that they were going to nationalize half of the remaining farms as well. And they barred the courts from inquiring into how much compensation would be paid to their owners. The IMF was represented in Zimbabwe at the time by Michel Camdesis, the governor of the Central Bank of France, and a former finance minister in François Mitterrand's socialist government. After being informed of Zimbabwe's plan to confiscate additional land and to resettle people to work on those lands, Camdesis agreed to a loan valued at 42 billion rands with full knowledge that much of it would be used for the resettlement project. Perhaps the worst violations of human rights have occurred in Ethiopia under the Marxist regime of Mengistu Haile Mariam. The famine of 1984-85, which threatened the lives of millions of people, was the result of government nationalization and disruption of agriculture. Massive resettlement programs have torn hundreds of thousands of people from their privately owned land in the north and deported them to concentration camp villages in the south, complete with guard towers. A report by a French voluntary medical assistance group, Doctors Without Borders, reveals that the forced resettlement program may have killed as many people as the famine itself. One Dr. Ronnie Brauman, director of the organization, describes their experience. Armed militiamen burst into our compounds, seized our equipment, and menaced our volunteers. Some of our employees were beaten, and our trucks, medicines, and food stores confiscated. We left Ethiopia branded as enemies of the revolution. The regime spoke the truth. The atrocities committed in the name of Mengistu's master plan did make us enemies of the revolution. Financing famine and genocide. In the 1980s, the world was saddened by photographs of starving children in Ethiopia, but what the West did not realize was that this was a planned famine. It was modeled after Stalin's starvation program in the Ukraine in the 1930s and Mao's starvation of the peasants in the 40s. Its purpose was to starve the population into total submission to the government, for it is the government which decides who will eat and who will not. Yet, right up to the time Mengistu was overthrown, the World Bank continued to send him hundreds of millions of dollars, with much of it going specifically to the Ministry of Agriculture, the very agency in charge of the resettlement program. In the late 1970s, the same story unfolded in communist Vietnam. There were resettlement programs, forced collectivization, concentration camps, atrocities, and tens of thousands of dissidents escaping to the sea only to drown in overcrowded, leaky boats. Throughout it all, the regime was generously funded by the World Bank. Laos has jailed thousands of political prisoners. Syria has massacred 20,000 members of its opposition. Indonesia has uprooted several million people from their homelands in Java. The Sandinistas in Nicaragua murdered their opposition and terrorized the nation into submission. Poland, while a puppet state of the Soviet Union, brutally suppressed its trade union movement. China massacred its dissident students and imprisoned its religious leaders, and the former Soviets slaughtered civilians in Afghanistan while conducting a relentless espionage war against the entire free world. Yet, these regimes have been the recipient of literally billions of dollars from the World Bank. How can the bank's managers continue in conscience to fund such genocidal regimes? Part of the answer is that they are not permitted to have a conscience. David Dunn, head of the bank's Ethiopia desk, explained, "Political distinctions are not something our charter allows us to take into account." The greater part of the answer, however, is that all socialist regimes have the potential for genocide, and the bank is committed to socialism. The brutalities of these countries are all in a day's work for serious socialists who view them as merely unfortunate necessities for the building of their utopia. Lenin said you cannot make an omelet without cracking a few eggs. George Bernard Shaw, one of the early leaders of the Fabian socialist movement, expressed it this way: under socialism, you would not be allowed to be poor. You would be forcibly fed, clothed, lodged, taught, and employed whether you liked it or not. If it were discovered that you had not character and industry enough to be worth all this trouble, you might possibly be executed in a kindly manner. But whilst you were permitted to live, you would have to live well. Reason to abolish the Federal Reserve. The top echelon at the World Bank are brothers under the skin to the socialist dictators with whom they do daily business. Under the right circumstances, they could easily switch roles. What we have seen is merely a preview of what can be expected for the entire world if the envisioned New World Order becomes operational. The IMF/World Bank is the protege of the Federal Reserve. It would not exist without the flow of American dollars and the benevolence of American leadership. The Fed has become an accomplice in the support of totalitarian regimes throughout the world. As stated at the beginning of this study, that is one of the reasons it should be abolished. It is an instrument of totalitarianism, getting rich fighting poverty. While the top leaders and theoreticians at the IMF and World Bank dream of world socialism, the middle managers and political rulers have more immediate goals in mind. The bureaucracy enjoys a plush life administering the process, and the politicians on the receiving end obtain wealth and power. Ideology is not their concern. Socialism, capitalism, fascism, it makes no difference to them as long as the money flows. Graham Hancock has been an astute observer of the international aid industry and has attended their plush conferences. He knows many of the leading players personally. In his book, Lords of Poverty, he speaks of the IMF's structural adjustment loans. Corrupt ministers of finance and dictatorial presidents from Asia, Africa, and Latin America are tripping over their own expensive footwear in their unseemly haste to get adjusted. For such people, money has probably never been easier to obtain than it is today. With no complicated projects to administer and no messy accounts to keep, the venal, the cruel, and the ugly are laughing literally all the way to the bank. For them, structural adjustment is like a dream come true. JSJ zero sacrifices are demanded of them personally. All they have to do, amazing but true, is screw the poor, and they've already had plenty of practice at that point when in India, the World Bank funded the construction of a dam that displaced 2 million people, flooded 360 square miles, and wiped out 81,000 acres of forest cover. In Brazil, it spent $1 billion to develop a part of the Amazon basin and to fund a series of hydroelectric projects. It resulted in the deforestation of an area half the size of Great Britain and has caused great human suffering because of resettlement. In Kenya, the Bura irrigation scheme caused such desolation that a fifth of the native population abandoned the land. The cost was $50,000 per family served. In Indonesia, the transmigration program mentioned previously has devastated tropical forests, at the same time that the World Bank is funding reforestation projects. The cost of resettling one family is $7,000, which is about 10 times the Indonesian per capita income. Livestock projects in Botswana led to the destruction of grazing land and the death of thousands of migratory animals. This resulted in the inability of the natives to obtain food by hunting, forcing them into dependence on the government for survival. While Nigeria and Argentina are drowning in debt, billions from the World Bank have gone into building lavish new capital cities to house government agencies and the ruling elite. In Zaire, Mexico, and the Philippines, political leaders became billionaires while receiving World Bank loans on behalf of their nations. In the Central African Republic, IMF and World Bank loans were used to stage a coronation for its emperor. The record of corruption and waste is endless. But the real eye-opener is in the failure of socialist ventures, those magnificent projects which are to bring prosperity to the underdeveloped countries. Here are just a few examples. Converting money into failure. Before receiving loans from the World Bank, Tanzania was not wealthy, but it fed its own people, and it had economic growth after receiving more than $3 billion in loans. It nationalized the nation's farms and industries and converted every business into a government agency. It built a truck assembly plant, a tire factory, electronic factories, highways, ports, railways, and dams. Tanzania's industrial production and agricultural output fell by almost one-third. Food was the main export in 1966. Under socialism, food had to be imported, paid for by foreign aid, and more loans from the World Bank. The country is hopelessly in debt with no way to repay. Argentina once had one of the highest standards of living in Latin America. But then it became the recipient of massive loans from the World Bank, as well as commercial banks in the United States. Since the money was given to politicians, it was used to build the only system politicians know how to build, socialism. By 1982, the gross national product was in a nosedive. Manufacturing had fallen to less than half of capacity. Thousands of privately owned companies had been forced into bankruptcy. Unemployment was soaring, and so was welfare. By 1989, inflation was running at an average of 5,000%, and, in the summer of that year, topped at 1,000,000%. Banks were offering interest rates of 600% per month in hopes of keeping deposits from being moved out of the country. People were rioting in the streets for food, and the government was blaming greedy shop owners for raising prices. The nation was hopelessly in debt with no way to repay. Brazil is run by the military, and the state controls the economy. Government-owned companies consume 65% of all industrial investment, which means that the private sector is limited to 35% and is shrinking. The government used loans from U.S. banks to create an oil company, Petróleo Brasileiro S.A., which became Latin America's largest corporation. Despite huge oil deposits and record-high oil prices, the company operated at a loss and was not even able to produce enough gasoline for its own citizens. By 1990, inflation was running at 5,000%. Since 1960, its prices had risen to 164,000 times their original level. A new crime was invented called hedging against inflation, and people were arrested for charging the free market price for their goods and for using dollars or gold as money. Led by communist organizers, mobs roamed the streets shouting, "We're hungry. Steal what you will." The nation was hopelessly in debt with no way to repay. The experience in Mexico was a carbon copy of that in Brazil, except that the amount of money was larger. When the world's fourth largest oil reserves were discovered, Mexican politicians reached for the brass ring. With billions borrowed from U.S. banks, they launched Petróleos Mexicanos, Pemex, and soon became the world's fifth largest oil producer. They also built chemical plants and railroads, and launched many other industrial projects. These were run as welfare agencies instead of businesses. Too many people on the payroll, too many managers, excessive salaries, too many holidays, and unrealistic benefits. The ventures floundered and lost money. Private businesses failed by the thousands, and unemployment rose. The government increased the minimum wage, causing more businesses to fail and more unemployment. That led to more welfare and unemployment benefits. To pay for that, the government borrowed even more and began creating its own fiat money. Inflation destroyed what was left of the economy. Price controls were next, along with rent and food subsidies and doubling the minimum wage. By 1982, Mexicans were trading their pesos for dollars and sending their savings out of the country, as the peso became all but worthless in Commerce Point 1 in 1981. The average wage for Mexican workers was 31% of the average wage for Americans. By 1989, it had fallen to 10%. Mexico, once one of the major food exporters in the world, was now required to import millions of dollars worth of food grains. This required still more money and more loans. All this occurred while oil prices were high and production was booming. A few years later, when oil prices fell, the failures and shortfalls became even more dramatic. In 1995, Mexico's bank loans were once again on the brink of default, and once again, U.S. taxpayers were thrown into the breach by Congress to cover more than $30 billion at risk. Although this loan was eventually repaid, the money to do so was extracted from the Mexican people through another round of massive inflation, which plunged their standard of living even lower. The nation is now hopelessly mired in socialism. The Communist Party, promising reform and still more socialism, is attracting a large following and could become a potent political force. Thus, the saga continues. After pouring billions of dollars into underdeveloped countries around the globe, no development has taken place. In fact, we have seen just the opposite. Most countries are worse off than before the saviors of the world got to them. Summary: the IMF and the World Bank were created at a meeting of global financiers and politicians held at Bretton Woods, New Hampshire, in 1944. Their announced goals were to facilitate international trade and to stabilize the exchange rates of national currencies. The unannounced goals were quite different. They were the elimination of the gold exchange standard as the basis of currency valuation and the establishment of world socialism. The method by which gold was to be eliminated in international trade was to replace it with a world currency, which the IMF, acting as a world central bank, would create out of nothing. The method by which world socialism was to be established was to use the World Bank to transfer money, disguised as loans, to the governments of the underdeveloped countries, and to do so in such a way as to ensure the demise of free enterprise. The money was to be delivered from the hands of politicians and bureaucrats into the hands of other politicians and bureaucrats. When the money comes from government, goes to government, and is administered by government, the result will be the expansion of government. The theoreticians who dominated the conference at Bretton Woods were the well-known Fabian socialist from England, John Maynard Keynes, and the Assistant Secretary of the U.S. Treasury, Harry Dexter White. White became the first executive director for the United States at the IMF. The Fabians were an elite group of intellectuals who agreed with communists as to the goal of socialism, but disagreed over tactics. Whereas communists advocated revolution by force and violence, Fabians advocated gradualism and the transformation of society through legislation. It was learned in later years that Harry Dexter White was a member of a communist espionage ring. Thus, hidden from view, there was a complex drama taking place in which the two intellectual founders of the Bretton Woods Accords were a Fabian socialist and a communist, working together to bring about their mutual goal, world socialism. Capital for the IMF and the World Bank comes from the industrialized nations, with the United States putting up the most. Funds consist partly of hard currencies, such as the dollar, yen, mark, and franc, but these are augmented by many times that amount in the form of credits. These are merely promises by the member governments to get the money from their taxpayers if the bank gets into trouble with its loans. While the IMF is gradually evolving into a central bank for the World Bank is serving as its lending arm. As such, it has become the engine for transferring wealth from the industrialized nations to the underdeveloped countries. While this has lowered the economic level of the donating countries, it has not raised the level of the recipients. The money has simply disappeared down the drain of political corruption and waste. Chapter 6. Building the New World Order. The game called Bailout re-examined and shown to be far more than merely a means of getting taxpayers to foot the cost of bad loans. The final play revealed as the merger of all nations into world government. The unfolding of that strategy as applied to Panama, Mexico, Brazil, Argentina, China, Eastern Europe, and Russia. Let us return now to the game called Bailout. Everything in the previous chapter has been merely background information to understand the game as it is played in the international arena. Here, finally, are the rules. 1. Commercial banks in the industrialized nations, backed by their respective central banks, create money out of nothing and lend it to the governments of underdeveloped nations. They know that these are risky loans, so they charge an interest rate that is high enough to compensate. It is more than what they expect to receive in the long run. 2. When the underdeveloped nations cannot pay the interest on their loans, the IMF and World Bank enter the game as both players and referees. Using additional money created out of nothing by the central banks of their member nations, they advance development loans to the governments, which now have enough to pay the interest on the original loans with enough left over for their own political purposes. 3. The recipient country quickly exhausts the new supply of money, and the play returns to point number 2. This time, however, the new loans are guaranteed by the World Bank and the central banks of the industrialized nations. Now that the risk of default is removed, the commercial banks agree to reduce the interest to the point anticipated at the beginning. The debtor governments resume payments. 4. The final play is, well, in this version of the game there appears to be no final play, because the plan is to keep the game going forever. To make that possible, certain things must happen that are very final indeed. They include the conversion of the IMF into a world central bank, as Keynes had planned, which then issues an international fiat money. Once that bank of issue is in place, the IMF can collect unlimited resources from the citizens of the world through the hidden tax called inflation. The money stream then can be sustained indefinitely, with or without the approval of the separate nations, because they will no longer have money of their own. Since this game results in a hemorrhage of wealth from the industrialized nations, their economies are doomed to be brought down further and further, a process that has been going on since Bretton Woods. The result will be a severe lowering of their living standards and their demise as independent nations. The hidden reality behind so-called development loans is that America and other industrialized nations are being subverted by that process. Hint is not an accident. It is the essence of the plan. A strong nation is not likely to surrender its sovereignty. Americans would not agree to turn over their monetary system, their military, or their courts to a world body made up of governments which have been despotic to their own people, especially since most of those regimes have already revealed anti-American hostility. But if Americans can be brought to the point where they're suffering from a collapse of their economy and from a breakdown in civil order, things will be different. When they stand in bread lines and face anarchy in their streets, they will be more willing to give up sovereignty in return for assistance from the World Bank and the UN peacekeeping forces. This will become even more acceptable if a structured demise of communism can be arranged ahead of time to make it appear that the world's major political systems have converged into the common denominator of social democracy. The final play. The underdeveloped nations, on the other hand, are not being raised up. What is happening to them is that their political leaders are becoming addicted to the IMF cash flow and will be unable to break the habit. These countries are being conquered by money instead of arms. Soon they will no longer be truly independent nations. They are becoming mere components in the system of world socialism planned by Harry Dexter White and John Maynard Keynes. Their leaders are being groomed to become potentates in a new, high-tech feudalism, paying homage to their lords in New York. And they are eager to do it in return for privilege and power within the New World Order. That is the final play. The essence of socialism is redistribution of the wealth. The goal is equality, and that means taking from the rich and giving to the poor. At least that's the theory. Unfortunately, the poor are never benefited by this maneuver. They either do not get the money in the first place, too much is siphoned off by the bureaucracies which administer the programs, or if they do get any of it, they don't know what to do with it. They merely spend it until it is gone, and then no one has any money, except, of course, those who administer the government programs. Nevertheless, politicians know that promises to redistribute the wealth are popular among two groups: the voters who naively believe it will help the poor, and the socialist managers who see it as job security. Supported by these two voting blocs, election to office is assured. One of the early American advocates of socialism on a global scale, including the draining of wealth away from the rich United States, was John F. Kennedy. He undoubtedly learned the concept while attending the Fabian London School of Economics in 1935-36, just prior to his father's appointment as ambassador to England. When JFK became president, his political views continued to carry the imprint of that training. In September of 1963, he addressed the finance ministers and central bank governors from 102 nations at the annual meeting of the IMF/World Bank. He explained the concept of world socialism in glowing terms. 20 years ago, when the architects of these institutions met to design an international banking structure, the economic life of the world was polarized in overwhelming and even alarming measure on the United States. 60% of the gold reserves of the world were here in the United States. There was a need for redistribution of the financial resources of the world, and there was an equal need to organize a flow of capital to the impoverished countries of the world. All this has come about. It did not come about by chance, but by conscious and deliberate and responsible planning. CFR sets strategy. The brain trust for implementing the Fabian Plan in America is called the Council on Foreign Relations, CFR. We shall look at it closely in future chapters, but it is important to know at this point that almost all of America's leadership has come from this small group. That includes our presidents and their advisors, cabinet members, ambassadors, board members of the Federal Reserve System, directors of the largest banks and investment houses, presidents of universities, and heads of metropolitan newspapers, news services, and TV networks. It is not an exaggeration to describe this group as the hidden government of the United States. CFR members have never been shy about calling for the weakening of America as a necessary step toward the greater good of building world government. One of the CFR founders was John Foster Dulles, who later was appointed Secretary of State by CFR member Dwight Eisenhower. In 1939, Dulles said, "Some dilution or leveling off of the sovereignty system as it prevails in the world today must take place to the immediate disadvantage of those nations which now possess the preponderance of power. The establishment of a common money would deprive our government of exclusive control over national money. The United States must be prepared to make sacrifices afterward in setting up a world politico-economic order which would level off inequalities of economic opportunity with respect to nations." CFR member Zbigniew Brzezinski was the national security advisor to CFR member Jimmy Carter. In 1970, Brzezinski wrote, "Some international cooperation has already been achieved, but further progress will require greater American sacrifices. More intensive efforts to shape a new world monetary structure will have to be undertaken, with some consequent risk to the present relatively favorable American position." At the spring 1983 Economic Summit in Williamsburg, Virginia, President Ronald Reagan declared, "National economies need monetary coordination mechanisms, and that is why an integrated world economy needs a common monetary standard. But no national currency will do, only a world currency will work." The CFR strategy for convergence of the world's monetary systems was spelled out by Harvard professor Richard N. Cooper, a CFR member who had been the Undersecretary of State for Economic Affairs in the Carter administration. "I suggest a radical alternative scheme for the next century: the creation of a common currency for all of the industrial democracies, with a common monetary policy and a joint bank of issue to determine that monetary policy." HOW, can independent states accomplish that? They need to turn over the determination of monetary policy to a supranational body. Emphasis in original. It is highly doubtful whether the American public, to take just one example, could ever accept that countries with oppressive autocratic regimes should vote on the monetary policy that would affect monetary conditions in the United States. For such a bold step to work at all, it presupposes a certain convergence of political values. Phrases such as monetary coordination mechanisms, modern world economic order, convergence of political values, or New World Order are not very specific. To the average person, they sound pleasant and harmless. Yet, to the insiders of the club, they are code phrases which have a specific meaning: the termination of national sovereignty and the creation of world government. CFR member Richard Gardner, another advisor to President Carter, explains the meaning of these phrases and also call for the Fabian strategy of deception and gradualism. In short, the house of world order will have to be built from the bottom up. An end run around national sovereignty, eroding it piece by piece, will accomplish much more than the old-fashioned frontal assault. As for the programmed decline of the American economy, CFR member Samuel Huntington argues that if higher education is considered to be desirable for the general population, a program is then necessary to lower the job expectations of those who receive a college education. CFR member Paul Volcker, former chairman of the Federal Reserve, says the standard of living of the average American has to decline. I don't think you can escape that. By 1993, Volcker had become the U.S. chairman of the Trilateral Commission. The TLC was created by David Rockefeller to coordinate the building of the New World Order in accordance with the Gardner strategy, an end run around national sovereignty, eroding it piece by piece. The objective is to draw the United States, Mexico, Canada, Japan, and Western Europe into political and economic union. Under slogans such as free trade and environmental protection, each nation is to surrender its sovereignty piece by piece until a full-blown regional government emerges from the process. The new government will control each nation's working conditions, wages, and taxes. Once that has happened, it will be a relatively simple step to merge the regionals in a global government. That is the reality behind the so-called trade treaties within the European Union, EU, the North American Free Trade Agreement, NAFTA, the Asia-Pacific Economic Cooperation Agreement, APEC, and the General Agreement on Tariffs and Trade, GATT. They have little to do with trade. In the Trilateral Commission's annual report for 1993, Volcker explains, "Interdependence is driving our countries toward convergence in areas once considered fully within the domestic purview. Some of these are as involve government regulatory policy, such as environmental standards, the fair treatment of workers, and taxation." In 1992, the Trilateral Commission released a report co-authored by Toyo Gyoten, chairman of the board of the Bank of Tokyo and formerly Japan's Minister of Finance for International Affairs. Gyoten had been a Fulbright scholar who was trained at Princeton and taught at Harvard Business School. He also had been in charge of the Japan desk of the International Monetary Fund. In short, he represents the Japanese monetary interests within the New World Order. In this report, Giotin explains that the real importance of trade agreements is not trade, but the building of global government. Regional trade arrangements should not be regarded as ends in themselves, but as supplements to global liberalization. Regional arrangements provide models or building blocks for increased or strengthened globalism. Western Europe, the EU, represents regionalism in its truest form. The steps toward deepening, increasing the number of agreements, are dramatic and designed to be irreversible. A common currency, central bank, court, and parliament will have expanded powers. After the Maastricht summit, the Dutch town where the meeting was held, an economist editorial pronounced the verdict: call it what you will, by any other name it is federal government. In sum, the regional integration process in Europe can be seen as akin to an exercise in nation-building. Applying this same perspective to the NAFTA treaty, former Secretary of State Henry Kissinger, CFR, said it is not a conventional trade agreement, but the architecture of a new international system, the vital first step for a new kind of community of nations. The newspaper article that contained this statement was appropriately entitled, "With NAFTA, U.S. finally creates a new world order." David Rockefeller, CFR, was even more emphatic. He said that it would be criminal not to pass the treaty because everything is in place, after 500 years, to build a true new world in the Western Hemisphere. By early 1994, the drift toward the New World Order had become a rush. On April 15th, the government of Morocco placed a full-page ad in the New York Times celebrating the creation of the World Trade Organization, which was formed by the signing of the General Agreement on Tariffs and Trade (GATT), which took place in the Moroccan city of Marrakesh. While Americans were still being told that GATT was merely a trade agreement, the internationalists were celebrating a much larger concept. The ad spelled it out in unmistakable terms. 1944 Bretton Woods, the IMF and the World Bank 1945 San Francisco, the United Nations 1994 Marrakesh. The World Trade Organization history knows where it is going. The World Trade Organization, the third pillar of the New World Order, along with the United Nations and the International Monetary Fund. A rare glimpse into the inner workings. So much for the final play. Let us return now to the game called Bailout, as it is actually played today on the international scene. Let us begin with a glimpse into the inner workings of the presidential cabinet. James Watt was the Secretary of the Interior in the Reagan administration. In his memoirs, he described an incident at a cabinet meeting in the spring of 1982. The first items on the agenda were reports by Treasury Secretary Donald Reagan and Budget Director David Stockman concerning problems the less developed countries were having with their bank loans. Watt said, Secretary Reagan was explaining the inability of those destitute countries to pay even the interest on the loans that individual banks, such as Bank of America, Chase Manhattan, and Citibank had made. The president was being told what actions the United States must take to salvage the situation. After the Reagan and Stockman briefings, there were several minutes of discussion before I asked, does anyone believe that these less developed countries will ever be able to pay back the principal on these loans? When no one spoke up, I asked, if the loans are never going to be repaid, why should we again bail out the countries and arrange payment for their interest? The answer came from several voices at once. If we don't arrange for their interest payments, the loans will go into default, and it could put our American banks in jeopardy. Would the customers lose their money? No, came the answer, but the stockholders might lose dividends. In amazement, I leaned back in my large leather chair, only 2 seats from the President of the United States. I realized that nothing in the world could keep these high government officials from scrambling to protect and bail out a few very large and sorely troubled American banks. Panama. The first major score in the game had been made under the Carter administration when Panama fell in arrears on the payment of its loans. A consortium of banks, including Chase Manhattan, First National of Chicago, and Citibank, brought pressure to bear on Washington to give the canal to the Panamanian government so it could use the revenue to pay interest on its loans. Although there was massive opposition to this move among the American people, the Senate yielded to insider pressure and passed the giveaway treaty. The Panamanian government inherited $120 million in annual revenue, and the interest payments to the banks were restored. As Congressman Philip Crane observed, at the time of the Torrijos-backed coup in 1968, Panama's total official overseas debt stood at a manageable and, by world standards, modest $167 million. Under Torrijos, indebtedness has skyrocketed nearly 1,000% to a massive $1.5 billion. Debt service ratio now consumes an estimated 39% of the entire Panamanian budget. What it appears we really have here is not just aid to a tin-horn dictator in the form of new subsidies and canal revenues the treaties would give to the Torrijos regime, but a bailout of a number of banks which should have known better than to invest in Panama, and, in any event, should not escape responsibility for having done so. The Panama bailout was a unique play. In no other country did we have an income-producing property to give away. So from that point forward, the bailout would have to be done with mere money. To pave the way for that, Congress passed the Monetary Control Act of 1980, which authorized the Federal Reserve to monetize foreign debt. That is banker language, meaning that the Fed was now authorized to create money out of nothing for the purpose of lending to foreign governments. It classifies those loans as assets and then uses them as collateral for the creation of even more money here in the United States. That was truly a revolutionary expansion of the Fed's power to inflate. Until then, it was permitted to make money only for the American government. Now, it was able to do it for any government. Since then, it has been functioning as a central bank for the entire world. Mexico. By 1982, almost every third world government was running behind in payments. Mexico led the way by announcing it could not send any more money that year on its $85 billion debt. Federal Reserve Governor Henry Wallach rushed to Switzerland to negotiate an IMF loan of $4.5 billion through the Bank of International Settlements. The central banks of Europe and Japan provided $1.85 billion, about 40%. The rest came from the Federal Reserve. Commercial banks postponed payments on the principal for 2 years, but with the infusion of new loans, payment on the interest was resumed. That did not solve the problem. Within a few years, Mexico was in arrears again, and in 1985, the banks agreed to postpone $29 billion in payments and rolled over another $20 billion, which means they issued new loans to pay off the old. In that same year, Secretary of the Treasury James Baker announced the government's plan to solve the world's debt crisis. It was a formal statement encouraging banks to continue lending to third world governments provided they promised to enact economic reforms favoring a free market. It was more of a philosophy than a plan because there was no hope that it would be implemented by any of the socialist governments receiving the loans. Behind the announcement was the implication that the federal government, acting through the Federal Reserve System, could be counted on to assist if the loans went sour. Baker called for funneling $29 billion over 3 years primarily to Latin American countries, of which Mexico was a prime recipient. Currency swap. Shortly after the Mexican government had loaned $55 million to Fidel Castro, it announced to the banks, "We will pay only what we have and no more." Whereupon Paul Volcker, head of the Federal Reserve, rushed to meet with Mexico's finance minister, Jesus Silva Herzog, and offered to put the American taxpayer into the breach. A $600 million short-term loan was extended to get Mexico past its election date of July 4th. It was called a currency swap because Mexico exchanged an equal number of pesos which it promised to redeem in U.S. dollars. Pesos, of course, were worthless in international markets, which is the reason Mexico wanted the dollars. The importance of this loan was not its size, nor even the question of repayment. It was the manner in which it was made. First, it was made by the Federal Reserve directly, acting as a central bank for Mexico, not the U.S., and secondly, it was done almost in total secrecy. William Grider gives the details. The currency swaps had another advantage. They could be done secretly. Volcker discreetly informed both the administration and the key congressional chairman, and none objected. But the public reporting of currency swaps was required only every quarter, so the emergency loan from the Fed would not be disclosed for 3 or 4 months. By that time, Volcker hoped Mexico would be arranging more substantial new financing from the IMF. The foreign assistance was done as discreetly as possible to avoid setting off a panic, but also to avoid domestic political controversy. Bailing out Mexico, it seemed, was too grave to be controversial. Debt swap. The currency swap did not solve the problem. So, in March of 1988, the players and referees agreed to introduce a new maneuver in the game, an accounting trick called a debt swap. A debt swap is similar to a currency swap in that the United States exchanges something of real value in return for something that is worthless. But instead of currencies, they exchange government bonds. The transaction is complicated by the time value of those bonds. Currencies are valued by their immediate worth, what they will buy today, but bonds are valued by their future worth, what they will buy in the future. After that differential factor is calculated, the process is essentially the same. Here's how it worked. Mexico, using US dollars, purchased $492 million worth of American Treasury bonds that pay no interest, but which will pay $3.67 billion when they mature in 20 years. Technically, these are called zero-coupon bonds. Then Mexico issued its own bonds with the U.S. securities tied to them as collateral. This meant that the future value of Mexico's bonds, previously considered worthless, were now guaranteed by the United States government. The banks eagerly swapped their old loans for these new Mexican bonds at a ratio of about 1.4 to 1. In other words, they accepted $100 million in bonds in return for canceling $140 million in old debt. That reduced their interest income, but they were happy to do it because they had swapped worthless loans for fully guaranteed bonds. This maneuver was hailed in the press as true monetary magic. It would save the Mexican government more than $200 million in annual interest charges. It would restore cash flow to the banks. And, miracle of miracles, it would cost nothing to American taxpayers. The reasoning was that the Treasury bonds were sold at normal market rates. The Mexican government paid as much for them as anyone else. That part was true, but what the commentators failed to notice was where Mexico got the American dollars with which to buy the bonds. They came through the IMF in the form of foreign currency exchange reserves. In other words, there were subsidies from the industrialized nations, primarily the United States. So, the U.S. Treasury put up the lion's share of the money to buy its own bonds. It went $500 million deeper in debt and agreed to pay $3.7 billion more in future payments, so the Mexican government could continue paying interest to the banks. That is called bailout, and it does fall on the American taxpayer. IMF becomes final guarantor. The following year, Secretary of State James Baker, CFR, and Treasury Secretary Nicholas Brady, CFR, flew to Mexico to work out a new debt agreement that would begin to phase in the IMF as final guarantor. The IMF gave Mexico a new loan of $3.5 billion, later increased to $7.5 billion. The World Bank gave another $1.5 billion, and the banks reduced their previous loan values by about a third. The private banks were quite willing to extend new loans and reschedule the old. Why not? Interest payments would now be guaranteed by the taxpayers of the United States and Japan. That did not permanently solve the problem, either, because the Mexican economy was suffering from massive inflation caused by internal debt, which was in addition to the external debt owed to the banks. The phrases internal debt and domestic borrowing are code for the fact that government has inflated its money supply by selling bonds. The interest it must pay to entice people to purchase those bonds can be staggering, and, in fact, interest on Mexico's domestic borrowing was draining 3 times as much from the economy as the foreign debt service had been siphoning off. Notwithstanding this reality, Citicorp Chairman John S. Reed, CFR, whose bank is one of Mexico's largest lenders, said they were prepared to lend even more now. Why? Did it have anything to do with the fact that the Federal Reserve and the IMF would guarantee payments? Not so. Because we believe the Mexican economy is doing well, he said. At the end of 1994, the game was still going and the play was the same. On December 21st, The Mexican government announced that it could no longer pay the fixed exchange rate between the peso and the dollar, and that the peso would now have to float in the free market to find its true value. The next day, it plummeted 39%, and the Mexican stock market tumbled. Once again, Mexico could not pay the interest on its loans. On January 11th, President Clinton, CFR, urged Congress to approve U.S. guarantees for new loans up to $40 billion. Secretary of the Treasury Robert Rubin, CFR, explained, "It is the judgment of all, including Chairman Alan Greenspan, CFR, that the probability of the debts being paid by Mexico is exceedingly high." But while Congress debated the issue, the loan clock was ticking. Payment of $17 billion in Mexican bonds was due within 60 days, and $4 billion of that was due on the 1st of February. Who was going to pay the banks? This matter could not wait. On January 31st, acting independently of Congress, President Clinton announced a bailout package of over $50 billion in loan guarantees to Mexico, $20 billion from the U.S. Exchange Stabilization Fund, $17.8 billion from the IMF, $10 billion from the Bank of International Settlements, and $3 billion from commercial banks. Brazil became a major player in 1982 when it announced that it too was unable to make payments on its debt. In response, the U.S. Treasury made a direct loan of $1.23 billion to keep those checks going to the banks while negotiations were underway for a more permanent solution through the IMF. 20 days later, it gave another $1.5 billion. The Bank of International Settlements advanced $1.2 billion. The following month, the IMF provided $5.5 billion. Western banks extended $10 billion in trade credits. Old loans were rescheduled, and $4.4 billion in new loans were made by a Morgan Bank syndication. The temporary loans from the U.S. Treasury were extended with no repayment date established. Ron Chernow comments, "The plan set a fateful precedent of curing the debt crisis by heaping on more debt. In this charade, bankers would lend more to Brazil with one hand, then take it back with the other. This preserved the fictitious book value of loans on bank balance sheets." Approaching the rescue as a grand new syndication, the bankers piled on high interest rates and rescheduling fees. By 1983, Third world governments owed $300 billion to banks and $400 billion to the industrialized governments. 25 nations were already behind in their payments. Brazil was in default a second time and asked for rescheduling, as did Romania, Cuba, and Zambia. The IMF stepped in and made additional billions of dollars available to the delinquent countries. The Department of Agriculture, through its Commodity Credit Corporation, paid $431 million to American banks to cover payments on loans from Brazil, Morocco, Peru, and Romania. At the conclusion of these agreements, the April 20th, 1983, Wall Street Journal editorialized that the international debt crisis is for all practical purposes over. Not quite. By 1987, Brazil was again in default on its monstrous $121 billion debt, this time for 1.5 years. In spite of the torrent of money that had passed through its hands, it was now so broke it couldn't even buy gasoline for its police cars. In 1989, as a new round of bailout was being organized, President Bush, CFR, announced that the only real solution to the third world debt problem was debt forgiveness. Perhaps, through repetition, we are running this history into the ground. But here are just a few more examples before moving along. Argentina. BY 1982, Argentina was unable to make a $2.3 billion payment that was due in July and August. The banks extended their loans while the IMF prepared a new infusion in the amount of $2.15 billion. This restored the interest payments and gave the Argentinian politicians a little extra spending money. 7 months later, Argentina announced it could not make any more payments until the fall of 1983. The banks immediately began negotiations for rollovers, guarantees, and new IMF loans. Argentina then signed an agreement with 350 creditor banks to stretch out payments on nearly a fourth of its $13.4 billion debt, and the banks agreed to lend an extra $4.2 billion to cover interest payments and political incentives. The IMF gave $1.7 billion. The United States government gave an additional $500 million directly. Argentina then paid $850 million in overdue interest charges to the banks. By 1988, Argentina had again stopped payment on its loans and was falling hopelessly behind as bankers and politicians went into a huddle to call the next bailout play. Somehow, the payments had to be passed on one more time to the taxpayers, which they were in the form of new loans, rollovers, and guarantees. As summarized by Larry A. Shostad at the University of Chicago, there isn't a U.S. bank that would not sell its entire Latin American portfolio for 40 cents on the dollar were it not for the possibility that skillful political lobbying might turn up a sucker willing to pay 50 or 60 or even 90 cents on the dollar. And that sucker is the U.S. taxpayer. As mentioned previously, this history can become repetitious and boring. It would be counterproductive to cover the same sordid story as it has unfolded in each country. Suffice it to say that the identical game has been played with teams from Bolivia, Peru, Venezuela, Costa Rica, Morocco, the Philippines, the Dominican Republic, and almost every other less developed country in the world. The need for convergence. This sets the stage for understanding the next phase of the game, which is unfolding as these words are being written. It is the inclusion of China and the former Soviet bloc into the grand design for global government. As with all the other countries in the world, the primary mechanism being used to accomplish this goal, at least in the field of economics, is the IMF/World Bank. The process is 1. The transfer of money from the industrialized nations, which drags them down economically to a suitable common denominator, and 2. The acquisition of effective control over the political leaders of the recipient countries as they become dependent upon the money stream. The thing that is new and which sets this stage apart from previous developments is that the apparent crumbling of communism has created an acceptable rationale for the industrialized nations to now allow their lifeblood to flow into the veins of their former enemies. It also creates the appearance of global political convergence, a condition which CFR theoretician Richard Cooper said was necessary before Americans would accept having their own destinies determined by governments other than their own. China. Red China joined the IMF/World Bank in 1980 and immediately began to receive billions of dollars in loans, although it was well known that she was devoting a huge portion of her resources to military development. By 1987, China was the IMF's second largest borrower, next to India, and the transfusions have grown at a steady pace ever since. The bank has asserted that loans will encourage economic reforms in favor of the private sector. Yet, none of the money has gone to the private sector. All of it is funneled into the government bureaucracy, which, in turn, wages war against the free market. In 1989, after small businesses and farms in the private sector had begun to flourish and surpass the performance of similar government enterprises, Red China's leaders clamped down on them with harsh controls and increased taxes. Vice Premier Yao Yilin announced that there was too much needless construction, too many private loans, and too much spending on luxuries such as cars and banquets. To stop these excesses, he said it would be necessary to increase government controls over wages, prices, and business activities. Then there is the question of why China needs the money in the first place. Is it to develop her industry or natural resources? Is it to fight poverty and improve the living standard of her citizens? James Bovard answers, the bank's defense of its China policy is especially puzzling because China itself is going on a foreign investment binge. The World Bank gives China money at zero interest, and then China buys property in Hong Kong, the United States, Australia, and elsewhere. An economist with Citibank estimated that China's direct investment in property, manufacturing, and services in Hong Kong alone topped $6 billion. In 1984, China had a net outflow of capital of $1 billion. Moreover, China has its own foreign aid program, which has given more than $6 billion in recent decades, largely to leftist governments. The Great Deception. It is the author's contention that the much heralded demise of communism in the Soviet bloc is a mixture of fact and fantasy. It is fact at the bottom level of communist society where the people, in truth, rejected it long ago. The only reason they appeared to embrace it for so many years was that they had no choice. As long as the Soviets held control of the weapons and the means of communication, the people had to accept their fate. But at the tip of the pyramid of state power, it is a different story. The top communist leaders have never been as hostile to their counterparts in the West as the rhetoric suggests. They are quite friendly to the world's leading financiers and have worked closely with them when it suits their purposes. As we shall see in the following section, the Bolshevik Revolution actually was financed by wealthy financiers in London and New York. Lenin and Trotsky were on the closest of terms with these moneyed interests, both before and after the revolution. Those hidden liaisons have continued to this day and occasionally pop to the surface when we discover a David Rockefeller holding confidential meetings with a Mikhail Gorbachev in the absence of government sponsorship or diplomatic purpose. It is not unreasonable to imagine a scenario in which the leaders of the communist bloc come to realize they cannot hold themselves in power much longer. There comes a point where even physical force is not enough, especially when the loyalties of those who hold the weapons also begin to falter. With economic gangrene creeping up the legs of their socialist systems, they realize they must obtain outside financial assistance or perish. In such a scenario, quiet agreements can be worked out to the mutual advantage of all negotiators. The plan could be as simple as a Statue of Liberty play in a college football game, the appearance of doing one thing as a cover for accomplishing something else. While Americans are prepared to accept such deception on a football field, they cannot believe that world financiers and politicians are capable of it. The concept is rejected out of hand as a conspiracy theory. Nevertheless, in this scenario, we theorize it is agreed among the negotiators that the Soviet bloc needs financial support. It is agreed that the Western nations have the capacity to provide it. It is agreed that the best way to move money from the industrialized nations into the Soviet bloc is through international agencies such as the IMF/World Bank. It is agreed this cannot happen until hostility between world systems is replaced by political convergence. It is agreed that future conflict is wasteful and dangerous to all parties. Therefore, it is finally agreed that the Soviet bloc must abandon its posture of global aggression while the Western nations continue to move towards socialism, necessary steps for the long-range goal of merger into a world government. But in doing so, it must be ensured that the existing communist leaders retain control over their respective states. Communists become social democrats. To that end, they change their public identities to social democrats. They speak out against the brutal excesses of their predecessors, and they offer greater freedom of expression in the media. A few dispensable individuals among their ranks are publicly purged as examples of the demise of the old order. States that once were held captive by the Soviet Union are allowed to break away and then return on a voluntary basis. If any leaders of the newly emancipated states prefer true independence instead of alignment with Russia, they are replaced. No other changes are required. Socialism remains the economic system of choice, and although lip service may be given to free market concepts, the economy and all means of production remain under state control. The old communists are now social democrats, and without exception, they become the leaders in the new system. The West rejoices, and the money starts to move. As an extra bonus, the former Bolsheviks are now hailed by the world as great statesmen who put an end to the Cold War, brought freedom to their people, and helped to forge a new world order. When did communism depart? We're not quite sure. All we know is that one day we opened our newspapers and it was accomplished. Social democrats were everywhere. No one could find any communists. Russian leaders spoke as longtime enemies of the old regime. Perestroika was here. Communism was dead. It was not killed by an enemy. It voted itself out of existence. It committed suicide. Does it not seem strange that communism fell without a struggle? Is it not curious that the system, which was born out of class conflict and revolution, and which maintained itself by force and violence for almost a century, just went away on its own? Communism was not overthrown by people rising up with clubs and pitchforks to throw off their yoke of tyranny. There was no revolution or counter-revolution, no long period of fragmentation, no bloody surges between opposing forces. Poof! It just happened. True, there was blood in the streets in those areas where opposing groups vied for power, but that was after communism had departed, not before. Such an event had never occurred in history. Until then, it had been contrary to the way governments act, contrary to the very nature of power, which never surrenders without a life-and-death struggle. This, indeed, is a great curiosity, which should cause people to think. Our premise is that the so-called demise of communism is a great deception, not awfully different from many of the others that are the focus of this volume. We see it as having been stage-managed for the purposes outlined previously, the transition to world government. In our view, the only scenario is the only one that makes sense in terms of today's geopolitical realities and the only one consistent with the lessons of history. We realize, of course, that such a view runs contrary to popular opinion and conventional wisdom. For many, it is shocking just to hear it spelled out. It would not be possible to convince anyone of its truth without extensive evidence. Certainly, such evidence abounds, but it is not within the scope of this study. So, now that we have stated it, we shall leave it behind merely as a clarification of the author's point of view so the reader can step around it if he wishes. Eastern Europe. American aid to Eastern European governments, while they were still puppet states of the Soviet Union, has been justified by the same theory advanced on behalf of China. It would improve their economies, show their people a better way of life, and wean them from communism. Advocates of that theory now point to the demise of communism as evidence of the soundness of their plan. The truth, however, is that the money did not improve the economy and did not show the people a better way of life. In fact, it did not help the people in any way. It went directly to their governments and was used for government priorities. It strengthened the ruling parties and enabled them to solidify their control. It is well known that one of the reasons Poland's economy was weak is that much of her productive output was shipped to the Soviet Union at concessionary prices, primarily to support the military. Polish-built tanks fought in the Vietnam War. 20% of the Soviet merchant marine was built in Poland. 70% of Poland's computer and locomotive production and 80% of her communications equipment was shipped to the Soviets. American grain purchased by Poland with money borrowed from American banks was sent to Cuba. Poland was merely a middleman, a conduit to Russia and her satellites. The banks were really funding Russia. It was in 1982 that Poland first defaulted on bank loans, which had been guaranteed by the U.S. government through the Commodity Credit Corporation. Under the terms of the guarantee, taxpayers would make payments on any bank loan that went into default. That was what the banks were counting on when they made those loans, but to classify them as in default would require the banks to remove them from their books as assets. That was unacceptable because it would make their balance sheets look as bad as they really were. So the Treasury agreed to bend the rules and make payments without requiring the loans to be in default. That was eventually stopped by an irate Congress, but not until the Reagan administration had stalled long enough to pay $400 million directly to the banks on behalf of Poland. In November 1988, the World Bank made its first loan to Poland in the amount of $17.9 million. 3 years later, in a dramatic demonstration of what the president had meant when he advocated debt forgiveness, the Bush administration canceled a full 70% of the $3.8 billion owed to the United States. Taxpayers picked up the bill. The same story has been unfolding in all the former Soviet bloc countries. In 1980, for example, just before Hungary was brought into the IMF/World Bank, her annual per capita GNP was $4,180. This was a problem because the policy of the World Bank was to make development loans only to countries that had per capita GNPs of less than $2,650. Not to worry. In 1981, the Hungarian government simply revised its statistics downward from $4,180 to $2,100.10. That was a drop of 50% in 1 year, surely one of the sharpest depressions in world history. Everyone knew it was a lie, but no one raised an eyebrow. It was all part of the game. By 1989, the Bush administration had granted most favored nation trade status to the Hungarian government and established on its behalf a special $25 million development fund. Russia. American banks had always been willing to make loans to the Soviet Union, except for short periods of expediency during the Cuban Missile Crisis, the Vietnam War, the Soviet invasion of Afghanistan, and other minor business interruptions. In 1985, after the public had lost interest in Afghanistan, banks of the free world reopened their loan windows to the Soviets. A $400 million package was put together by a consortium of First National of Chicago, Morgan Guaranty, Bankers Trust, and Irving Trust, plus a London subsidiary of the Royal Bank of Canada. The loan was offered at unusually low interest rates to buy American and Canadian grain. Public indignation is easily disarmed when the announced purpose of a loan to a totalitarian government is to purchase commodities from the country where the loan originates, especially if the commodity is grain for the assumed purpose of making bread or feeding livestock. Who could possibly object to having the money come right back to our own farmers and merchants in the form of profits? And who could fault a project that provided food to the hungry? The deception is subtly appealing. It is true that the money will be used, in part at least, to buy grain or other locally produced list of World Bank countries. Eastern Europe, by Jerry Lewis, Wall Street Journal, Commodities. But the borrowing nations are like a homeowner who increases the mortgage on his house to enlarge his living room. He probably will make the addition, but he borrows twice as much as he needs so he can also buy a new car. Since the government allows a tax deduction on mortgage interest, in effect, he now gets a tax deduction for the interest paid on his car as well. Likewise, the borrowing nations usually borrow more than they need for the announced purchase, but they receive all the money at favorable rates. Yet, this is not the most serious fault in the transaction. In the case of Russia, the grain was no small item on her list of needs. After repeated failures of her socialist agriculture, she was not able to feed her population. Hungry people are dangerous to a government. Russia needed grain to head off internal revolt far more than the homeowner needed to increase the size of his living room. In other words, Russia had to have the grain, with or without the loan. Without it, she would have had to curtail spending somewhere else to obtain the money, most likely in her military. By giving her the money to buy grain, we actually allowed her to spend more money on armaments. But even that is not the primary flaw in making loans to Russia. The bottom line is that most of those loans will never be repaid. As we have seen, the name of the game is bailout, and it is as certain as the setting sun that somewhere down the line, Russia will not be able to make her payments, and the taxpayers of the industrialized nations will be put through the IMF ringer one more time to squeeze out the transfer purchasing power. Business ventures in Russia insured by U.S. In 1990, the U.S. Export-Import Bank announced it would begin making direct loans to Russia. Meanwhile, the U.S. Overseas Private Investment Corporation was providing free insurance to private companies that were willing to invest in the ex-Soviet state. In other words, it was now doing for industrial corporations what it had been doing all along for banks, guaranteeing that if their investments turned sour, the government, make that taxpayers would compensate them for their losses. The limit on that insurance had been $100 million, a generous figure, indeed. But to encourage an even greater flow of private capital into Russia, the Bush administration authorized unlimited protection for sound American corporate investments. If these truly were sound investments, they would not need foreign aid subsidies or government guarantees. What is really happening in this play is a triple score. 1. International lending agencies provide the Social Democrats with money to purchase goods and services from American firms. No one really expects them to repay. It is merely a clever method of redistributing wealth from those who have it to those who don't, without those who have it catching on. 2. American firms do not need money to participate. Since their ventures are guaranteed, Banks are anxious to loan whatever amount of money is required. Efficiency or competitiveness are not important factors. Contracts are awarded on the basis of political influence. Profits are generous and without risk. 3. When the Social Democrats eventually default in their contracts. To the American firms, or when the joint venture loses money because of socialist mismanagement, the federal government provides funds to cover corporate profits and repayment of bank loans. There you have it. The Social Democrats get the goodies, the corporations get the profits, and the banks get the interest on money created out of nothing. You know what the taxpayers get? By 1992, the wearisome pattern was clearly visible. Writing in the New York Times, columnist Leslie H. Gelb gave the numbers. The ex-Soviet states are now meeting only 30% of their interest payments and almost no principal on debts to the West of $70 billion. Various forms of Western aid to the ex-Soviet states totaled about $50 billion in the last 20 months, and the money has virtually disappeared without a trace or a dent on the economic picture. The interesting thing about this report is that Leslie Gelb has been a member of the CFR since 1973. Why would a CFR spokesman blow the whistle on one of their most important maneuvers toward the New World Order? The answer is that he is doing just the opposite. Actually, he is making a plea for more loans and more outright aid on the basis that the need is so great. He advocates the prioritizing of funding with first attention to aiding Russia's nuclear power facilities, agriculture, and industrial capacity. At the end of his article, he writes, "The stakes could not be higher. All the more reason for substantial, practical, and immediate aid, not for grand illusions." Congress hears and obeys. In spite of the fact that all the preceding billions have disappeared without a trace or a dent, the transfusion continues. In 1993, the World Bank advanced another $500 million loan to Russia. Before leaving office, President Bush arranged for another $2 billion loan through the Export-Import Bank, and Congress authorized hitting the voters with another $2.5 billion in foreign aid earmarks specifically for Russia. In July, at the Tokyo summit meeting of the Group of 7 industrialized nations, another $24 billion was promised, half of which will come from the IMF. As this book goes to print, there is no end in sight. The conspiracy theory. A moment's reflection on the events described in this section leads us to a crossroads of conscience. We must choose between two paths. Either we conclude that Americans have lost control over their government, or we reject this information as a mere distortion of history. In the first case, we become advocates of the conspiratorial view of history. In the latter, we endorse the accidental view. It is a difficult choice. The reason it is difficult is that we have been conditioned to laugh at conspiracy theories, and few people will risk public ridicule by advocating them. On the other hand, to endorse the accidental view is absurd. Almost all of history is an unbroken trail of one conspiracy after another. Conspiracies are the norm, not the exception. The industrialized nations of the world are being bled to near death in a global transfer of their wealth to the less developed countries. Is it being done according to plan? Or is it an accident? It is not being done to them by their enemies. It is being done by their own leaders. The process is well coordinated across national lines and perfectly dovetails with the actions of other leaders who are doing the same thing to their respective countries. Furthermore, these leaders regularly meet together to better coordinate their activities. Could anything that complex be accomplished be by accident? Or would some kind of a plan be required? A spokesman from the IMF would answer, yes, there's a plan, and it is to aid the less developed countries. But after 40 years and hundreds of billions of dollars, they have totally failed to accomplish that goal. Would intelligent people believe that pursuing the same plan will produce different results in the future? Then why do they follow a plan that cannot work? The answer is they are not following that plan. They are following a different one which has been very successful from their point of view. Otherwise, we must conclude that the leaders of the industrialized nations are, to a man, just plain stupid. We do not believe it. There is little room to escape the conclusion that these men and women are following a higher loyalty than the self-interest of their respective countries. In their hearts, they may honestly believe that, in the long run, the world will be better for it, including their fellow countrymen. But for the present, their goals and their methods are not shared by those who have placed them in office. Under those circumstances, they must conceal their plan from public view. If their fellow citizens really knew what they were doing, they would be thrown out of office, and in some cases, might even be shot as traitors. Add all that together, and it spells conspiracy. The only other explanation is that it's all accidental. No plan, no cooperation, no goal, just the blind forces of history following the path of least resistance. For some, it will be easier and more comfortable to accept that model. But the evidence speaks loudly against it. What is the evidence? Not just the previous chapters, but everything that follows in this book. By contrast, the evidence for the accidental theory of history is a blank page. Summary. The international version of the game, called Bailout, is similar to the domestic version in that the overall objective is to have the taxpayers cover the defaulted loans so that interest payments can continue going to the banks. The differences are, 1. Instead of justifying this as protecting the American public, the pretense is that IT is to save the world from poverty. And 2. The main money pipeline goes from the Federal Reserve through the IMF/World Bank. Otherwise, the rules are basically the same. There is another dimension to the game, however, that involves more than mere profits and scam. It is the conscious and deliberate evolution of the IMF/World Bank into a world central bank with the power to issue a world fiat currency. And that is an important step in an even larger plan to build a true world government within the framework of the United Nations. Economically strong nations are not candidates for surrendering their sovereignty to a world government. Therefore, through loans that will never be paid back, the IMF/World Bank directs the massive transfer of wealth from the industrialized nations to the less developed nations. This ongoing process eventually drains their economies to the point where they also will be in need of assistance. No longer capable of independent action, they will accept the loss of sovereignty in return for international aid. The less developed countries, on the other hand, are being brought into the New World Order along an entirely different route. Many of these countries are ruled by petty tyrants who care little for their people except how to extract more taxes from them without causing a revolt. Loans from the IMF/World Bank are used primarily to perpetuate themselves and their ruling parties in power. And that is exactly what the IMF/World Bank intends. Rhetoric about helping the poor notwithstanding, the true goal of the transfer of wealth disguised as loans is to get control over the leaders of the less developed countries. After these despots get used to the taste of such an unlimited supply of sweet cash, they will never be able to break the habit. They will be content, already are content, to become little gold-plated cogs in the giant machinery of world government. Ideology means nothing to them. Capitalist, communist, socialist, fascist. What does it matter so long as the money keeps coming? The IMF/World Bank literally is buying these countries and using our money to do it. The recent inclusion of Red China and the former Soviet bloc on the list of IMF/World Bank recipient countries signals the final phase of the game. Now that Latin America and Africa have been purchased into the New World Order, this is the final frontier. In a relatively short time span, China, Russia, and the Eastern European countries have now become the biggest borrowers, and already they are in arrears on their payments. This is where the action will lie in the months ahead. If you enjoyed listening, please subscribe to the channel by hitting the subscribe button below. After doing so, click the bell icon to receive new content notifications.